Good morning, OTC. Good morning, good morning, good morning, good morning. How the fuck is everybody doing? Good morning. Dr. Good morning to you, sir. Arctic. Good day to you. I still think you're going to have a little dip on that Lucid still. We'll talk about it in a little bit. Ace Lee, good morning. Streamlabs. Suck it. GTA. Doing his best George Bush Sr. and redacting every fucking thing in the chat. Good for you, buddy. MIA, good morning to you, sir.
Good morning. Happy Thursday, everybody. Let's go.
I mean, I'm ready.
Thursday, right?
Guten Morgen to you too, Mr. Shermcorp. Brandy Stogner, what's up, baby?
Andy.
Okay, all right.
Guten Morgen.
No, Ace Lee said Gut Morgan.
Yes,
G-U-T-E.
Guten Morgen.
Yeah, Ace Lee's been on that bullshit lately, but we love him for it.
Hey.
How you looking? How's everything feeling?
Feeling good. Market's not looking great. We're getting smacked.
Are you?
When I left the house. Am I looking good? I'm looking great. You kidding me? I gotta walk up in Niagara Falls Public School in 45 minutes. Dude, I'm fresh, dressed like $1,000,000.
Oh, smelling, feeling like $1,000,000. Are you doing the pass the bottle? The heat is on. Everybody's in the back smoking the Cheech and Chong. Hell yeah. Okay. All right. Well, good morning, CVS. How's everything? We got some lovely news from Birdie. Morning USA made some nice gains on my bankruptcy, on my bank puts today. Looking to reinvest within the coming hours. If Wall Street would be kind enough to fake pump so he can get... Birdie's basically bitching at the market wanting a little bit better buy to the downside. Hey, Bird, I think you're about to get it too.
Boy, Birdie.
Congratulations, sir. Yeah, we have been...
Just because you put helmets on doesn't mean you can ride your bike in the middle of the road, asshole.
No, at that point, no, you're good. At that point, he's identifying as a vehicle, and at that point, it's a bumper-to-bumper collision. It's not a vehicular homicide.
Interesting.
Yeah. I'm identifying as transparent.
They had some interesting stuff to play on CNBC this morning. So they had these very pro LGBTQ people on, and they were saying that it's all a farce, that the people protesting, and they specifically were talking about Anheuser-Busch and Target, and they were saying that the reason that the stock's plummeting and that the stores will never recover isn't because of the people that were against it, but it was because the LGBT, that community, turn their backs on them, and that if companies don't start adhering and carrying their products, that we're going to see more of this.
Look, we got bigger fucking problems.
It seemed to me, if you looked real closely, you could see the hand of BlackRock shoved right up this lady's ass and working her mouth like a puppet.
Oh yeah, Mr. Fink himself.
Yeah.
Yeah, Fink elbow deep in this lady, just going and Elmo-ing the shit.
Just keep an eye on it, because now you have BlackRock interjecting and trying they're trying their absolute hardest to start a culture war.
Well, you have seen Fink's recent comments at the World Economic Forum that was saying that, well, we need to go and we need to push these behaviors. Basically talking about investors almost as if they were fucking dogs. Like we need to be herded like cattle. And
are you talking? Well, yeah. Are you talking about the James O'Keefe thing?
No, I'm talking about Larry Fink.
Did you see the James O'Keefe the undercover shit with the dude from BlackRock?
No, you're talking about the former employee?
Yeah.
Yeah, I did hear. Yeah, it's the pandemonium setting in. He's thinking big shit's popping.
Pretty much.
Yeah. No, I don't think that he's wrong. I think it definitely could get there. I think that somebody's going to go and probably step in prior. Good morning, everybody. Hit the absolutely, Birdie. If you have not if I can't tell you, you got to learn from Birdie himself. Very, very smart man. He's going and letting you know you got to hit that like button with your lips, dude.
You do?
Yeah, and Girth said it was kinky, so Girth approved. Here's what I got today. I'm actually pretty excited for this trade. I've been watching this. I mean, we've been watching this for years, but right this moment, the hourly. If anybody can go and tell me what this looks like.
That looks just like two balls.
Johnson.
That's a giant Woody. Woody Harrelson, ladies and gentlemen.
Dick and balls. Now, right here, we're looking at this, and you got to think that this is a Head and Shoulders, right? This is creating a neckline we're now getting rejected from. I genuinely think we end up, and I'm not bullshitting, but this is not financial advice. This is what I will be doing today. And you can go and check these out in the gains section after the fucking closing hours. I'm looking at the 429 area for this to come back to. I do not want to be playing 429s. I probably won't even play 430s. I think we're going to get 429 and some change today. I'm looking first at 430, so I'm more than likely going to be playing like a 431 call. At very, very least, I will be playing the 400s and not playing with them long. Yeah, AGLE is 400% to the upside or some stupid shit. Thing's flying. AMC is down what? 6%. It was down almost 8 earlier, down to the 420. Now that I'm looking at this, I think that there's a possibility of 408. But here is what I will say. I think that we go and end up going low. They're going to probably try us around the 332.28 to go and say, oh, we're going to bounce here. I don't think so. I think that's when they're going to go and you're going to see an uptick in calls. And then you're going to watch everything go and you're going to see a bunch of uptick in calls, people starting to buy, thinking that that's the dip, and then they're just going to push it one more time. Excuse me. I think you might get some upside off the first candle this morning. I'm going to be looking to the 435.70, 435.80 area. But I'm going to be looking into that. Anything pretty much around north of the 430, I think it was 434.50. I'm going to be probably looking south in a very, very, very big way. We got absolutely fucking pulled yesterday for 40% or something like that on Tesla. So we got a little bit of ground to make up. But those Palantir puts, the 1250s were going off. Those 15 and a halves that we picked up on Tuesday went absolutely nuts. We were picking them up for $10 a piece, and those went up to shit. I mean, those are up hundreds, at least. Yeah, we're already $50 in the money. Those 15 fives are, yeah, $100. So that's $1,000 option right there. But I genuinely think there is a good amount of downside. Bitcoin going to 40, let it run. I don't give a shit. I'm going to go and I'm going to let you know Google's a very, very interesting one, as well as AMD. I think AMD is probably going to come and try to retouch $9, or not $9, excuse me, 109, $109 on AMD, not 9. Correct. Sorry to misspeak, but 109 on AMD seems perfectly good to me. But we did see a lot of volume coming to the downside all day yesterday. We got absolutely fucked on. People think that this is going to bounce along with the market. I'm gonna go and beg to differ. I think that you're gonna probably see the 622 push, 622.50 on Tesla. Shib did have a good night. Damn, AGLE is up 600. The Jesus Christ. Doesn't even have a daily chart. Nuts. But yeah, I do genuinely like the downside. I would like to see a little wick up just to give me a little bit of sentiment, like you have a little bit of lead in your pencil here for the SPY. Because I want there to be skin in the game for people, for them to fuck out of their money. Simple as that. There's no reason to run the SPY down if there's not money to go and steal, if that makes any sense. Now 700. Yeah, that's going to be an interesting one. I would stay away from the runners. I did not take my own advice, so I'm fucking around with Nikola, and Nikola seems like a really good buy to me at 140 area, but it's held that 140 over and over and over again. I think you might get a dip. But that being said, you go and start breaking into 154 area and it's church. I think that you're gonna try. They're gonna try to give you a bottom right here off of 434, as if it's just gonna like run back up to this area. I think they're gonna try to hold it over 334.50. They might try to take it up one more time to 3508 or something like that, and then it'll probably come back down. But I'm not negotiating on downside off of this level back into that head and shoulders. If we see a bounce at, like, let's say 431 or so, then maybe I'll start going and I'll look at it for what it is at that point. But the fact that on Nikola we held that 137, I look at that as decently bullish. But Lucid has a lot of puts to the $6 and the $6.50, or to the $5.50. So what I was saying to Arctic earlier was, I genuinely think that there is a possibility today for Lucid to be under, and I mean under, 550, and even potentially lower than that. But I would watch this 614 area. I wouldn't go and allow myself to go, and if it does happen to break up, don't freak out about it, just because right this moment it's only moving like 8, 9, 10, 20 cents, if that, a day. So tell fucking Lucid to smoke pull until it goes and gets at least a dollar on its name. But right now I do have those 7 calls that are getting probably just eaten theta wise. We're going to be out of those as soon as we possibly can. I have a phone call that I have to take literally 5 minutes at 9:40. So I will go and just hop right back in after I get off the phone and give you guys the understanding of what I'm looking at in the market. Wells Fargo is fake green pre-market. Probably not good for them. What I did find weird this morning was that Ape was up 10% exactly most of the morning. Thought it was just weird. But SQs are obviously up to what, 1.5, almost 1 and 1/10. I think that there's a decent amount of buyers stepping in underneath, but here's what I will say. I'm going to the downside today. If I see anything different, then obviously I'll abort it, reverse the play, and we'll go long. But I'm going to be patient into letting this run to where I want it. But I'm also not going to go and be hesitant on other plays, because I know that I'm going to stick with this trade to the downside. I'm going to continue to buy it pretty much any price that it goes to. So that being said, I will more than likely be out of anything that I buy that I just talked about today by the end of close, and I will more than likely reverse that exact position, probably a little closer to the money. So what I mean by that is I'm more than likely going to take puts to the downside off of the 34.50 area, and then if this does go, let's say, to 429, like I think it's going to, I think we're going to dip low. We're probably breaking that 430.19, and we'll probably bounce 429.46. Not financial advice. I'm just letting you know what the fuck I'm doing. That's what I'm looking at. Just pointing out an observation. First issue, though, is going to be this 31 area, and by then we're going to be making money. So that's what I am looking at, is 31, not... Because if it gets to 30 or 430 or 429, then I'm $200 plus whatever the fuck I was. But if I have 430s and I sit here and hang around at 431 for 2 fucking hours, I'm gonna be tight. So, also the thing that I had said about that area, I had said before I even look back, we were gonna go. Probably try to retest those pre-market lows, and I think that is exactly what they are tomorrow. Well, this downtrend that we have right now is more than likely going to go and give us that 32. Oh, that's S1. Okay, that's going to be or I'm sorry, that's T1. That's going to be a target 1. The fuck was I just looking at? Oh, right here. They were gonna try to probably go. We were looking at the hourly on the SPY. They were probably gonna try to go and try to show you a bottom right here around 432.70-ish. Well, when I turn this back on and I go back to the 5-minute, this downtrend is quite literally running through the level of 432.64 to sub that, but just assume that like this is where you could possibly find that bounce. But if we are going to get here, and I still think there's potential for more, that means that we're going to have to go about 432 by lunchtime. So I think that you're definitely going to get a move to the upside, probably just off rip here, and you're more than likely looking at the 434, 430, or 434.50. Let's call it 30. Let's call it 434.32 and that 434.80 area. But this is more than likely going to start playing a little bit of fuck you, go away kind of vibe. So I'm looking for that. I'm looking for the downside on Lucid. Palantir, probably more downside, but I am going to be patient with that one because that one can get a little rippy. Down 3%. I wouldn't be surprised if this one literally just goes right through the crotch. This one is set up to move to the downside at about 9:55, 10 o'clock. We have 5 minutes until the market opens. What's up, non-refundable? I just talked for about 10 minutes, letting you know where I think the market's going. I also think that that's going to probably give you the ability to buy Tesla 255, maybe a little higher than that, maybe the 250, 257, 258, but this is probably coming right back down to what? Let's call it 245 or so. But I'm going to be very cautious of where I put my money in tech right now, just because everything is very, very inflated. I think Google's a good buy if you have the stones to hold. It's definitely looking like a Head and Shoulders, but if you have the balls to go long on it, it might actually go and pay out if it does decide to continue. So yo at Fox. But yeah, I think we're going a little bit upside, a lot of red, and then I'm going to be exiting positions today and going calls into tomorrow. But if I get out of a stock and it's, let's say I get out of the SPY and it's 431, I'm going to be getting out and then getting back into calls, but I'm going to be getting it at like 432 because I don't think it's necessarily going to run up a lot. I think it might be running back to like 435 and then get rejected. So we're going to look at all that shit today, but we have about 4 minutes to the market open. SQ is definitely looking strong. It is absolutely fucking pouring all of a sudden again. So here in Florida, we have a little tradition. Whenever it's fucking pouring outside and the market is going on, it's usually red. Not kidding. Not even a little bit. Do I go and bet money on that fact? Yeah, all the time. If it rains out, seems like it's always a short.
Now climate change is affecting the stock market.
Nope. I just
I
think it's interesting how it's always perfectly timed.
Enzo Thunberg.
No, I think it's always perfectly timed how when my house feels like it's going to wash away, you normally just want to pick puts up.
How dare you?
Is Enzo or is AMC lawsuit doing something by the 30th? I think it was like June something that was the initial. When is that decision? It might be the 30th actually.
Yeah, I have no clue on that one.
I also think June 5th or July 5th might be a catalyst date. Can't tell you why though. The stock market last time it crashed on like a numerical number of 11. If you go and look at a lot of the events that go, and a lot of events have 11s in them. Palantir's trying to look strong right now, but I don't think so. I think Tesla is trying to go and show you that it's trying to bounce so hard, but I mean, you can't ignore the fact that it's getting just shit on. So yeah, make sure that you're going and being smart here. We have a minute going into the market. I will be here until I do my thing online with my doctor very, very quickly. And then I will be right back with you lovely people. Make sure you're keeping your eye on your own charts. 30 seconds, guys. MIA, anything else?
Good luck, everybody.
Good luck, everybody else.
Talking again today, in front of the Senate Banking Committee today. So yesterday was the House he was in front of. Today is the Senate. I think he got lost in the House yesterday because with the Adam Schiff stuff going on, it was Powell was kind of lost. So today they may focus a little bit more on what he has to say.
Okay.
Market's opening, the Dow down 0.15%, S&P down 0.25%, and the Nasdaq, what's the Nasdaq? Oh, Weeble doesn't want to show me the Nasdaq. Okay, Weeble, see what you're doing.
All right, what do we got? SQ's flickered up. All right, so here's the market trying to show you all the good shit. Trying to show you, hey, look, we're gonna bounce, everything's fine.
What is the Nasdaq doing? Why will Weeble not show me the Nasdaq?
I don't know.
Throw this phone out the window. It'll only show me. It's just like I've got the ticker that just shows the three indices, and it's only showing the S&P and the Dow.
Here's Tesla trying to make a little pushback like we thought.
Oh, this is ridiculous.
I'm shit. Alright. I am I'm trying to fill 431s for 16 cents. They're probably not going to fill. I'm moving them to 17. I just filled. Tesla's gotten a little run back up, but looks like Riot's trying to step itself up. Lucid, oh my god. Where are you going? Those 550s are moving already. Yo, Lucid's shitting. Alright, I will be right back, guys. My apologies. I am back, guys. Sorry about that. Sorry about that. Yep, we are doing exactly what we wanted. This is the green side. Now I think you're about to get pushed back the other way. Palantir's going, or excuse me, Lucid's getting shit on. Palantir's going through $14. I think that Palantir's fucking hysterical. I think that Amazon is getting a little too big for its britches. I'm looking at Amazon to go short right around the 127. Nasdaq's still pushing up for some reason, and I'm not really concerned. I just went short Amazon 121 or 127 puts at 127.80 for 91 a contract. All right, Amazon, I'm ready to turn. I think AMD is probably going to go and revert back to that 109. Neo's under $8. Go woke, going broke at GTA. Way to go, CVS. Bought those Teslas, or bought TSLL a while ago. Finally bought something that goes up. Good shit. Yeah, we have a lot of really bad bugs here as well. Yeah, I would like another, please. I went short on Lucid 5.5s. I took puts 5.5s. Oh, let me buy that dip on the SPY. Come on. Hood is picking up a another firm. Yep, there's Lucid breaking the 750. I want Amazon to turn the fuck around, please. There's Lucid. That's exactly what Lucid's done today. Right there. That's a fucking absolutely massive win right there. Those 127s only stayed at 82 for a couple seconds. Now they're back at 93. They're above where I bought them. Give me that bounce. Or not the bounce, but the SQ bounce. The shit in the market. I just went long on SQ20 calls. Right there. Tesla, chill the fuck out. Sit the hell down. And Spy, I don't know what you're doing, but you're not going up to 436. I would just appreciate you not doing that. Because, I mean, shit, you could go and do that. Because I still don't have a problem with that. Go ahead and send it up there. You think you got the big old peepee? Let's go. I just love. Pause. Tesla's still climbing back up. No, I think Tesla's about to get word that it just made an AI company. And that's good news. I think it's about to figure it out, though. We bought those SQ20 calls for next week, just to let you know. I think they'd probably still be good for this week. Oh, there's the break that it's trying to get on the 435. 435.7 was like a prediction of one of my areas. Well, excuse me, 135.04. I like the SQ. We bought the Lucid bounce right here off of this rejection. We got out of Tesla. Now, why is Amazon just cooking? No. Apple. Nasdaq's trying to go and lead everything. That's not gonna work. That's coming back. There's no way that I can make that work in my head. Coins coming to the downside. All of crypto is coming to the downside. Apple's trying to run us green, but I don't think that's gonna have it. There's that candle giving a hell of a lot more back than it should. bounce and short. I whispered in Tesla's ear and said, shh, it's okay. Yeah, we're about to get shit on, Billy. We're good. Nice to see you, sir. My real identity was exposed there for a minute. Oh, they had Mandingo in the fucking chat? Good shit. Oh, what the hell? Forgot. What's up? I'm just sitting here cooling out, maxing, relaxing out cool, and shooting some b-ball outside of the school. You know what I'm saying? Boeing is moving. Yeah, and Coinbase is shitting the bed. I think Meta's probably short here. Fuck you, stop. Fucking dickhead. Lucid, talk to me nice. Keep coming down. Oh, and it did break the 80. Good shit. Good for you. Keep going, girl. Head, shoulders, knees, and toes. Knees and toes. I'm about to find them cheeks. Oh, bend over, Jerome. Coming. I'm coming to see Papa. Órale, verga. Good thing, yeah, no shit. As long as they're printing money, everything's good. No one told you life was gonna be this way. Clap, 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 clap. There's the spy candle that I needed. Thank you. There's Palantir going through the 13 or through that $14, dude. I'm on fucking fire right now. Come on down. Jeromeo, I think. Clap, clap, clap. Should have. Yeah, do you know why it's called the clap, Billy? Oh, what a voluptuous trade. Fucking ace, dude. Oh, there's the downside. Yeah, buddy. Touch it. Look me in my eyes, Girth. Germ Corp says existing home sales. They were expecting 2.5 or 4.25 mil. The last was 2.9, and we currently have a 430. I don't know. I don't know how I work with numbers. I really don't. Harley Knight, what's up, baby? Nexi. SQ's coming up looking beautiful. Is Lucid continuing to go to the downside while we have downside pressure, though? Douglas PC was popping. Ace Lee, like, don't fucking scare him off. Oh yeah, by the way, those fucking people in the Titanic, I'm gonna let you know in case you don't know already, those fucking people are dead. Just being honest. So stop worrying about it. If you're the cute little human being that can worry about shit like that, don't. No reason. Fucking people are dead or are 100% alive and okay, but either way, there's no reason to worry about it. See, now you gotta love when the fucking stock is trying to use your buy area as support. Oh shit. Did I just get... We just got the tree fitty right there from God... No, we got even better than the tree fitty. We got the 420.69 from the Mr. Billionaire. I don't know where... I don't even know where it is because it's not showing up on my side of Restream, which is odd. Yo, Spire, you fucking good, bud? Okie dokie, I'll buy. I don't know why that's not. It was working the other day. Amazon looks like it's had enough. No. No, thank you, please. Stay calm, bro. It's crowns. No, I know that. I think this is cute. Not a shot. You better fucking hope. Yeah, right. Amazon and Apple are doing it single-handedly. And TMS apparently. Microsoft is just being asked. So Microsoft's probably going to go up right about there. If it wants to break, it's going to have to break 340, and then I'm shorting the piss out of it anyway. So where's all this money going? 250s. We're gonna go to 437 first. There's no point in doing that. I mean, that makes absolutely no sense. There's no way. There's no way you're gonna go and push me out of these. Amazon's playing games. Tesla's just doing whatever the fuck it wants to. Nvidia's up. It does not feel right. Come on, Bitcoin, join the party? No. Palantir's over the 14 again after it just fell through. Okay, I believe you, Spy. I don't understand. I don't know, but fucking, I'm touching. So I don't know why. I have not an idea why the fuck this market decided to run like this. But I think it goes and closes lower regardless. My sentiment does not change. Even with it doing this. Amazon seems fake. AMD's trying to go back to $9. I just went long on the SQs again. I absolutely hate Amazon right now. Palantir definitely pulled back. Now, I don't know if it's trying to squeeze itself, but I particularly don't give a shit. I don't want them to AMCQ either. Yeah, no, I mean, I don't think anybody wants to be. Explain this to me like I'm 5. No, you just crash it with Biden and blame it on him. I just bought more SPY 431s. So I showed it here. I'd be shorting Tesla back to probably 255. I would stay away from the 250s just to be safe. IMPP spinoff. Listen to what you just said. IMPP spinoff. How about you spin off the, never mind. There's no shot that people are. A spin-off of C3 AI. It's just odd. Oh, you're sturdy in the paint? Your turnaround jumper's fucking dog shit, though. I bet you. You probably got as much flex as fucking Dirk Nowitzki. Deadass serious. You got absolutely no sauce. Not even close. Somebody say spin? Yeah, sit and spin, baby. What's poppin'? IMPP changing to CISS. Elon Musk, apparently, as far as I know, is also going and making cisgender a slur. Alright, I'm ready to shit now, please. Bye-bye. That shit right through that 338, or excuse me, 438. Nope, still wrong. 435, 28. And then I think it might have been the 435.08. But I would be taking Tesla puts here. I think everything's getting trapped to the upside right now, guys. Look at every stock that I click on. Everything has more blue. This is definitely getting more red. told you life was gonna be this way. I'm gonna touch the market, something fierce. That's just be the way. I feel like there was a song in Tony Hawk Pro Skater back in the day that was made by like a school bus. Maybe their band name was literally fucking School Bus. Pal is saying that he thinks it's going to be appropriate to raise 2 more times this year. That's not the plunge team in action. That's fucking idiots buying right now. It's not the plunge team. Like this is just cold-blooded stupidity here. My sister? Your sister? Oh shit. Oh, domestic violence. You can come get my fucking 431 puts after I exercise them on your bitch ass. Not taking no for an answer. Stop fucking playing with me. There's no way. Here's my complication. Lucid wants to come back. Palantir's being fuck all, like just absolutely worthless. It just doesn't seem. This didn't seem right. This bounce in general didn't seem correct. So now what? We're just gonna run back up. Just to still be shit? Got rejected here. You'd have to break that. What the fuck happened to Amazon? Amazon's just sitting. If one of these stocks goes and takes one step out of line, this is a perfect choreographed move. Amazon's iRobot deal faces EU antitrust. What other bullshit news you want to throw at us? Can't wait until the market gets a hold of that news. I can't believe you can't believe normal people are stupid. Oh, dude, come to Florida. When you have a fucking news article from Seeing Alpha that says Amazon rises as Loop Capital says AWS slowly likely to bottom soon, that goes and tells me two things. If you're trading off of that piece of news, you're a fucking idiot. Second of all, if you look into that statement, it literally tells you soon. Doesn't say now. But they put it out 3 hours ago. I promise you there's somebody that's moving a shitload of calls, like out in time, thinking that this is going to be a bottom, just off a news article. Now, okay, so now we're going to talk about the fact that NASDAQ is barely up a half. Dow is even barely, and we're up 0.2. With all this fucking help, man. Tesla, you're actually, excuse me, Spy, you're dog shit. I promise you. It's just amazing to me how they'll genuinely probably pull this all the way back to where I've been talking. That's what blows my mind. It's like if you're like just a person watching the market, like how do you go and get Tesla to just plummet $4? Excuse me, SPY to plummet $4. I don't know. I'm kind of vibing with Pal today. He's already saying some dumb shit, you know. Arctic saying that Soundhound's going again. Amazon 129. So Amazon gets bad news yesterday. Okay, AMD's pulling back. This is gonna be sold as a bull flag, right? AMD's taking off to the downside underneath its indicators. Palantir looks like it's gonna drop again. Netflix is giving it up. Coinbase did not like that 57 mark at all. I think that would be amazing if this market just collapsed. What are we worried about though, Arctic? We just sold green gains. I don't give a shit if you went and made a half a cent on a quarter of a century. It's still a green trade. If you're making green trades, you're fundamentally not able to fail. Come on, SQs. Say it with your chest, dude. I had to whip it out and put it on Bitcoin's lips, you know. I had to let him know. I had to throw it over the shoulder and tie it in a bow, dude. Wasn't putting up with that shit. Oh, yeah. There's a decent candle. I promise you're gonna come back and get every bit. Bring that ass. Thank you. Look at me. Look at me in my eyes right now. You like. I am the captain now, Spy. Okay. And when I say make it clap, you better drop down and get the eagle on, girl. Because right this moment, I need a big old I need the candle from hell right now. And I don't know if that's just Powell, like I need Powell to just just run his mouth about something, or if it's just gonna be a collective of news. Market's shitting. Let's go. Oh, absolutely. She was at poker last night. Just bought some July 700 EX puts. I like it. I like it, Bird. Amazon is touching my ass. Go ahead, Lucid. Break the bottom again. Look at that shit right there on the SPY. Talk to me nice. Somebody take your tits out right now. Oh shit! Let me get them. Let me get them Chelmets in there. Ever heard of Sheeb? Yeah, I bought some last night. Tesla's just, you know, looking good. Just looking good. Amazon got a downside push. Gave up its 5 MA. No, I didn't. What? Oh yeah, I did. Deadass. I'm like, I wish I was wrong about that, but no, I'm deadass serious. I told you I don't lie about anything on this channel. Birdie is on a nice winning streak. Hey, why don't you come take your shirt off? Come rub some of that luck on me, you know what I mean? I mean, I'm just thinking that's how we greet in America, you know what I mean? We play shirts and skins. It's kind of a very, now you want more? No, you don't want any fucking sheep. You don't want them headaches. You don't want them little scrappy. Tesla broke wick. Come on down. Oh my god, if this fucking play actually runs all the way there, I'm going to literally I don't know. I'm gonna lose it. I was buying these for $3 a piece. Disgusting. Yeah, make sure you like and subscribe with your lips. We're here every single day. Except for the weekends. We tend to go and not try to over-obsess about the market, but we do anyway. By the way, I did want to go and kind of throw a shout out to the new morning show that's going to be up next week, I believe. From 7 to 9 in the morning, I believe that MIA is going to go and be doing kind of like a little news update, things you need to know kind of shit. Yes, timing was quite well for the past weeks. Yes, sir. But I do look at a lot of the things right now in the market to continue to give us plays, and I think that he's going to go and kind of put something together and see what kind of news sticks and what kind of content and stuff like that, and have the ability to just cut that into a smaller time frame and throw it up on the internet. But it is extremely exciting to me knowing that Amazon and Tesla both look really, really good prior to me looking at the RSI. Like I'm all good, but 2 hours RSI is a little high. Oh, that says 17. Word. Oh, okay, that makes more sense. I think we're good here. I think we are good to surpass the like 433.73 to the downside. I think they've done a little bit too much walking, and now they got to do a little mouth work. I know. But I don't think it's turning up. I think it's trying to go and give you the illusion of you making a higher high here. And I think it's probably not going to give you much of a chance to realize it might just go and run right through the bottom right there at the 33.76 area and just run through the bottom or the open candle this morning. They have enough Vaseline? Oh, dude, they buy it. Absolutely. Yeah, they go and get that shit industrial grade and all that type of shit. Yeah. Yeah, I'll have to find a supplier or something. Is Elon actually going to the ring with Zuckerberg? First of all, if either one of those men put their fucking hands on each other, the other one is going to get literally indicted for a fucking hate crime. Both of them are retarded. Like, you have Elon, who is quite literally autistic and on the spectrum, and then you have Mark Zuck, who is just a dipshit, just kind of a weird fucking guy. But somebody's gonna cry foul. Something like, Elon loves the attention. How fuck yeah. But if you're looking at it like, this isn't Brazilian Jiu-Jitsu where we go and roll around and Think about if you are somebody like Mark Zuckerberg's coach. That man is worth billions of dollars. You just, oh yeah, you're so good at what you do. Right up to the point knowing that, like, oh, the guy's got security, he's never going to need to be in a fight. I don't even teach this guy shit. And then realize that, like, you're about to walk into a 180 pound, 6'2", probably 200 pounds, 6'2", 6 whatever the fuck he is. They were talking about it earlier in the chat. But still, like, you are about to go and play with strength that, how do I say that nicely? A lot of people on the spectrum do not know their own strength. So I would be interested to see what happens when Elon goes from like, everything's good, peace, love, all that good shit, Twitter, yeah, to I'm gonna take that man's head off his fucking shoulders. Elon 6'2", 185, Mark 5'6". Stop it. That's 14 inches of reach right there. That's 14 inches, if not more, of wingspan. They probably stand in the ring and yell code at each other. Fuck you, man. I don't know why that's funny. I mean, yeah, it wouldn't even... GTA wouldn't even be close. Like, it would be the equivalent to watching, like, shit, I think that would be just as good. Now, hear me out. I'm gonna get a lot of shit for this, and you can clip this and fucking send it out there. I think Elon Zuckerberg would probably be just as exciting as Francis Ngannou and John Jones. I think the same fucking outcome would happen. At some point, the big one just happens to find a right hand of God. Whether that right hand of God is going up against the face of a very, very soft fucking Facebook employee, that's for you to decide. Zuckerberg been... But listen. There's a difference between rolling with somebody, and there's a difference between getting punched in the fucking face repeatedly for hours. Just to go through a week of decent sparring, those men would both probably crack. Elon would probably get bored with it. And Zuckerberg would probably have to go and read a self-help motivation fucking book to get halfway through his. Right. No, it's not even about... I mean, I do see the correlation there, but I think that everybody should have some form of mixed martial arts background. I think that you should have to have not necessarily for the fighting, but for the discipline. to understand. Like, I think if everybody had a lot more confidence in life and gave two fucks what everybody else thought and worried about their own goddamn self, we would be in a hell of a lot better place as a country and an overall society. Zuck saying the lines. That guy is taking pole, Billy. I know. I'm about to just fucking delete it off my shit. It doesn't make any fucking sense because everything else is pulling back, and it doesn't make any fucking sense why you're getting everything in the market. What is Amazon? Amazon is literally getting bad news into a market that is already getting shit on. So there's no reason to run up. Like it just doesn't make any fucking sense. It really doesn't. Somebody fucking help me here. Jake Paul and Elon Musk would be even worse. No, I think a Oliveira McGregor fight would be good. I think a McGregor Chandler would be super hyped and then one way very quickly. I think a Dana White and the bare knuckle guy would be a good time. Rosie O'Donnell and Whoopi Goldberg. Are those the two names? Yeah, I think. Condoleezza Rice and Maxine Waters would be the fucking main event for sure. If I had a pay-per-view event, no fucking, don't play with me. It would be just. I don't know. I don't know. Some reason that just doesn't seem right, but that's definitely correct. Girth, but not Oliveira. UN Soundhound, Arctic. If that's set up over 4-0, oh, that did too. That's set up beautifully. Stepping up really nicely. Make sure that you get through the 453. I think people think the moves already happened here. I don't. I think I'd beg to differ. I think Arctic's like stayed in this perfect. I know he got this a while ago. I feel like but I saw him talking about it yesterday. Yeah, you're going to be looking at that 453 as a decently important area. If you can get that, you're looking very interesting at a break. You're just looking for this trend to give up. But as soon as it does, I would hammer it to the downside, right back to $4. Yeah, I've been in sound. Oh, good. My old lawyer. What could you possibly want, you demon? SQs pulling back just to have the SPY do this dumbass shit. You need another 200 rejection or what? What's good? Like, confusion right now. What's moving? I'll wait. Oh, right. Google looks like it's trying to bounce here, but watch it if it goes over the 50 here. I don't think so. Go ahead and head and shoulders into a head and shoulders. That's fucking beautiful. You asshole. Don't, like, that's just incredible. Go ahead. Head and shoulders into an hourly head and shoulders. Go ahead and do it. Go ahead and fucking touch me. What? If you're giving up your 50 on an hourly, we actually have been down almost an hour now. You're trying to get that on your 5. And you're about to give up that 5 on daily. 86.50 on Apple. What? Apple's being that guy. Another top 156.7, excuse me, 186.57. 52. I disagree that we are like the first, they're big gaps. SQ's trying to hold 200. I'm trying to understand the trying to figure out why. So those calls aren't going to happen. There's more structure here. 46. They've already got the 26 or the 36s. So this is getting Amazon, Apple. What the fuck is the correlation there? I'm so confused what these two have in common. Keep in mind, if this is a breakout, of the trend, this still has to break back on Apple. Gave it a little support here, but it's still got to come and retouch. Retouching and retesting is going to go out. I just feel like you're getting a little far away from your indicators. Same kind of shit here on Apple. And it's kind of almost unnecessary. It wants to go gap. Which would I go fill first? The tiny gap on NVIDIA at 395.30 or essentially 296. There's a little bit of room to the downside is the point. Is Amazon's full name Amazon Warehouses? No. I think it's literally just fucking Amazon. It's like fucking Prince. Doesn't need a second name. My baloney head. I don't know why that just came into my head. Oh. NVIDIA Palantir is trying to hold 14. Netflix giving up a little bit. Microsoft, NVIDIA trying to go back to the red side. Amazon's up fucking 4%. Now, how can I be so correct about choosing the one stock that would be fucking me right now, going short in it? Doesn't make any sense. I could have gone and played anything else. Why did I choose Amazon? Chose fucking Amazon because Amazon has downside potential. Same way that AMD is. AMD is going to probably go fill that gap. 109. Right there. $4% on Amazon. Dude, suck my dick. Still not good at 27. Probably ends up 2487. Oh yeah. Apple's looking good though. And Tesla's coming back. Sometimes you need I don't know that I know that. GTA, I don't know that I associate. I don't know if our brand goes and associates with feels what you're feeling there. Joe, who's the Douglas PC guy? Tell him I said what's up in there. Hey, Amazon suck ass, bro. There's no shot. Cool, we can buy the calls that we were, or excuse me, the puts that we were picking up earlier. We can buy those for what? Almost 1/3 of what we were purchasing them for earlier. Like, that's a fucking steal if I've ever seen one. I'm out here going to the garage sale, dude. I'm picking up Honus Wagner baseball cards, though. That's a fact, Jack. Get voluptuous. Hashtag blessed. Fucking hate myself. That's fucking funny. Amazon is booty. And Lucid's trying to figure out which way it's going to identify today. AGLE, what's that been looking like, Arctic? I stepped out for, stepped outside. But is that thing still moving? That would be a, what was that, 700% or some stupid shit like that. 600% earlier this morning. It went down from like 12 cents to something lower than that or some shit, and then it went to 80 cents and opened up. That sounds gross. I only got to look at it for a second, but that could be interesting. The other thing that I saw that was interesting is that Mullen apparently is trading like 6 billion shares in pre-market, which I thought was kind of interesting. Very, very interesting market, yes. 432s and 430s are getting inflow. Apparently something's burning down around my house because there are a bunch of sirens headed this way. So I do apologize if you hear those. Good morning, Bree. Sorry we kept you up too late. Selling off all getting that 440. I like it. Yeah, somebody was missing. Aisley, is that your people? Selling off slow bleed. Oh, that's fucking. It's no good, man. I genuinely see it. Oh my god, I would be irate. SPY just went red. Now, if you get all those things that we were just talking about, that were up, and you get those things starting to come to the downside, That could definitely be interesting. Here's the NASDAQ turning back around. Get fucked out, Jones. AMC is down 416. Snow making a move up. DocuSign looking like it's trying to go, but looks like it might have just got double topped. Ford, by the way, got some really good news. Sensonomics is looking good right now for some reason. I don't understand why, and I don't have any information on why. Trying to break 80 cents. I need Apple and Tesla to both just come down quite a bit. Amazon to take a breath. Maybe go spit on somebody else. Still only 2 hours into the market. Amazon is holding strong, but I'm not happy about it. Yeah, Love. Is it Lovesac? Yep. Yeah, this shit's comfortable as hell. There was a lot of institutional or insider buying on ZNTL. I don't really follow pharma, but you might want to look at that. Mars getting pulled. Yeah, so if Microsoft, Nvidia, Amazon, and Apple just kind of turn to the downside here, you could see this market you could definitely see the SPY start to move to the downside if all of those stocks start losing value and the stock is basically all of those stocks all put together, if the main 7 lose value in them, the majority of that index is obviously going to lose value. So you're going to want to look probably to the downside on that index. It's typically how that works. So if we can break VWAP here, we have the indicators basically rejecting us from a price level instead of trying to help us move above them. SQs are basically trying, see how the SQs are coming into their indicators and trying to use them as support. These look like on Tesla, on the SPY, it looks like it might be a little bit of resistance. Sold my bank puts with minutes to go in Europe, all banks deep red today. Made my cash. Let's buy back on tomorrow's rebound. That's what I'm doing, Bird. So if they were deep red in the AEX, that sometimes does go and kind of give you the sentiment of what happens to. It's almost kind of like a future sometimes. If you see the other foreign markets fade at close, you might see others, especially the big markets. And if China decides to start fading like it should, yeah, there's Apple starting to pull back a little bit, but Tesla's trying to move green. But I think Bitcoin might go and spoil the party here, which is a beautiful thing for me anyway. TSM might go and fall through the bottom as well. So yeah, you have TSM, Microsoft, Nvidia, Google, Amazon, Apple, and then overall the NASDAQ that are green. And if those are not going to stay green, I would be very interested with the SPY already red, what the SPY would look like if all those green stocks did get red. Netflix looks like it's trying to come through the 420. GME's trying to get over 24. Looking like it might. If it gets rejected from there, that's very, very bad. Lucid looks like it's trying to go back for that 580. Look at what happened to the banks. JP Morgan. down over 1.5. Western Alliance is down almost 4. Jesus. SPY's trying to stay green. Yeah, I don't see the SPY going and holding it. It's just me. I don't see enough volume even to substantiate the move they've already made. I think whenever Jerome's done with his speech, something's gonna happen.
that strength is maintained and not undercut. In the face of these declining numbers, the Federal Reserve is considering proposals that could further contribute to the decrease in small and mid-sized banks. Chair Powell, as the Fed is considering changes to the current banking regulatory framework, including stricter capital requirements that Vice Chair Barr has advocated for, how is the Federal Reserve evaluating the downstream impact of these on our smaller community banks?
So I think community banks, when we think of community banks, we think 10 billion and under mainly, but in assets. But I don't think under 100 billion. I don't think the proposals that are under consideration are really applying to those banks. So I think that it shouldn't be a factor for smaller institutions, which, as you point out, have been declining in number for 30 years.
So what do we do to support them? From your perspective, what is the Fed doing to support community banks and rural banks, or creating conditions where they can thrive?
So there are these secular forces that are driving interstate banking, and also just population moving out of, you see rural areas that have lost half their population, things like that. So we can't do much about that. The piece of it that we understand that declining numbers of community banks is not a good thing for the country. The country isn't better off for that happening. And so we don't want to be part of the problem. And part of that can just be once fit size regulation, high fixed costs, it will make even small bank, especially small bank models,
Uber's moving.
So we very much try hard to not be part of the problem, and we do, as an institution, very much understand how important community banks are for the economy.
Can you speak to that? Can you tell me what role you believe community banks play that maybe other institutions cannot?
So community banks are in their communities, so they know the community well, and they know the people in the community and the businesses in the community, and
relationship lenders.
It's relationship lending, yeah. It's not. I told a story yesterday, which happened to me. We were moving to Washington, and we had this big bank wanted to make the loan, and they decided not to make the loan at the last minute. I called the local community bank. The loan officer was somebody, they knew my family, they knew the house. He went to my high school. He was much younger, of course, and they made the loan very quickly and they just understood it. It was going to be a great loan. We paid it off long ago. So I understand personally that they're better at doing certain things. The big banks do certain things very well, but they don't do that very well. And for smaller businesses.
Absolutely. And just want your commitment that you'll continue to take a look, whatever type of additional regulating or regulation tools that are kind of perceived to be helpful to maybe some of the bigger issues, that we take a look at how they affect downstream, how they affect small banks, mid-sized banks, and that we make sure that we create conditions where they can flourish.
Yes, you very much have my commitment on that.
Thank you so much.
Thanks, Senator Britton. Rest assured, one of the, best after yesterday, maybe not, but one of the few things that both sides feel strongly and agree on here is that community banks play a major role in our financial system, and all of us support the community banks in our communities and know how important they are. So thank you for your comments. Senator Tester is recognized from his office.
Yeah, thank you, Chairman Brown, and thank you, Chair Powell, for being in front of the committee. I appreciate you. Look, when I talk to Montanans, I hear about what I think everybody in the committee hears about. They hear about inflation, you hear about the high cost of housing, you hear about unaffordable child care, and all these are economic conditions that impact hardworking families and small businesses and communities across my great state. And the examples are clear. Hospitals can't hire nurses. Schools can't hire teachers. And if they can hire them, there's no place to live. And even if they can find a place to live, then finding child care is a problem, and then paying for that child care is a problem too. Unfortunately, we haven't done much about any of those from a congressional standpoint, but I think all these challenges need to be addressed. But I'm talking to the chairman of the Fed. And so when I ask the chairman of the Fed, when we talk about these issues of inflation and housing and child care, I know you guys think about inflation, but do you think about the other things, and do you have tools to address things like housing and child care, or is that simply out of your purview?
We enforce some of the consumer protection laws, and you know, we can have an effect as it relates to fair lending and things like that. But ultimately, the bigger question is just the availability of housing and its availability near where the jobs are. There's not much there's not really nothing that our tools can do. The best thing we can do for those issues is to provide an economy where we have stable prices and maximum employment.
So there's been a lot of talk, and I'm sure there's been a lot of questions asked on this committee about interest rates. And I ask this not to influence you, because I do not believe you should be influenced by political forces. The last thing we would need would be the worst thing that could happen is if the United States Senate is dictating monetary policy. We'll leave that up to the pros like you. But interest rates continued to be an issue. You are fully aware that the debt deal that was struck clawed back unspent COVID dollars. You are familiar that there are some supply chain issues in this country that have impacts on inflation, as I think the COVID money will have some impacts. And there's some other things out there that I know you're looking at. So I'm going to ask you a question that I'm sure you've been asked already, but what's going to be the key determinant as to whether you raise rates or leave them where they're at? Or I don't think dropping them would be appropriate, but what are the things you're looking at to make those kind of decisions?
Well, I would say that if we see the economy performing about as we expect, then 2/3 of the committee really thought it would be appropriate to raise rates a couple of times between now and the end of the year. So what do we expect? We expect continued modest growth. We expect, you know, continued gradual cooling off of the labor market, gradual better alignment of supply and demand, and we expect inflation to be improving. And so if all those things happen, we think we're within a couple of rate hikes of the level we need to get to. We want to get to a level where we're confident that inflation is and will continue to is moving and will continue to move down to 2% over time. That's and not a higher level, that level. And so that's why we've slowed down here, as we think we are getting close to that level.
Okay, so let's think out past that. What factors are you going to look at that would determine a lowering in interest rates then?
So we don't see that happening anytime soon, and the test for that is that we're confident that inflation is moving back down to our 2% goal. We want to have some confidence. So, and I will say in the summary of economic projections that my participants and I filed last week, I think by the end of next year, by the end of 2024, the median participant did have some rate cuts. But that's going to depend on how the economy performs, and inflation has just consistently proven more persistent than we've expected, and that other forecasters have expected. So it's going to have to await a time when we're confident that inflation is moving down to 2%.
So I want to talk about regulation. I know it's been touched on. Katie Britt touched on it a little bit. And I know Michael Barr oversees the Fed's regulation actions. But when we passed 2155, the bill to give reg relief to small banks in particular, there was a sentence in there about tailoring, so that even if you had a community bank, a small community bank, if they had a risky portfolio, you could regulate them to match that risk. And bigger banks, the same thing. Can you tell me what Barr is thinking, or what you're advising him when it comes to, because I think we've all agreed, the chairman just said, we want to protect community banks. They're not the problem out there. In fact, they're the ones that provide access to capital for these communities so they can grow and an economy can happen. Can you tell me what your interaction is with Barr when it comes to regulation, and where you think he's going?
So broadly speaking, when regulations need to be voted on at the Board of Governors, and I'm one of the people who votes, I'm also chair of the committee, so that's the nature of the interaction.
Okay.
In terms of what you're really talking about, regulation for smaller institutions, I would say I think it's important that regulation be appropriate for an institution's size and risks. So it's not a one-size-fits-all approach to regulation, and the largest institutions need the highest capital standards and the most regulation. And as you get down to community banks, the regulation and supervision should reflect their size and risk.
I apologize, Mr. Chairman, for running over. Thank you, Chairman Powell.
Thanks, Senator Tester. Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman, and thank you, Chairman, for being here today. I know several of my Republican colleagues have been asking you about Basel III and the potential for some changes, obviously, in capital requirements. I'm afraid part of what they're trying to do is fix a liquidity crisis at regional banks with a capital fix, which I don't think the two necessarily go hand in hand. In fact, it seems to me, while you've been trying to engineer a soft landing, and now have taken a pause, and I'm certainly not critical of that. I can't fathom why the Fed would want to raise capital requirements when we could be facing what's a credit crunch. And I mean, does that make sense to you that in a potential credit crunch with caused somewhat by higher rates, obviously somewhat by design, that it doesn't make sense to increase capital requirements for banks and individuals?
So I think that's always the trade-off, is higher capital means more stable, stronger banks that can last through bigger crises and things like that. But it's continuum, because that also means slightly less capital being available and higher price of capital. So and the thing with capital requirements is the answer isn't 0 and it's not 100. You've got to find the right place. I would also say that the capital in the form of the what I've been briefed on is a proposal where the big capital increases are really for the largest institutions, and much less so for institutions that are not among particularly the 8 G-SIBs.
But what's the motivation for that? I mean, you've just articulated the challenge, obviously, better than I did. But why the big, for example, the big institutions? What's the situation that would require higher capital requirements?
To your point, we spent many years raising capital and liquidity standards for the largest institutions, and appropriately so. I supported all of that, and I'm glad that I did. I think it's been warranted, and I think that the large banks have competed very successfully with this high capital. And I think further increases are going to be on the table. We always thought there would be some further increase at the end of Basel III globally, but I think it's going to be on the increases are going to need to be justified.
I'm going to get to another question, but you said something a little earlier that I wanted to get to in response to Senator Tester. Is your interaction with each other confined only to public meetings? Is that
not at all?
Okay.
Not at all. No, not at all.
So you try to persuade each other at the water cooler.
I talk to all my colleagues a lot. I'm not one of those people who can just sit in your office all day. I'm popping up and running around. I'm one of those people. So.
I see. Okay. Well, just because in your interaction it sort of sounded like that, and I used to be in a 3-member commission, not that regulated.
We have very regular meetings and conversations. Right through the weekend. We talk frequently.
Okay. Okay. In an earlier exchange with, I think it was Senator Tillis, you talked a little bit about digital economy challenges, and you're considering some changes to reflect, how quickly individuals can move money. And I mean, I think a lot of people would maintain that while you always need to have the foundation to weather the storm, so to speak, such as SVB, you might not even have a storm, but for the fast ability for somebody to spark a run, for example, or to move money quickly. But you didn't elaborate on what kind of changes you might be considering. Do you have some personal thoughts on it, or things that you've been talking about as you're running around talking to each other?
Yes. I'm not the biggest expert on this, but so
that's two of us.
The thing that's clear is that our existing liquidity requirements, they didn't take into contemplation at all the idea that you could have a run this fast. And so things are embedded in the net stable funding ratio and the liquidity coverage ratio that reflect an understanding of how fast a run happens. Mm-hmm. And we now learned that, so that's why I think there is regulatory response is going to be appropriate here, not just supervisory. In addition, you would have thought, and we thought, and by the way, this is every bit the board is every bit as accountable as the San Francisco Fed on this. Sure. That supervision could have been much more forward-leaning on the liquidity issue than it was, and so we're going to address that too.
Yeah, no, great point, because these guys have heard me use my my soccer referee illustration. If you warn the offender over and over and over, but never throw up a card, they just offend worse the next time. So I think that's an obvious finding, and I would concur with you. But the whole issue of the run itself is also problematic, while not maybe directly jurisdictional to any one regulator. As policymakers and regulators together, we should find a better solution. But thank you again for your service and for being here. Thank you, Mr. Chairman.
Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So in 2010, Congress passed Dodd-Frank to make banking regulations tougher and to avoid future bank collapses. And very soon after that, bank CEOs started lobbying for weaker rules. Now, Chair Powell, you also lobbied for weaker rules. When President Trump first nominated you as Fed chair in 2017, you testified, actually in this very room, I think, that you intended to, quote, consider appropriate ways to ease regulatory burdens for the banks. And when I asked you if there were any rules at all, that you thought ought to be made stronger, do you remember what you said?
I think I pointed to the net stable funding ratio.
No, actually, that's not what you said. You said, honestly, Senator, I think they're tough enough. You couldn't point to anything you thought should be tougher. In 2018...
In the event we strengthened the net stable funding
ratio.
Well,
in 2018, you supported Congress's weakening of those rules. You led the Fed in hacking away at one rule after another. According to the Fed's own analysis of the Silicon Valley Bank failure, you weakened the rules in multiple ways. You reduced capital requirements. You weakened liquidity risk management. You skipped out on using enhanced stress testing for banks with tens of billions of dollars in assets and more. And the result was that the second, third, and fourth largest bank failures in U.S. history, which together required $23 billion in bailout money. In fact, you now hold the record. In a single year, the FDIC has been forced to rescue more giant failed banks on your watch than any Fed chair in American history. Chair Powell, do you agree with Vice Chair Barr's conclusion that the Fed bears a big share of the responsibility for the failure of SVB?
I certainly think that our supervision has been shown to have been lax in not being assertive enough. I think that the supervisors saw the right issues but weren't forceful enough in hindsight. And I think that's certainly a fair conclusion.
Okay. So those regulations were weakened. Those supervisors were clearly asleep at the switch for more than 5 years under your watch. And I'll just say it again. This is exactly why I opposed your nomination in 2017. The decisions that you made, the votes that you took, and the things that you said helped caused this mess. And when you were up for reappointment in 2021, I opposed your confirmation because I believed that your continued leadership would be dangerous to our financial system. And the Fed's own report confirms that. So yesterday, Chair Powell, this committee voted on a bill to help hold CEOs accountable when their actions blow up banks. At the Fed, you are the one who lobbied, who drafted, and who voted for weaker rules, and you were ultimately responsible for the team of Fed supervisors who fell down on the job. Do you take responsibility for your role in these bank failures?
So I think we learned some lessons from the bank failures, and the main responsibility I take is to learn the right lessons from this and to undertake to address them so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system. That's not supposed to happen, and we need to take appropriate steps to make sure it doesn't happen again.
So I just want to make sure I understand what you mean when you say you take responsibility. Do you take responsibility for your actions that led to the failures of these banks?
Yeah, I think the question of what happened, supervision was at fault. That's both at the board and at the reserve banks.
And are you ultimately responsible for those supervisors? Are you in charge here?
Under the law, the vice chair for supervision has
Okay, so you
has
take
sole
no
authority.
responsibility on
I didn't say that.
Well, that's what I'm trying to ask. I'm trying to
not what I said.
understand what you take responsibility for.
I take responsibility for addressing the situation appropriately.
That's talking about going
my
forward.
focus. That's my focus. It's going forward.
Yeah, well, that kind of sounds like not taking responsibility for what you've done in the past. You know, a month ago, we had the CEOs of the banks that exploded in here, and each of them had scooped up huge bonuses, and each of them said they plan to keep every penny of that money. And now we have the chair of the Federal Reserve who led the charge to weaken bank regulations, who oversaw the bank supervisors who failed miserably to hold these banks in line. And again, the accountability is zero. Our banking system is broken. $23 billion in bailout money, and there is no accountability for those at the top. And once again, the people who didn't cause the mess are forced to clean it up. We need significant changes here. Mr. Chairman, I yield.
There are two senators that might be online. Senator Sinema is recognized from Arizona if she's online. If not, Senator Warnock from Georgia, if he's online. Okay, we'll close the hearing today. We have come together to discuss how the economy ought to be. I don't believe that to have a strong economy we must trade American jobs for corporate profits, nor do I believe we must sacrifice a safe and resilient banking system for easy money for the biggest banks. We can fight inflation and protect worker gains by investing in growth right here at home and building a more inclusive economy. Thank you for joining us, Chair Powell, today. I look forward to working with you to strengthen our economy. For senators who wish to submit questions, they're due 1 week from today, Thursday, June 29th. For Chair Powell, please submit responses to questions. For the record, 45 days from the day you receive them. Senator Scott has some comments he'd like to make.
Thank you, Mr. Chairman. Just to be quick, one of the comments that I heard during the hearing was that somehow tax cuts led to the challenges that we're facing with our debt. Just wanted to clarify the record that revenue in 2022 was $4.9 trillion, more than 30% higher than 2017 revenue of $3.32 trillion. One of the things we should just recognize as a clear fact is that if your revenue goes up, and that's what happened after the TCJA in 2018 and 2019, we had an increase in revenue, not a decrease in revenue. Unfortunately, we had an increase in spending that exceeded the increase in revenue. So if you spend more money than you take in, you still end up with a deficit.
Thank you. And of course, Senator Scott recognizes that we had a pandemic. The committee is adjourned.
In China, it's a little bit more of a difficult market. Culturally, they don't eat as many hamburgers, so having a local franchisee helps in terms of determining what's on the menu, what's the best way to operate, navigating some of the regulatory things and cultural things that make it so different from McDonald's in the US.
Every business is under greater scrutiny than any time before. And social media allows that to happen, and also public expectations of how big companies behave are heightened, and that's fair enough.
China is McDonald's second largest market by store count, behind the US. So how did the Illinois-based burger joint find success in a country known for its love of pork? McDonald's first restaurant opened in China in Shenzhen in 1990, but it wasn't until 2 years later when the chain moved into Beijing, opening what at the time was the world's largest McDonald's in the globe's most populous nation. The restaurant had 700 seats, 29 cash registers, and served 40,000 customers on opening day.
The novelty and the newness was something that immediately gravitated a lot of consumer interest in China, and people in the early days queued up and lined up to partake in what was in essence, a slice of American culture, albeit in a hamburger.
And it was quickly expanding into other locations too. In 1994, McDonald's opened its 20th restaurant, 80 miles east of the capital, Beijing. In 2010, it announced plans to double its footprint to 2,000. Building out its supply chain and adapting to the Chinese market were key to its early success. Despite those investments, McDonald's was still playing catch-up with rivals. KFC, China's first Western fast food restaurant, opened in 1987. Pizza Hut launched in 1990. KFC had over 8,100 restaurants in China, compared with Pizza Hut that operated over 2,500 restaurants, and McDonald's China with 4,642 stores.
The reason that Yum is larger, the reason that KFC is larger in China versus McDonald's is really twofold. The first is that Yum owned the distribution business in China, so it just allowed them to access smaller cities first and get that first mover advantage. And the second piece is that chicken, as a part of KFC, is just naturally more appealing in China, where chicken is larger protein than beef.
As the company continued to grow out its operation, it faced other hurdles as well. In 2014, McDonald's, along with KFC parent Yum brand, faced concern over food quality after a reporter secretly filmed workers picking up meat off the floor of a local supplier. McDonald's China business reported a decline in sales that year.
One bad branch with a bad food supply, or just a CCTV expose showing a dirty kitchen, right, that can matter.
The chain also faced rising competition from local rivals. China has about 2.6 million fast food restaurants.
And they're actually competing against these noodle stands that will sell a hot bowl of noodles for a fraction of what it costs for a McDonald's, meal.
The fast food industry in China is worth $184 billion.
Yeah, I think the big problem for McDonald's is whether or not they were committed to using their own balance sheet to building out a market the size of China. Real estate costs and site acquisition costs in China are considerably larger than they are in the United States.
Embracing its franchise model with an eye towards slashing operating costs, McDonald's sold its China business for a little over $2 billion in 2017 to Chinese state-owned enterprise CITIC and U.S. private equity firm Carlyle Group. As part of the agreement, the burger chain's partners would be responsible for providing capital for the business, including pricey real estate, and McDonald's would receive royalties based on sales as well as fees for opening a new restaurant. McDonald's retained a 20% stake in the business, CITIC owned 52%, and the Carlyle Group had a 28% stake.
Certainly the long-term opportunity for growth in China was not something that was under review, but the fact that just the volatility of owning China and just the challenging planning that came around that was really the key reason why McDonald's chose to refranchise that market back in 2017.
Having a state-owned entity as a partner really conveys a lot of benefits to McDonald's in terms of site allocation, but they know that they can't play the real estate game in China in the same way they can play it in the United States.
McDonald's has more than 4,500 restaurants in China and Hong Kong, compared with over 13,000 in the U.S. Beyond the number of stores, one key difference between its U.S. operations versus its China business is the ability to own real estate.
They are, in essence, a real estate company, and they're one of the largest holders of commercial real estate in the United States when you collectively add it all up. You can't do this in China because, again, you can't own land 100%. You're only entitled to the land if you purchase it for 100 years, and that reverts back to the government.
McDonald's CEO Chris Kempczinski on its most recent earnings call even said that, while some might think that they sell burgers and fries, what they really sell is the business, the brand to franchisees because they're in charge of the rent. So they're effectively a landlord. But outside of the US, when they don't have the ability to hold on to that model, it really changes things and they become more like a traditional franchisor in that respect.
Today, McDonald's China business makes up a small portion of revenue for the parent company. More than 38% of McDonald's revenue came from the US in 2021, followed by Germany, the UK, and France. The entire Asia-Pacific region made up just 10% of McDonald's revenue in 2021. McDonald's does not break out revenue for every country.
I mean, part of the way we structure ourselves is we always have local management run the local countries, and I think that helps just localize us as a brand, because rather than just being seen as a dominant global behemoth, we just want to be the local McDonald's. We want to be the French McDonald's, or we want to be the Chinese McDonald's, or the US McDonald's.
The company structures its overseas business into two categories: an international operated market, which includes Australia, France, and Germany that it owns and operates, and an international developmental licensee market that includes China, where it licenses out its ability to own and operate stores. McDonald's same-store sales in its international developmental licensee market increased 16% in 2022 from the year prior, compared with the U.S. same-store sales that saw an uptick of just 5.9%. McDonald's stock price has continued to climb, reaching $266 per share in February 2023. With a population of 1.4 billion and about 100 urban areas with over 1 million people, the Chinese market is a massive opportunity for McDonald's owners. While Beijing, Shanghai, and Guangdong account for about 45% of fast food industry revenue in China, much of the rest of the country remains untapped.
Most of their stores in what we call first-tier cities along the eastern seaboard of China and the large industrial cities like Shanghai and Beijing and Guangzhou. But now they see opportunity in secondary and tertiary cities, which means there's a lot of runway for growth for McDonald's ahead of them.
But despite China's zero COVID policy that resulted in some temporary closures, McDonald's has continued to expand, opening over 700 new restaurants in China in 2022, an all-time high. The company also has plans to open an additional 900 stores in 2023. In other words, the burger giant is planning to open a new McDonald's in China about every 10 hours in 2023. And perhaps more importantly, it has leaned into digital delivery and adapted its menu.
But the other thing that's most striking about McDonald's in China is the amount of technology that resides in the store. So almost universally, when you go into a McDonald's, you don't step up to a line and wait to talk to the person at the register to place your order. You walk to a giant electronic kiosk and you enter all of your order electronically.
Making adjustments to cater to the tastes of Chinese consumers in terms of the menu options has been an important development, but also the manner in which they portray themselves through either communications or advertising.
In 2007, with a fleet of over 300 motorcycles, McDonald's launched its delivery service in Shanghai. Today, in China, delivery and digital payments, as in paying with your smartphone, are the norm. Almost 90% of transactions in China are digital, compared with about 25% in the US.
McDonald's can actually learn things in the China market and then at some point, sort of have those things migrated back to the United States and serving the United States market. It's a very wise move strategically on the part of McDonald's to get complete digital integration, which also gives them a treasure trove of data.
And it has an opportunity in China's burgeoning coffee market too, with plans to launch 1,000 new McCafes across China by the end of 2023. McCafes operate both as standalone stores and within existing restaurants and offer fresh ground coffee from around the world, as well as hot snacks. Starbucks has over 6,000 stores and plans to reach 9,000 by 2025. Chinese coffee consumption in the traditionally tea-loving nation is only about 9 cups a year, but growing. By contrast, in the US, more than half of 18 to 24-year-olds have had a cup of coffee in the past 24 hours.
That they've had successful McCafe operations in the United States, and transporting that to China makes a lot of sense. because people will use their dining rooms as a place to socialize, over a cup of coffee.
Something that McDonald's pursues is, given the high margin nature of coffee offerings, as well as the fact that these beverages do skew to breakfast, so you get more of a day part balance as well.
Another advantage for McDonald's business in China versus its U.S. counterpart is the availability of a large pool of labor.
The United States is very mature at this point, highly saturated with competition. And so if there is a marketplace that still has opportunity and also utilizing this sort of capital light model, and then China makes a lot of sense.
The 2% inflation target is key to the Fed's vision for stable prices in the U.S. economy, as well as the rest of the world.
2% Bank of England inflation target.
But who decided 2% was the magic number?
It is, I think, an error to say 2% is somehow magically the right number.
You would think somewhere in the Bible, and God says he wants 2% inflation.
The 2% inflation target, it's relatively arbitrary.
It was invented, oddly, in New Zealand.
25, 30 other central banks adopted the New Zealand approach, so we led the way in inflation targeting. I mean, there's a bit of a mafia amongst central bankers. Once you're in the family, you're in the family sort of things. And they all get together, sit around conference tables.
Turns out the 2% inflation target didn't exactly start that way.
It's sort of a historical accident.
Somehow it just became 2%. 2%'s good.
Yeah, they missed out the 0 2. They thought it was 0 to 2.
Here's how economies across the globe adopted inflation targeting, how they settled on 2%, and whether or not that target may change. The Federal Reserve uses monetary policies to achieve its dual mandate: maximum employment and price stability. Price stability can be achieved with inflation targeting, which is
just the simple idea that the way a central bank should run its policy is to choose an explicit numerical target for inflation.
The Federal Reserve didn't have an official inflation target until 2012, which happened to be right after the Federal Open Market Committee contrarian of the time, Tom Hoenig, left his position.
I was president of the Federal Reserve Bank of Kansas City from 1991 to 2011. During the period that I was there, it followed the great inflation. That period was really quite chaotic, if you will.
And too many dollars start chasing too few goods. The result, inflation.
In the late 80s, an individual from the Bank of New Zealand came to the United States.
That individual is Arthur Grimes. He is pretty much the father of inflation targeting.
In the 70s and 80s, New Zealand had one of the highest inflation rates in the Western world.
Grimes was fresh out of the London School of Economics.
Yeah, and I applied these new insights into designing a brand new central bank act. It was a wonderful opportunity for a really freshly minted PhD economist. I had worked at the bank for 6 years before I did my PhD, so I knew the central bank well.
So the bank was shifting to be more independent because in New Zealand at the time, its central bank was tied to the government.
We were saying, well, okay, if we have independence, what should we target? Interest rates or the money supply? One day I said, well, actually, what are we trying to achieve? We're trying to achieve price stability. Why don't we just have an inflation target? It was sort of like cut through the middleman.
And thus, inflation targeting was born, not as a strict 2%, but instead as a range.
But we really wanted to embed our credibility by achieving a target that no one believed we would achieve. So we made the target pretty tight, just 1% plus or minus 1%, which became just the 0 to 2. And I have to tell you, even around the table at the central bank, we didn't believe it. The idea of achieving 1% inflation was none of us had experienced in our adult lifetimes, pretty much. And we got there. In fact, we got there a year earlier than we said we would. From then on, people started saying, actually, they do mean business.
Like most things, instead of going to 0, everyone became satisfied with 2%, and that became the target first in Europe and then eventually adopted by the European Central Bank.
Like inflation targeting became very fashionable in the late 1990s, early 2000s.
Targeting 2% keeps consumer expectations anchored. So if people can reliably expect inflation to be at or around 2%, the target can steady, aka anchor, the market.
By international standards, New Zealanders live well.
Other central banks started adopting it before we got the unemployment down.
But economic disaster will surely arrive.
The policy did lead to records of unemployment in New Zealand.
It took a few years before unemployment came back down to normal levels and inflation stayed low. I actually left the Reserve Bank in 1993, thinking that, okay, now we've solved all the problems of monetary policy. Clearly, I've turned out to be a little too optimistic on that front in recent years.
And this was before the U.S. had an explicit target.
In the 1990s,
Chairman Greenspan.
That was still the Greenspan era when they wouldn't say a number.
And have not other countries had successful results in lowering rates of inflation as well as our country?
It's too soon to tell, Mr. Chairman.
But, it sure looked like every time inflation went above 2%, they would raise interest rates to reduce it. And every time it went below 2%, they'd go the other way.
After the Great Recession,
Fed Chairman Ben Bernanke's historic move tying Fed funds to a specific unemployment rate along with an inflation target.
The FOMC declared its target of a 2% inflation rate in 2012.
Really historic target set by the Federal Reserve, something very specific that people have been screaming for.
Some economists argue that the inflation target should be less than 2%, like Honig, formerly of the Kansas City Fed. He thinks there should be no target at all. Instead, inflation of 0%.
And in the long run, that's the best for the economy.
I think it's more credible to have a lower target. It's perfectly fine to fall below 2%.
Closer to 0, I think you would be well served.
If you go back into the literature, Milton Friedman was actually arguing for an inflation rate of about -2 or -3% as being the optimal inflation rate. But I think that's probably a bit too severe. Roughly, or 1% deflation is not problematic in my view, because it's just reflecting the reality that a lot of prices are falling.
That people are afraid of deflation. The fact of the matter is, people become afraid of deflation because of the Great Depression. It's become almost stereotyped. They don't understand that it wasn't modest deflation. It was very serious deflation.
As deflation, it is just as dangerous as inflation.
Deflation is when there is sustained downward movement of prices for goods and services. So, for example, it would make it harder for companies and households to pay debts off.
Following the Great Depression, we had the Keynesian Revolution, where you had more government deficits, more government spending, and therefore a stronger likelihood of increasing inflation, and people were used to it. So that's how we've kind of evolved into accepting inflation. You associate inflation with mild inflation, not the hyperinflation we had in the late 1970s.
Economists that argue for 2% or lower targets often point to how aiming for anything higher may lead to higher and higher inflation.
What are you going to get when you get to 3%? What's it going to do to asset values?
Or if they're prepared to tolerate 4, they'll be prepared to tolerate 7 or whatever. And inflation expectations rapidly become destabilized with a higher target.
When you start inflating, you actually invite asset bubbles, and that is a very dangerous road for any country to take, especially a country that is the world's reserve currency.
Why does the central bank want to use its policies to increase the cost of living for ordinary citizens? It's just bananas.
But there's no evidence that 3 or 4% inflation, does substantial damage relative to 2% inflation.
In 2017, some economists wrote a letter to the FOMC making the case for a higher target.
Are we still thinking that we could up it to this 3 or 4% inflation rate?
Signed that letter back in 2017. And so our thought process was we should enter the next recession where we might have to push interest rates all the way back to zero again with a higher rate of inflation.
Economist Lawrence Ball was also one of those signatures on the letter.
The double-digit inflation of the 1970s, Paul Volcker and the Federal Reserve conquered inflation. What people forget is that after the Volcker disinflation, inflation leveled off at about 4% in the late 1980s. And at that point, Paul Volcker was willing to declare victory, and inflation sort of went away as a major concern or political issue.
Here's the Fed's reasoning for aiming for positive inflation at all. Reason 1. A positive number makes it easier to measure inflation.
We want to make sure measurement error doesn't push us all the way down into negative. Slightly higher rate of kind of baseline inflation is good for the economy, and that it can sort of grease the wheels of lots of adjustments that need to happen.
Reason 2. Aiming for inflation lowers the risk of deflation.
Is like a really extended bad recession. And so it collapses back to the case that we should have as many tools as possible to get us out of really steep, long recessions.
Which brings us to 3. It gives the Fed room to cut interest rates if there's an economic downturn.
Interest rate that matters is what's called the real interest rate. It's like the interest rate that's posted, and then you minus off inflation from that to get the real interest rate. If inflation is very low, then interest rates actually can't get all that low. Like even if the Fed puts the interest rate at 0, if inflation's only 2%, you can only get to negative 2% on interest rates. But if you need an even lower interest rate to push the economy back to full employment to end the recession, you're stuck.
Up until 2008, the Fed had developed a pretty effective way of dealing with recessions. The Fed would start cutting interest rates, and that would stimulate consumption and investment and spending. And in 2008, there was still a recession, should have cut interest rates more, but then interest rates were already 0. And you can't have negative interest rates simply because people are not going to lend money.
The 2017 letter points to how the Fed's policy rate remained at 0 for several years, and there was no acceleration of demand growth.
It's hard to imagine now, given that we've had a genuine problem of too high inflation for a while. The problem from like 2009 to 2019, basically, was that the Federal Reserve had declared it had a 2% inflation target, but it consistently was missing it on the low side. Inflation was just not coming in at 2% over a long period of time. And I thought, and I think other people in the letter agreed, that was a problem.
The letter also argues there was a lack of evidence that moderately higher inflation would harm Americans' standard of living. Instead, the letter notes tremendous evidence that a tighter labor market would improve standards of living.
Inflation basically helps people climb out of debt a little faster, especially the occasional unexpected burst of inflation is a real boon to people who have a lot of debt.
That problem is inflation.
4% inflation was low enough for Paul Volcker. It should be low enough for the rest of us.
Since the pandemic, the Federal Reserve replaced its 2% inflation target with some more flexible language.
It's not inflation targeting, it's average inflation targeting.
Came after 15 Fed listening events.
Most economists agree that the Fed announcing a drastic change to interest rates would be a PR disaster.
I think that at the moment, the Fed has a little bit of a credibility problem. They let inflation get to 9%. If they were to change the target, their credibility problem would only grow. People would say, oh, yeah, changing the goalpost.
If Jerome Powell, said, oh, did I say 2%? Oh, I meant 4%. Oh, sorry, my bad, but it's 4%. That would shake confidence in the Fed.
If we could make the change without that political awkwardness or without losing credibility, I would do it in a heartbeat. I understand the Fed's reluctance.
Fed Chair Jerome Powell has said that the inflation target of 2%, average or not, won't change anytime soon.
I'm think I'm going to retire as an economist with the target still at 2%, but I do think, there's a chance. And there are some pretty influential people in the central banking world who are in favor of a higher target. So I wouldn't rule it out entirely.
Well, I think adopting 2% is a lot better than adopting nothing. than adopting an inflation target. So, I think, it's not ideal in my view, but it's a lot better than not having an inflation target.
Tin, tantalum, tungsten, and gold. All of these minerals are found in our electronics, and in the Democratic Republic of the Congo, which contains an estimated $24 trillion in untapped mineral resources. Yet the DRC remains one of the poorest and most dangerous countries in the world, and mining these four metals can help fund armed conflict in the region.
The mining potential of this country is just beyond imaginable, and yet you have poverty at the highest level.
With the passage of the Dodd-Frank Act in 2010, U.S. companies are required to disclose their use of conflict minerals. This has led to greater awareness and some important reforms. But today, consumers still can't be sure if the minerals in their electronics are fully conflict-free, or if the mines where they originate are dangerous, environmentally destructive, or use child labor.
You can't actually ascertain whether my phone, the capacitor that is powering it, is not from conflict mineral. The whole process is muddled.
That's largely because in the DRC and surrounding countries, hundreds of thousands work in the informal mining sector, toiling away using hand tools in what's known as artisanal and small-scale mines. This type of mining can be hazardous and very difficult to regulate, but it's also one of the few sources of income available to some of the world's poorest men and women.
And on the flip side, you have the international market that has these perfect standards, and consumers as well, and increasingly, they want perfect environmental conditions, gender equality and anti-corruption and this and that. They want the perfect package, but that's not the situation on the ground. That's not even the situation in our own communities.
The largest companies in the world, including Apple, Microsoft, Intel, and Tesla, put out extensive conflict mineral reports every year, usually stating that there is no reason to believe that the minerals that they source help to support armed groups. But corruption and instability at mine sites means that there are never any guarantees. Apple, Intel, and Tesla did not reply to requests for comment, while a Microsoft spokesperson stated, Microsoft remains committed to responsible and ethical sourcing and takes this issue very seriously. The four conflict minerals, tin, tantalum, tungsten, and gold, are used widely in consumer electronics. In a smartphone, for example, tin is used to solder metal components together, while tantalum, which is extracted from the metallic ore coltan, is used in capacitors, which store electrical energy. Tungsten is used in the components that make a phone vibrate, and gold is used in circuit board connectors. Only 2% of the world's tin, tungsten, and gold comes from the DRC and surrounding countries, so mining these minerals doesn't usually help to fund armed conflict. But 67% of the world's tantalum comes from the DRC and Rwanda, and the eastern DRC, where a large percent of these minerals are found, is mired in violence stemming from tensions between the Hutu and Tutsi ethnic groups. After the Second Congo War ended in 2003, a transitional government was unable to contain armed groups who perpetrated violence against civilians, thus giving rise to self-defense militias. Today, rampant poverty, corruption, and institutional chaos continues to drive many Congolese to join one of the over 120 armed groups operating in the eastern DRC.
Before the artisanal miners can access the coltan mine in some places, they have to pay taxes to the armed group because the government is not fair to provide security to them.
Beyond taxation, these groups will fully take over some mines, either extracting the ore themselves or using forced labor, purchasing arms with the proceeds. And beyond the potential for funding conflict, conditions in artisanal mines can be quite dangerous.
I think in the past 4 or 5 years, every year we've had people who've been buried underground. I think the latest was like over 30 people in Kamituga. It is a very dangerous job, both from a security side, from a financial stability side, from a health and safety side.
Such conditions also apply to other minerals found in the DRC, like cobalt, which is surging in demand due to its importance in EV batteries. The majority of the world's cobalt is mined in the relatively safer southern DRC and is not benefiting armed groups. Yet concerns over working conditions and the use of child labor in artisanal cobalt mines remain.
With cobalt and the DRC, if you are a large-scale buyer for the battery supply chain, it is challenging to not buy DRC material because the DRC represents about 3/4 of annual supply globally.
For the last decade or so, African countries, intergovernmental organizations, and companies alike have ramped up efforts to better trace and clean up mineral supply chains.
African states started to work very closely with the OECD around 2010 to make sure that the expectations, the standards, the certification mechanism that was being developed in region would align with and complement the initiatives that were coming out of the international community in terms of expectations of the private sector.
If you're a big company, you're a name brand, you're consumer facing, you can easily spend $1 million on this. And the big brands that we all know, they would spend a lot more.
This has given rise to a web of organizations working to trace and verify supply chains. For example, Apple, Microsoft, Tesla, Intel, Samsung, and hundreds of others are members of the Responsible Minerals Initiative, which maintains a list of smelters and refiners that have undergone an independent audit to ensure that they're sourcing responsibly. In its most recent conflict minerals report, Apple says that it has removed 163 smelters and refiners from its supply chain since 2009, including 12 in 2021. Then there are other organizations actually doing on-the-ground tracing and due diligence at mine sites. ITSCI is the main player in the DRC and surrounding region, working in over 2,000 mines.
A company located downstream in the supply chain, of course, and even a smelter, let's say upstream, located abroad, will not have the capacity to visit all of these mines, to assess the conditions at the sites, to verify information and to collect risks. And this is exactly what the role of ITSCI is.
ITSCI trains government agents to tag and seal bags that come from registered mines. But no system is foolproof, and if agents are corrupt, they might accept minerals from outside, unregistered mines and tag them anyway.
Agents were actually selling the tags to other mines. And even when the system was working, those minerals were melted with the minerals from other mines from which we don't know where it was coming from.
Ultimately, it's just really hard to stop bad actors in the system. But experts say the answer is not boycotting minerals from the DRC or from artisanal and small-scale mines overall.
Recognizing the importance of artisanal mining and decriminalizing and legitimating that work. I mean, if we recognize, for example, that artisanal mining is the most important rural, non-farming activity employing tens of millions throughout Africa, generally 30 to 40% of which are women, making sure that we're decriminalizing that and recognizing as legitimate is the first step to supporting them.
Disengagement, Lebert says, would just lead to greater poverty and thus more instability in the region overall, making it even harder for mines to meet international standards, something many companies also recognize. In Tesla's most recent conflict minerals report, they state, As recommended by the OECD, we do not support an embargo, implicit or explicit, of any DRC material, but instead allow sourcing from the region when it can be done in a responsible manner through audited value chains. Overall, though, Lebert says that individual companies need to be doing more to monitor risks on an ongoing basis and independently verify what third-party auditors and tracing schemes are telling them.
The trend has been an over-reliance on industry scheme because, companies, for the most part, want it to be as easy and as simple as possible. They want to outsource the due diligence to somebody else and not worry about it, and for it not to be a headache, but at the same time to protect themselves reputationally.
Though there's much work to be done, many do agree that international standards and corporate efforts have led to gradually improving conditions. But moving forward, getting all countries on the same page when it comes to the ethical sourcing of conflict minerals and cobalt is key.
What's also very important is how much the Chinese companies are going to play by the same rules than Western companies. Because so far, 9 of the 14 biggest companies in the Katanga, where the cobalt is, are Chinese or owned by Chinese. So it really has to be like a worldwide scheme where everyone agrees with the rules.
Unlike the US and the EU, China does not have enforceable due diligence guidelines. And while compulsory standards would certainly add pressure for mines to clean up their act and help cut off the market for unethically sourced minerals, lasting change will likely only come when the DRC itself stabilizes.
The first thing that needs to take place is that the government must create a stable environment. Whether it's going to be by political negotiation or outright military operation, they need to really ensure that the activities of the armed group is brought to the barest minimum.
But that won't happen overnight.
Ultimately, the conditions that we see on the ground or the human rights issues that are of concern to us all are very much linked to governance, poverty, and we need to get at these more systemic issues if you want to see lasting changes in supply chains, not just de-risking in the short or medium term for a company's benefit.
There are many problems in the modern housing market, but the biggest one for Americans tends to be the price.
Prices rose 40% from the start of the pandemic.
In the final quarter of 2022, the typical U.S. home sold for a record-shattering $468,000. That's unaffordable for most Americans, leaving them to rent.
The housing costs are completely out of line with wages.
Some members of Congress believe Wall Street is a part of the problem.
What's outrageous is your tax dollars are helping Wall Street buy up single-family homes. You're subsidizing Wall Street.
Massive private equity firms like Blackstone and Pradium Partners have backed a relatively new breed of homeowner, the corporation. This growing industry buys or builds single-family homes and then rents them out.
We hear from community organizers that are door knocking in certain neighborhoods and are just surprised by how many of the homes on a particular block will be owned by a corporate landlord.
Industry advocates say corporate landlords play a critical role in addressing the nationwide housing crisis.
What we have in housing in the United States is a chronic shortage since the financial crisis.
And so the question really is, how do we fill that gap? Is the answer incentivizing new housing development, new housing investment, new market participation?
What's behind the rise of corporate landlords? And how, if at all, will the government regulate them? As of 2023, corporate landlords only command a small portion of the rental housing in this country. The vast majority of all rental units, including apartments, are owned by individual, small-time investors. But there's growing focus on single-family homes.
Institutions, large companies, only account for about 1% of all the rental housing in the United States and only about 2% of the single-family rental housing.
There's a small but mighty group of companies that lead the industry.
So Pretium is the parent company for a company called Progress Residential that owns about 90,000 homes. They were started by Don Mullen, who came out of Goldman Sachs' mortgage group. Invitation Homes was started by Blackstone, but Blackstone sold their position a long time ago. They own about 80,000 homes. American Homes for Rent, which was started by Wayne Hughes, they own about 60,000 homes. There's a company called Tricon Residential that's out of Canada. And then there's one called Amherst. Those are the big five.
In recent years, corporate landlords have been most active in the Sun Belt. In 2021, corporations bought 28% of all the homes sold in Texas. That figure was 19% in Georgia and 16% in Florida. Companies like Pradium and Blackstone target these markets. Blackstone in particular has held large stakes in several companies that dominate the region. Rent hikes for single-family homes in this region have outpaced other parts of the country. Since the onset of the pandemic, rents for a two-bed detached home increased about 43% in Phoenix. They're up 44% in Tampa and 35% in Atlanta. That's compared to 24% nationwide. Experts say that many of the properties bought up by institutional groups were previously owned by people who were destabilized in recent recessions.
After the pandemic, people saw the opportunity to go into these lower income neighborhoods, working class neighborhoods, buy up these houses and in communities that the working class can afford. And they're holding these houses, often for years, taking them off the market, making it even harder for young people and working class families to own a house.
Companies like Blackstone make serious money from these investments. For example, the company's Real Estate Income Trust delivered an 8.4% return on investment in 2022. This in a year when the wider stock market declined nearly 20%.
Part of the problem with private equity involved in housing is that they're in it for the short term. Their goal is to take a company, increase cash flow in order then to sell it or to take it public, which they did in the case of Invitation Homes. Unlike, maybe smaller landlords who still are looking to have a profit, may be in it more for the long term and see it as a long-term investment, are more concerned in terms of stability and concerned in terms of satisfied tenants and wanting there to be less turnover. With private equity, it's really about kind of maximizing the short-term returns.
In particular, real estate funds issued by private equity groups can be a useful hedge against inflation, boosting their popularity. Analysts write that by 2030, institutions may own 7.6 million single-family rental homes. That could be more than 40% of the market. But that's a big if. Many real estate experts say the main solution to the problematic housing market is to build fast.
In the late 70s, early 80s, the United States routinely generated between 300,000 and 400,000 starter homes a year. In 2020, we generated 65,000. So we have a situation now where we're trying to catch up, but we haven't quite gotten there.
15 years ago, lots of homes were coming onto the market. As Wall Street's risky lending led to a crash in the late 2000s, scores of people lost their homes. Roughly 8 million mortgages went into foreclosure between 2007 and 2016. Institutional investors stepped in, buying up homes that were on sale.
A lot bigger investors started to get into the rental game. They started buying up thousands of these distressed properties. And actually, they really helped to put a floor on home prices because home prices were crashing so hard.
There was a decision to subsidize some of these private equity firms to go into the housing market. You could argue that that was needed because the market had been so suppressed.
This crash led to the birth of the single-family rental industry.
So I had a friend of mine who was very well connected. He took me all around Washington, D.C., and I just shared what was going on. And then out of that, I met with somebody at HUD whose idea was like, why are we going to foreclose on all these people and try and create huge losses for HUD, the Housing and Urban Development, and then provide all sorts of rental assistance to these people who are going to need it? Why don't we just basically keep them in the house, restructure it, maybe say, okay, you're a renter now, not a homeowner, but cause a far less distress.
You started to see the emergence of professional management in the single-family rental home space.
I mean, it was needed maybe for a couple years, not for a decade, where it's lining the pockets of people now on Wall Street.
Still, many people say that the institutional investors are providing a quality product to relatively high-income individuals.
They figured out pretty early on, like, it's pretty hard to be profitable when you're focusing on people who are missing payments all the time and living in 70-year-old homes that need a lot of CapEx. So the Wall Street group has focused on newer homes and higher paying, higher income tenants who are more discretionary renters, not out of necessity, because that's been a better profit model for them.
Other experts point out that given the supply constraints, there aren't many other options for people on the market.
It's almost a captive market, particularly in terms of with single-family rentals. They've been very explicit about how people are shut out of the home buying market and are going to be perpetual renters.
Renting or buying your home is one of the most consequential financial decisions an individual will make.
Home ownership is the main way in this country that people build wealth. And while in some ways it may not look very different whether somebody's renting or owning a home, financially it's very significant both for that individual family and for communities whether or not they do own the home.
That said,
not everyone wants to be a homeowner. They want to be able to rent for a little while, potentially move within that neighborhood, or move to another state. Moving and flexibility has become a premium to most consumers, so renting is not considered less than buying. It's actually favored by a lot more consumers.
Some of this can be observed in this chart. It shows the so-called home ownership premium. The time periods depicted in blue show when renting would be a better deal. That includes most of 2021. In the periods marked red, owning was a better deal. That includes many of the years following the Great Recession. The changes in the home ownership premium are driven by home prices and mortgage rates.
Usually the cost to be an owner are a couple $100s a month higher. And especially if you start throwing in maintenance and other things, it's even higher than that.
Lots of potential buyers may be waiting for a wider correction in the housing market.
Over the last 40 years, the housing cost for the typical home in America compared to the income of the typical home buyer has been running 29 to 30%, whether you look at the median or the average. It has blown out to 42% right now. We have a pretty significant home price decline forecast coming.
I've seen anything from really not falling at all this year to dropping back 10, 15%. Now, the thing that is different this time around than during the Great Recession is that supply and demand issue. There's still not enough supply, and that's going to keep prices inflated.
Some experts believe the best way out of this problem is not to limit corporate landlords, but rather to do whatever it takes to build more housing.
Some of these big REITs, these landlords, are actually building homes. They're adding to the supply that we desperately needed.
Experts believe this trend could help, but it needs far more time to prove its value.
We can only find 909 actively selling build-to-rent communities, about 10% of the rental home construction in the country right now, but 26% of renters rent a single-family home, so it's not even keeping up with the pace of rental demand for single-family versus apartment.
Some members of Congress believe limiting corporate activity in the housing sector is a good first step.
Wall Street is going to buy up a single-family home, and it's vacant for a couple of years. We're going to tax it, forcing these firms to sell that back into the market. What we're saying is don't have private equity buying up single-family homes. That's going to mean there are more single-family homes on the market.
With a split Congress, it would take significant bipartisan efforts to pass.
There are some bills in Congress which want to limit the amount of homes that investors can own, and they're unlikely to get through because they're pretty drastic. They're telling investors that they're going to have to only be able to own, in one sense, 100 homes, or they're going to have to pay significant taxes on the others. Now, these institutional investors own thousands of homes.
In a statement, Blackstone told CNBC that every home they own could go to a resident who hopes to buy the home later.
I mean, we think, frankly, that they just own too many, particularly in terms of the single-family home industry. I think there are ways, such as implementing additional taxes on them, that would either generate money for affordable housing or encourage them to sell off from their portfolio. We do support rent control, just cause eviction, different conditions in terms of to ensure the habitability of a property.
On the ground, a litany of states have tried to provide direct relief to tenants through policies like rent control. Groups backed by Blackstone have fought back hard. In 2018, the company spent about $7 million to oppose rent control for single-family homes in California, according to researchers at University of California at Berkeley. In a statement to CNBC, a Blackstone spokesperson said the proposition would have exacerbated the state's housing crisis. At the same time, the private equity group has not made meaningful investments in building new single-family homes.
There's going to be a bit of distress there, but long-term, this is the first inning.
Traffic. After receding for years during the global pandemic, it is returning to cities, small and large, around the United States. Debates over what to do about it never ended. The average American driver lost 51 hours and $869 in valued time by sitting in traffic in 2022. In 2019, before the pandemic, it cost the average American nearly 100 hours and nearly $1,400. Proposed solutions often include widening roads, adding public transit, building denser cities, and charging people to drive at certain times. That last is currently on the table in places such as New York, and it has met with fierce opposition from both sides of the political spectrum. Despite this, some say congestion pricing is the only way to directly reduce traffic in the long run in crowded, expensive cities like New York, where building just a mile of road or subway track can easily cost billions of dollars. In the long run, widening roads doesn't work.
At some point, it will become expensive enough to pursue these strategies of adding capacity that don't actually address the problem, that I think people will be forced to consider congestion pricing. And in fact, that's what's happening.
In 2011, two economists published this paper, basically providing evidence of something called the fundamental law of highway congestion, a term that was first proposed by economist Anthony Downs in 1962. That law basically says, if you build it, they will come. The Sepulveda Pass stretch of Interstate 405 in Los Angeles is one example. After a $1 billion widening project, a USC-affiliated news group found traffic actually worsened.
If you think about the history of Los Angeles, will be obvious, which is Los Angeles has been adding roads in an effort to combat traffic congestion for generations without much success, right? It turns out that that pattern is not a peculiar one.
Turner and Duranton found that when cities add 1% of lane miles to major roads or highways, they soon see a 1% increase in the total miles driven in the city. They saw that when they looked at road capacity and traffic data in a single city over time, and when they compared cities to each other. They also simulated a randomized controlled trial too impractical to run in real life. Using what Turner calls statistical tricks, the team added a 1% increase in lane miles to a model of half of the cities and metropolitan areas in the US, and not the other. They saw the same 1% vehicle miles traveled increase they found elsewhere. That suggested expanding roads caused people to drive more.
The reason the paper was influential was because it's hard to do, and we were pretty successful at it.
This phenomenon is sometimes called induced demand, and today few dispute it exists. This fundamental law holds that building more transit, building denser, more walkable cities, or adding bike lanes doesn't really solve the problem either, since those things are also subject to induced demand. The solution is simple. Use pricing to divert drivers away from using roads at times when they are busiest and toward times when demand is lower.
This is something that has been done many times in many places in the world, Singapore, for example. It is fantastically effective, right? And that in response to, if it costs a marginal $2 to do your commute at 7:30 instead of 7:15, there are many people who are willing to shift their commute by 15 minutes, by 30 minutes, in order to avoid these sorts of small tolls.
New York's plan to price congestion is a cordon plan, meaning there is a line or cordon that runs from the bottom of Manhattan to 60th Street. Any car entering this zone on the island would have to pay a toll. For cars entering the district during peak hours, the fees could range from $9 to $23, depending on which plan under consideration the city chooses to adopt. Prices would be lower during off-peak hours and overnight. There also would be a 100% tax credit for people who live in Manhattan and who make less than $60,000 per year.
I think New York can get this done, and there'll be a lot of lessons that come out of that will apply to other places. But pricing the system to make sure that people are actually paying for the system that they're using, and then using those funds that goes back into the transportation system that either addresses the challenges for low-income drivers or expands the transit system, and then providing other modes for people to get around.
Over time, added lanes may once again fill up with traffic, but the picture is nuanced.
Just like congestion doesn't have a single cause, there isn't a single solution. And for the most part, we recommend more of everything. In growing regions, especially where there's high population growth and high job growth, we almost have to look at capacity improvements.
Bill Isley works at the Texas Transportation Institute at Texas A&M University. The institute puts out a widely cited annual urban mobility report.
Capacity improvements really do help. Adding lanes sometimes gets a bad rap because people will look out there and they say, well, that road is filled up again. Perhaps you've wasted our money on this. But as we look at that a little bit closer, that traffic that's been generated by the road or that suddenly appears to be created was actually on the transportation system already. They could have been travelers that were on a different route, taking a different mode, or perhaps traveling at a different time of the day.
Traffic can be caused by several factors. It can be temporary or occasional, like when it is caused by a vehicle accident, road construction, or bad weather. Recurring congestion is the congestion drivers encounter during rush hour or on roads that always seem clogged, like this one in Los Angeles, or this one in Atlanta.
It's a supply-demand imbalance. The demand for road travel exceeds the supply of roads, essentially.
But accidents, road construction, bottlenecks, and traffic signals can also worsen that recurring congestion. Addressing those factors can make a difference, at least in the short term.
The debate is, does adding a lane to a freeway work? Well, it depends on what you mean by work. Does it reduce congestion? Pretty much there's agreement that yes, in the short term, at least. Where it differs, though, is in the long term. And that is where things like induced demand come in.
And though public transit, bike lanes, and sidewalks are also subject to induced demand, they still make a difference in the kinds of challenges a city faces.
You could put 500 people into a subway car, right, versus 500 people driving here on K Street, and the magnitude of the impact is completely different. You say the same thing for a bike lane, for example, right? Built a bike lane out here, you have a lot of people using it because there's a lot of demand for that. But the impact of that is not going to be anything that's going to be a major public policy concern like it's going to be when we think about single occupant vehicles or a bunch of trucks that are clogging up the roadways. One issue all these solutions do have in common, they cost money. All of them.
You know, in New York, how much is building an additional rail line? Billions. How much is building an additional freeway? Billions. Building an interstate bridge, that's one of the things in Washington State that connects Portland, Oregon to Washington State. I mean, that's like $4.5 billion. I mean, that's not cheap.
The COVID-19 pandemic kind of messed up everything.
Before 2020, the conversation around traffic was mostly dominated by the topic of congestion. When the pandemic hit, the roads cleared. Safety took the place of congestion as cars sped down empty roads and freeways. Now, traffic is back. INRIX provides transportation data to a broad range of clients. It publishes the widely known Traffic Scorecard, ranking cities around the world. Of American cities, Chicago, Illinois had the worst traffic delays in 2022. The average driver spent 155 hours in traffic. It's the second worst record in the world, just 1 hour less than London's. U.S. cities saw the return of the morning commute in 2022, but some features are totally new.
The trick now is people are leaving perhaps later in the day. We're seeing that there's traffic sort of all day now. There are the peaks, but it's not necessarily always quite as peaky, if you will, in general. It's certainly changed our travel behavior.
Trips to downtown areas increased in 2021, still below 2019 levels. At least some of New York's key real estate sectors continue to underperform relative to pre-pandemic levels. In the fourth quarter of 2022, Manhattan office leases fell 8% from the third quarter and were 25% lower than the 5-year average. Across the US, telecommuting has now become the second most common form of commuting after driving a car. This presents a whole new set of traffic problems. For example, some data show that when people work from home, particularly for longer stretches, they generate more trips than they would if they were making a traditional commute.
Even though you may intuitively think, well, if you're working from home, there you're not commuting, therefore it's better. But it actually is more trips, more frequent, maybe shorter trips, maybe in suburban areas. So how does that all play? I don't think we have a good handle on that yet.
With a $67.2 billion market size and nearly 7% annual growth, the sporting goods industry has become one of the fastest growing industries in the U.S. since 2018.
You've got over 240 million people who are participating in sports and activities in the United States. So it's a big market. And then you've got about 90.5 million who are in the outdoor participation, such as hiking, camping, fishing.
The biggest player, Dick's Sporting Goods, controls an estimated 14.2% of the market share, the most by a single company.
Dick's Sporting Goods has been one of the better retailers at really continuing to evolve with the customer, with the demands of the customer. They always made sure to pick very good real estate that was in prominent locations.
In 2021, Dick's Sporting Goods saw record-setting revenue of $12.3 billion as the company pivoted its distribution strategy during the pandemic. Today, the company looks to sustain that growth as leadership shifts to a new CEO, a focus on technology, and navigating tough competition in the sporting goods e-commerce space. In 1948, Dick Stack, an 18-year-old with just $300 in his pocket, opened his first business. At the time, it was just a simple bait and tackle shop that later expanded to work clothes, sportswear, equipment, camping gear, and picnic supplies. Dick's Sporting Goods' expansion was slow, taking nearly 2 decades for the second storefront to open. But by the 1970s and 80s, business started taking off when Ed Stack, Dick's son, joined and bought the company from his father. In the 90s, the company expanded its offering to include more sports, outdoor equipment, apparel, and footwear. By 1996, there were 50 Dick's Sporting Goods stores.
As hard as it might be to believe today, Adidas wouldn't sell to us, Puma at the time wouldn't sell to us, so we almost went out of business a couple times. In 1987, we almost went out of business with the savings and loan crisis. The bank basically said, we can't lend you any money any longer. We had to find another bank. We almost went out of business again in 1994 when we moved the company from Binghamton to Pittsburgh, and we grew too fast. So in 1987, we almost went out of business. That wasn't our fault. In 1994, we almost went out of business. It was completely all of our fault.
With 141 stores across 25 states, Dick's went public in 2002. At the same time, competitors like Sports Authority emerged as the sporting goods segment grew in popularity as sports participation ballooned in the early 2000s. Its biggest competitor, Sports Authority, had 221 more stores than Dick's and generated more revenue. But Dick's Sporting Goods saw consistent revenue and net income growth as the company grew its reach with more stores. Improving operating margins was vital to the company's sustained success.
Where we started in Binghamton, New York, and then we went to Syracuse, then Rochester, then Albany and Buffalo, and we stayed in these very concentric circles. So our distribution costs were probably less. Our marketing costs we could leverage. Our management costs to get out to see the stores was a lot easier. And those concentric circles, I think, was really a big key to our success in being able to survive when so many others in our industry weren't able to.
Dick's quickly edged out Sports Authority, overtaking the once king of sporting goods retail by 2005. And just a year later, Sports Authority went private after it was acquired by private equity firm Leonard Green & Partners.
Sports Authority and others that have gone out of business through the years, maybe didn't operate as well. They didn't have the real estate in the right places. They didn't have the breadth of assortment to really cover the athlete that was shopping there. And they kind of missed the mark in multiple areas. Dick's has always thought ahead. They've always worked hard to change and be different.
Historically, the sporting goods segment consists of many small players, typically owner-operated stores. Those stores account for over 64% of the market share, each tailored to specific needs of their communities. In 2022, Dick's Sporting Goods accounted for 14.2% of the market share, the largest by a single company. That all came from heavy investments in acquisitions, innovation, and technology. The company went on a spending spree from 2004 to 2007. It acquired Galen's Trading Company, Golf Galaxy, and Chick Sporting Goods, boosting the company's footprint from over 230 stores to nearly 500 in 2008. In the consecutive decade from 2008 to 2014, revenue jumped 65%. While Dick's Sporting Goods was expanding, its once biggest rival Sports Authority was on the verge of collapse. After exchanging hands 3 times from 1990 to 2005, Sports Authority struggled to find its footing. The company began selling its assets off to former competitors, primarily Dick's, in 2016. Sports Authority's once massive footprint had allowed the brand to accumulate an enormous customer database. When Dick's purchased Sports Authority's IP in 2016, the company got access to 28.5 million Sports Authority's loyalty program members and an estimated 114 customer files, including emails, addresses, and transaction history data.
I think that was a pretty shrewd move. They got data to all their customers, and they were able to market to them through the Dick's loyalty program. They also captured some of the private brands that were popular at Sports Authority. And I do believe that Dick's has done a very good job to sort of bring that into their own portfolio and to use that to help them to grow, certainly to capture some percentage of that consumer, but also just then to expand the market from that level.
A lot of people don't realize that our first e-commerce sale was in 1999, but we have always made technology investments, whether it was from the e-com standpoint, and in 2017 we made significant investments from a technology standpoint, from a system standpoint, from an e-commerce standpoint.
In 2018, a vital inflection point in the company's evolution came amid an immense tragedy. After the Parkland shooting where 17 students and faculty members lost their lives, the company took a stand on guns. It had been selling guns for seemingly its entire history, and capturing a sizable chunk of its annual revenue. Then CEO Ed Stack initiated an internal review of their long-standing gun sales business. In 2018, the company announced it would stop selling assault-style guns, high-capacity magazines, and firearms to anyone under the age of 21. The company announced that it would destroy any unsold inventory. The backlash wasn't inconsequential. The company estimated a $250 million loss.
We found out that the kid who did the shooting in Parkland actually bought a shotgun from us, and we did everything right. We did everything right by the book. And at that point, we said, you know what, the system as it's set up today isn't working. That we knew that was going to have a real negative impact on our business, and it did, but we knew that it was the right thing to do. And as we look back on it today, if we had the chance to do it all over again, we'd do it exactly the same way.
You look at their business numbers, and it hasn't hurt them at all. They've continued to be successful, even though they got out of that segment of the industry.
We took those guns out, and in a number of stores, we did a test and took all firearms out of our store and reallocated that square footage and products that we put in there, and we found that we did more business at better margins with the other product, and that's why the street didn't have much of an issue with it.
In March 2020, at the height of the pandemic, Dick's Sporting Goods closed all of its stores, as the company was deemed non-essential compared to other businesses. With all of its stores closed, and its high-priced inventory filling shelves where no customers are walking through the doors, Dick's Sporting Goods needed to act fast.
It was a scary time for everybody from a health standpoint and from a business standpoint, what was going to go on. And so our technology group pulled together curbside pickup in 2 days. So we had originally kind of put a roadmap together, thought it could take roughly a year to get done with all the testing and everything that we wanted to do. But necessity is the mother of invention, and we didn't have any time to do that. And the technology group, and Lauren pushed on this very hard, that they pulled together the technology, and we had this up and running in 2 days.
Curbside pickup allowed customers to place their orders online, drive to the store, and have contactless pickup, circumventing the need to go into stores, allowing Dick's Sporting Goods to offload its massive inventory at a time where shopping in stores wasn't safe. E-commerce was another example of a major lifeline for the company. Just a few years prior in 2017, as major rival Sports Authorities went bankrupt and in-store sales were slumping, the company saw a clear shift in the industry. Dick's invested heavily in e-commerce and technology, and it revitalized its site. That decision proved beneficial when the pandemic broke out. In 2020, e-commerce sales reached $2.8 billion, a 100% increase from 2019. Nearly 70% of online orders were fulfilled directly by stores through curbside orders.
So over the past 5 years, Dick's has gotten much better and more efficient as an operator. They have done a very good job embracing e-commerce and all the work that you need to do to make e-commerce and omni-channel a very fluid and efficient process for the consumer, such that you know when the inventory is in stock in a store, when it can be picked up, when it should be shipped, where it should be shipped from. All of those things have made omni-channel retail possible at Dick's Sporting Goods. And they're one of the better ones that have really embraced it and gotten to a point where the profitability of an e-commerce sale is pretty much on par with going to a store.
The momentum continued well into 2021, as the company set new records. Revenue grew nearly 30%, net income nearly tripled, and Wall Street was ecstatic. Share prices shot up to record heights, peaking at $145.19 on October 30th, 2021. The sporting goods market hit nearly $70 billion in 2022, and while the industry has seen robust growth, competition is rising.
We've clearly saw in 2022, and I think we're going to continue to see going forward, that consumers have embraced some of these new sports and some of these new hobbies. And we expect that to continue. We expect the business to normalize back to kind of that low to mid single digit industry growth rate, call it, anywhere 3 to 5% in a given year. And we would expect exporting goods to be able to grow at or above that pace as they continue to capture market share from smaller independent players within the sporting goods space.
In 2022, Dick's partnered with Nike to establish exclusive product launches and campaigns and be the first provider of new products.
The relationships with our brands are really important, and we've got a number of brands that we characterize as strategic partners. And those strategic partners, we work with them from a marketing standpoint, supply chain standpoint, what the product looks like in the store and the amount of space that they get in the store. But we've got a great balance between the brands and our own vertical brands that we have. And those vertical brands have done very well. And the primary brands such as Nike, Callaway, North Face, we continue to invest and grow those brands also.
Competitors in the space like REI are developing larger storefronts, creating one-stop shop superstores to compete with big box stores like Walmart that offer low-cost sporting goods. Over the next few years, analysts suggest the sporting goods industry will tighten.
I think the big thing that we're also trying to figure out is what's the right level of operating profit the company should run at. And, by operating profit, I'm talking EBIT margin or operating profit margin. And I think investors are trying to figure out, should it stay in the low double digit area? Should it go back to low, high single digits, mid single digits? For years prior to the pandemic, they operated at around a 5.5% operating margin. All of a sudden in 2021, they're at a 15% operating margin. So what's the right level? And I think that's where you continue to see a little bit of concern from the consumer. And I think the investor in sporting goods continues to think about what's the normalization path.
Inflation's been something we've all had to deal with, whether it be supply chain costs, costs of everything have gone up. And we've been our team's done a really good job of adjusting to that. We've increased, payroll costs have gone up. We've been very happy to increase our payroll costs, and our businesses continue to be very good.
In Q3 of 2022, net sales increased 7.7% from a year prior, and increased over 50% from 2019, attributing its jump to the company's focus on maintaining its continued strong performance and quality of product lineups, and focus on the company's future, therefore expanding the in-house brands, developing its e-commerce network, and widening the company's margins going forward.
And we know that we have to be thoughtful on how we grow. We have to be thoughtful to make sure that we don't let our business outrun our management team's ability to manage it, our capital structure. We've learned from those mistakes. And one thing we're really good at is we never make the same mistake twice.
You've probably seen headlines about these workplace trends. First, it was the Great Resignation, then quiet quitting. Well, that was 2022, and 2023 has a new buzzy workplace trend.
It's called quiet hiring.
Managers across multiple workplaces are trying out a process called, get this, quiet hiring.
Quiet hiring is really in the news right now. Quiet hiring is one of several trends that we've identified as potentially having a major impact in 2023 for the future of work. And some organizations, it's going to be a game changer. For some organizations, it might be one of our other trends that's more of a priority. It depends on where their biggest challenges are.
There's a difference is how you do it. If you do it the right way, perfect. If you do the wrong way with the wrong intentions, I say quiet hiring is not going to work. It's going to not have the employee engagement the way that you want to.
So with all the economic uncertainty going around, employers are looking at ways to fulfill their needs without actually having to commit to growing their workforce. One way of potentially doing that is what has been called quiet hiring.
Quiet hiring is actually not a new concept. Companies have been using quiet hiring for years now to fill talent gaps. It basically means hiring short-term contractors or reassigning your existing employees to new positions or asking them to take additional responsibilities.
Fundamentally, we don't have enough talent right now. We don't have enough people to do the jobs we need. And even if we are eventually going to be able to hire them, the hiring timelines are very, very long. That's one of the major forces that started shaping quiet hiring.
I think there is a relationship and a trend almost between the Great Resignation, quiet quitting, and now quiet hiring. I'm sure there'll be something quiet down the road. I think it's the evolution of how the workplace is changing and trying to adapt to the post-pandemic world.
Tech companies like Google, Amazon, and Microsoft have been laying off tens of thousands of workers. The larger economy, however, remains relatively strong. Demand for workers is high and unemployment is low. Many economists still think a recession could happen in 2023, and companies are turning to quiet hiring as a way to trim costs ahead of a potential economic downturn.
So the way this trend works in relation to the broader economy is that it is the case that the economy is slowing down. So we have seen mixed economic signals, but there's no question about the economy slowing down, which makes employers hesitant to hire, but the work still needs to be done. So in that case, the employers are willing to lean on their current workforce a bit more in order to get the job done. There are parts of the job market right now where there are pretty severe labor shortages. Industries like healthcare is one of them. So in these industries where there are labor shortages, quiet hiring may be a way for employers to fulfill their needs.
It's incredibly expensive to hire new talent, and it's a little bit cheaper to retrain existing talent that you have. And it's definitely a little bit cheaper to also do it with contractors if you design it correctly so that you're not breaking the law in terms of where you're classifying your workers. When we look at how much it costs to hire someone, say it's a replacement hire, you're looking at the impact on my team, but also on my managers and on my colleagues. There's a lost productivity as long as that position's open. The recruiting team and the hiring manager is going to spend that's expensive time doing the sourcing of candidates, the reviewing of applications, the interviewing, the conversations to make the decisions. And then you add in bringing in additional things. Maybe there's a relocation bonus, there's a signing bonus. It's expensive.
There can be many negative attributions to the idea of quiet hiring, such as you're effectively causing people to work harder for no change in their compensation. And I don't doubt that there are instances of that. I don't think that's the most important part of the phenomenon.
I think it's labor abuse and wage theft when not done the right way. Let's put it in an example. If you are busy and if you are cross-training your employees left and right, you are literally cross-training them for 4 or 5 roles. Wearing multiple hats and then paying one salary? No, it's not going to work. How about you go back and see the root cause of why you're trying to cross-train the employees. How about you are not forecasting those headcounts? Whose fault is it? It's a resources planning? It's a workforce planning? So let's go back and hold the leadership team accountable. Why are you backfilling it? I mean, why are you not paying them if you're backfilling it? It creates the burnt out for employees. And normally the high performer are the one who's going to take on that. They always go above and beyond. And this is why people are quitting.
If an organization isn't really thoughtful about how they do quiet hiring, there is absolutely a risk that you could end up worsening some of the diversity, particularly if, say, you're moving people into an opportunity that can give them access to more leadership roles in the future. Have you thought about the diversity of the group that you're moving in there? From an equity perspective, are you making sure that the compensation that you're offering doesn't create inequity within the organization in terms of people with similar skills and similar responsibilities being paid differently?
Quiet hiring is smart business strategy, and as we look for the future, organizations need to understand where their talent sits in the organization so they can deploy that talent along the way as they continue to move their organization forward.
Quiet hiring is actually a great opportunity for employees because they get an opportunity to own their growth, they get an opportunity to invest in themselves, build a skill set, and actually bring that skill set and their diversity of thought into areas outside their purview or job responsibilities within an organization. It's also an opportunity for employees to accelerate their careers, because when would you get an opportunity to hop onto new responsibilities and take on new job roles, exhibit your impact?
Quiet hiring, I believe, is representative of the future of work trend, where we're going to see a more healthy balance of power between employers and employees. It's definitely been imbalanced over the past few years. Quiet hiring is an opportunity for employers and employees to come together and talk about different opportunities that can allow employees to stretch themselves and be challenged while benefiting the business and allowing the business to innovate and move forward faster than its competitors.
In the world of artificial intelligence, there's been one name that's been on everyone's lips lately.
ChatGPT. ChatGPT.
ChatGPT.
OpenAI, the San Francisco-based startup that created ChatGPT, opened the tool up for public testing in November 2022. In under a week, the AI model amassed over 1 million users, according to OpenAI's CEO. By the end of January, ChatGPT was averaging about 13 million visitors per day. users have put the text-based AI chatbot through its paces, with prompts ranging from the silly to the practical and even the creative.
The future's unfolding, it's hard to ignore. Automation's coming, it's knocking on the door.
The tool has become so popular that it's not unusual for users to be met with a message saying that ChatGPT is at capacity and can't handle any more queries.
As a linguist, and as a person who cares a lot about grammatical issues, stylistic issues, punctuation, spelling, the first thing that's really impressive is how good it is at basic writing. It's better than most of the writing that I've gotten from students over the decades.
I would say it has been an explosion of interest around not just ChatGPT, but around generative AI more broadly. I've described this in a couple different scenarios as being akin to an iPhone moment.
Of course, as with any new technology, there are a number of legitimate concerns.
If people believe that there's a problem with fake news, tools like this can only make the problem worse.
OpenAI declined to be interviewed as part of this documentary. So in order to figure out what ChatGPT is and how it works, CNBC decided to go to the second best source and just ask the chatbot itself. We entered our questions into the bot's web interface and instructed ChatGPT to answer in a 1 to 2 sentence interview format. We used the text-to-speech software to give ChatGPT a voice. Can you give me a short description of yourself and then tell me what kinds of things can you do?
I am ChatGPT, a large language model trained by OpenAI. I am capable of understanding and generating text, and can answer a wide range of questions, as well as generate creative writing and text summaries.
So a lot of the people that have used your services seem to think that you're pretty smart. Tell me, how do you have all of this knowledge?
I have been trained on a massive dataset of text, which allows me to understand and generate text on a wide range of topics. The dataset contains a wide variety of information such as books, articles, and websites, which allows me to have knowledge on many different subjects.
Do you have any limitations? Are you sometimes wrong?
As a language model, I don't have my own personal experiences or beliefs. I can only base my responses on the information that I've been trained on, which means that my answers may be limited in their accuracy or completeness. Additionally, my knowledge is based on the data that was available to me at the time of my training, so it may not be up to date. And as an AI model, I might make mistakes based on the model's predictions.
The maker of ChatGPT, OpenAI, has some big backers, including Microsoft, LinkedIn co-founder Reid Hoffman, and Khosla Ventures. Elon Musk also helped to co-found the company back in 2015. ChatGPT, which stands for Generative Pre-trained Transformer, is just one of the company's projects, all of which support its goal of ensuring that artificial intelligence benefits all of humanity. At the core of ChatGPT and other chatbots like it is what experts refer to as a language model. For ChatGPT, that model is called GPT 3.5.
Language model is the underlying technology that powers the chatbot. I like to think about it as the language model being the engine and the chatbot being the car. And so the language model itself is it's a complex, what they call machine learning software. It's the thing that sifts through the data and finds patterns, and the chat interface is which, when people interact with, that's where they receive the answers from.
Chatbots have been around for a while, but most have been tailored towards very specific tasks, such as answering basic customer service questions about your phone bill. ChatGPT is much more sophisticated, thanks to the wide-sweeping data on which it was trained.
OpenAI doesn't reveal specific data that you use to train. What we do know that it's a ton. It surfs the web, spools all that internet data. They do Wikipedia entries, a lot of archived books.
ChatGPT is part of a growing field of AI known as generative AI.
Most of AI in the last couple of decades has really been around analyzing existing data. So, finding an anomaly in data, detecting fraud, making a movie recommendation. Generative AI is very different. It allows you to create brand new content. That content can be text, like a news article, or poetry, or marketing copy in a website. It can be video, it could even be audio, like creating brand new music.
The technology has venture capitalists excited. Funding for generative AI companies reached $1.37 billion in 2022 alone. Microsoft has been investing in OpenAI since 2019, when the company committed $1 billion to the startup. In January, Microsoft announced a third round of investment.
One expert said that it could cost up to $3 million a month, about $100,000 a day.
A lot of AI researchers have sort of estimated that it costs, millions of dollars to train and then operate, plus, the bandwidth of keeping it alive when it's under heavy use. I mean, these are not cheap software programs. They require a lot of investment.
In a tweet, OpenAI CEO Sam Altman said that while the average cost per query is a few cents, the compute costs are eye-watering. Enter Microsoft.
OpenAI trained the models that power ChatGPT on Azure, Microsoft's public cloud infrastructure. That's a bunch of servers sitting in a data center in the middle of the state of Washington and many other locations around the world.
But OpenAI is not the only company trying to crack the generative AI code. Big tech companies and startups alike are developing a slew of generative AI programs that can transform text to pictures or videos and offer coding suggestions, among other use cases. One VC firm estimates that there are over 450 startups now working on generative AI. Meanwhile, Microsoft, Meta, and Google have all developed their own language models to power their version of conversational chatbots. Though development has not always gone as planned. Back in 2016, Microsoft released Tay, which was promptly shut down for spewing foul language.
Unlike some of the other hyped technology sectors in the past few years, this has a very real application, both for individuals and for enterprises right now.
Microsoft has taken some of the products that OpenAI has built and added it to products it has. So for example, CarMax is a company that lets you look at reviews of cars. And what CarMax did is it took the OpenAI service on Azure and it summarized all of those reviews of the Kia Sorento. And that way you don't have to go through 500 reviews.
Microsoft is reportedly also considering adding ChatGPT to its Bing search engine in a bid to compete with Google. One company that's already experimenting with such a feature is You.com, which lets users conduct a search using a conversational format. However, AI tools are still far from perfect, and experts argue that users should take care to not rely on them too heavily, at least not for the time being. It's a sentiment shared even by OpenAI's CEO, who said, quote, "It's a mistake to be relying on it for anything important right now. It's a preview of progress. We have lots of work to do on robustness and truthfulness."
There's a lot of kinks that need to work out. For instance, it generates a lot of wrong answers, and it's really confident though. I talked with a legal research firm that told me when they tried using it to study court cases or to summarize court cases, it was getting a lot of the history wrong. So they couldn't use it as a legal research tool as of yet.
With its massive user base, the misinformation issue is one that's top of mind for Google. During a monthly all-hands meeting, Google executives said that Google has much more reputational risk in providing wrong information, and is thus moving more conservatively than a small startup when it comes to releasing its chatbot publicly. The company is, however, already internally testing an AI-powered chatbot and an alternative search page that can use a question and answer format. Another issue with the current iteration of AI technology is that it can be biased or toxic if the databases that it pulls from are also biased or toxic.
People have already found instances of it generating biased answers, like, associating women with, housework, men with more scientific endeavors, and certain examples. OpenAI has acknowledged this, but that's an issue that's been long plagued the AI industry and a lot of companies trying to evaluate its use.
Many of these data sets do have some kind of cleaning, vetting, or wrangling process that removes content that is, deemed offensive or pornographic or otherwise unacceptable, so that the data set you get on your end is clean.
But cleaning up this large data set can come at a real human cost. A recent investigation by Time found that OpenAI initially outsourced workers in Kenya to sift through thousands of snippets of text describing horrific situations, including sexual abuse, violence, and hate speech. The worker's job was to label these examples as inappropriate, so that ChatGPT could learn to detect and filter out toxic content. According to the Time investigation, a number of these workers walked away from the job traumatized. CNBC reached out to OpenAI for comment regarding this incident, but the company did not respond. Despite these efforts, there's been instances where ChatGPT has provided instructions on things like bomb making, though experts say OpenAI is adding guardrails almost daily to prevent ChatGPT from answering such queries. What do you do if somebody asks you to do something potentially dangerous, like how to make a bomb?
I cannot provide instructions or information on illegal activities such as bomb making.
Even though generative AI like ChatGPT still has a long way to go, predictions about how the technology will influence our society are already swirling. One prominent discussion centers around generative AI's propensity to replace some human workers. Among the industries that may be most affected by ChatGPT, experts say, are journalism, law, and translation. Programming may also change, with companies already training generative AI models to write basic code.
Relatively few of the stories in newspapers or on television news are done as investigative reporting. They're more reporting information, and that's something that generative AI is exceedingly good at. There now are an increasing number of tools for generating briefs, which lawyers write.
Tools like this, Barron says, even have the advantage of customizing briefs for a specific judge, by taking all of the data of their past opinions and seeing which brief succeeded in winning the case. But not everyone shares this outlook.
This is not something that's going to take your job. It's a novelty. It's a gimmick. ChatGPT is fun and interesting, but it's ultimately an iterative step forward in how people can see the capabilities of artificial intelligence in the world of language.
Nevertheless, society has already had to adapt. Worries around students misusing ChatGPT have prompted a number of school districts around the country to ban the tool. Barron suggests that educators could go back to having students take oral exams, or have students turn in multiple handwritten drafts of a paper so that teachers can see the progress of a student's writing instead of just the end result. Meanwhile, image-generating programs like OpenAI's DALL-E 2 have raised complicated questions around creativity and ownership. Still, some experts believe there's no replacing the human brain.
Large language models are about language. So they don't understand the world outside of language the way that you and I and other humans do. What it may do is, take away some of the really annoying tasks that were part of our job that we didn't really want to do, like some of the data cleaning and data prep tasks. But I think this will ultimately create more opportunities for knowledge workers in the long run than the opportunities that it will preclude.
As for ChatGPT's thoughts, they're quite nuanced for a bot. Do you think that AI like yourself will completely change the world?
AI has the potential to greatly impact various industries and fields, but its impact will depend on how it is used and developed, and responsible usage is crucial to ensure that its impact is positive.
I almost never have cash on me, just my credit cards. And I pay my friends, my bills, all using this. This has honestly changed the world and how money moves through the economy. An estimated 149 million Americans, or 62% of smartphone users, use peer-to-peer payment services. That's up from 90 million people in 2019. Stocks of payment services like PayPal, which owns Venmo, and Block, which owns Cash App, boomed in 2020 as more people began sending money digitally. And then there's Zelle, which launched in 2017 and is owned by 7 big banks. It stands out from competitors in one major way. It doesn't have an independent revenue stream.
Zelle is a consortium of banks working together for an opportunity as opposed to a standalone company.
The financial institutions that were offering P2P services, many of them got together and decided that they needed a common branding.
But customers using any P2P service are vulnerable to being scammed.
What are the costs to consumers when things don't go well in the payment space?
You built the system, you profit from every transaction on the system, and you tell people that it is safe. But when someone is defrauded, you claim that's the customer's problem.
So why did the banks create Zelle? And what can be done to stop fraud on the platform? Zelle was launched in early 2017. It's owned and operated by Early Warning Services, LLC. That company is co-owned by 7 major banks: Bank of America, Truist, Capital One, JP Morgan Chase, PNC Bank, US Bank, and Wells Fargo. There are more than 1,800 banks and credit unions participating in the Zelle network.
Zelle is a P2P payment system that enables two people with different bank accounts to send money across from one bank account to another bank account instantly. They're trying to create the ease of money transmission that Cash App and PayPal and Venmo have, but while doing it in a contained ecosystem inside the bank.
And the banks needed a service that anyone could use because you, your mom, your best friend could all sign up for Venmo or for Cash App or for PayPal and send money to each other, whereas you might not be able to do that directly from your bank account. The banks didn't want to lose that engagement, so they said, we're going to build a service that's open to everyone.
Projections suggest that Zelle outperformed Venmo, PayPal, and Cash App in transaction value in 2022. The thing about Zelle is the banks don't really need it to be profitable.
You should think of this really as a little bit of an accommodation, but also as an engagement tool versus a revenue generating machine.
Peer-to-peer payment apps can be traced back to the late 90s with the founding of PayPal.
Back when eBay was a baby, basically. It was a wonderful invention that kind of occurred right after Y2K. So it facilitated transactions between people who didn't know each other, particularly in this online auction space. And at that time, we were still using checks for those types of transactions. That's what person-to-person payments stepped in to address. And PayPal was the person-to-person payment provider that stepped in to do that.
Several banks tried to compete with PayPal back in the early 2000s, but they ultimately were forced to shut down. One of their major flaws was trying to monetize their services when PayPal was not only free, but also paying people to join and to refer friends.
I think the failure in the past was that they were trying to emulate PayPal without really understanding what was going on. They were trying to monetize something that was already being given away for free. So they have learned that lesson, obviously, because Zelle is a free P2P mechanism.
The other thing that led to the banks pulling out of P2P payments was the high rate of fraudulent activity.
With the beginning of any new product or services, there's fraud and there's gaming, and it's how quickly you can learn and consume that to make the product better. It has a real impact on how well the service is able to survive. And admittedly, financial institution tolerance for stuff like that is pretty low, whereas, a fintech might be more willing to have some losses and learn as they go.
Venmo was founded in 2009. It was purchased by PayPal in 2013 and grew in popularity a few years later. Similarly, Cash App was launched in 2013.
For banks, it's a no-brainer to try to compete in that space. Customers use their mobile banking apps all the time, and no one wants to cede opportunity from a space that people are already really active in to third-party competitors. So that's where Zelle kind of came into the picture.
So Venmo is actually pretty different from Zelle. On its face, it's also an account-to-account fintech challenger, but there's a number of different ways in which Venmo can monetize its consumer base that Zelle does not take advantage of for a variety of reasons.
Venmo has the most users, but a lower volume that leads to a lower average transaction value. And Zelle, on the other hand, has a really high average transaction value. That's because it's really popular for high value transactions. For example, I use Venmo a lot for social, but I also pay my rent on Zelle. And that dichotomy is super common, and it makes competition in the space really interesting because it isn't necessarily a quote unquote winnable space. It's a space where providers can compete for volume, but they can compete for different kinds of volume, and you can get users who are on another platform to use yours, even if they don't give up the one that they were using before.
Tight security can be at odds with convenience, and that also applies to P2P payment apps. Of the 7 banks that own Zelle, 4 of them reported more than $90 million in scam or fraud claims in 2020. That number jumped to nearly $236 million in 2021. An October 2022 Senate report projects it will exceed $255 million in 2022. The report also says that in most cases, the banks are not repaying customers who were the victims of a fraud or a scam.
You built the system, you profit from every transaction on the system, and you tell people that it is safe. But when someone is defrauded, you claim that's the customer's problem.
Senator Warren has also accused the consortium of banks that own Zelle of withholding information about these scams and fraud cases. Zelle's parent company, Early Warning Services, LLC, called the report, quote, misleading in an October 2022 press release. Zelle says that more than 99.9% of payments are sent without any report of fraud or scams. There have also been reports of fraudulent activity on PayPal, Venmo, and Cash App. All 4 companies provide resources to consumers to better protect themselves.
One of the reasons that P2P fraud is so tricky is because it's less about something that's inherent to the platforms. It's not like they're being hacked or there's data sort of falling off the edges or whatnot. And it's more about human error. People are being tricked online, there's social engineering, there's scams, and they're falling for it.
Companies like Zelle and others will say, well, the consumer has to work with their financial institution. We're not the bank, right? And I think that just puts too much onus on the consumer. Right now, the way that things are in terms of legal liabilities and responsibility, companies have obligations to investigate and to adhere to certain prescriptions, but the consumers largely still can be liable for sometimes up to $500. So that's problematic.
Most of them are taking it on a case-by-case basis. So they'll listen to what the situation was and then make a determination about whether or not those are funds that should be returned to the consumer. And there are times, too, where they will work with the receiving bank and try to claw back those funds. That doesn't always work because if the funds are already taken out of the account, what are you going to do?
The challenge is that once you're online, there's like continually evolving kinds of schemes. And yet, I would say with respect to all of the companies, not just Zelle, beyond education, you don't really see the technology keeping a pace with methods that consumers can use, A, to either slow down the transaction, and you do see companies responding there, or B, if we're in a real-time payments and transactions space, are there real-time solutions to managing and preventing fraud? And who should bear the responsibility?
There's some mitigations around that, about like how much money you can send at one time. But fraudsters are creative. So I think what we'll need to see, and what I expect to see in some form or fashion, is some ability to rein in and provide some consumer guarantees around reversibility or effectively a chargeback.
They are working to fix the fraud problem, and there's really 3 approaches they're taking to that. The first is a tech-driven approach. They basically use AI, machine learning, to better make sure that senders and recipients are who they say they are on the back end. There are also education campaigns. When you're sending money, you might get a prompt saying, are you sure you're sending this to who you think you're sending this to? Just to try to preempt the fraud before it happens by making consumers more aware that it's a risk. And then the third is this rumored reimbursement plan that came out late last year. Under this plan, banks would determine if a fraud claim was legitimate, and then the bank that holds the account where the funds were sent would reimburse the victim. So if I sent money to you and you were a scammer, your bank would be responsible for paying me back if it was proven to be a claim that could be repaid. Competition in the space is really fierce, but it's complicated because it's really common for people to use multiple apps for different use cases. So I would say that the majority of P2P users are on more than one of these platforms and potentially even all 4 of them, but they are using them in different ways.
The companies are competing to gain more share of users in different age demographics. Only 20% of people over the age of 65 said they use Zelle, while 41% said they use PayPal, according to a Pew Research Center survey from July 2022.
What we're looking to see is more people who are older, who have greater financial means, higher incomes, starting to adopt fintechs as their primary mode of accessing financial services.
Gen Z and even Gen Alpha, like, are digital everything all the time. They live and die by their smartphones. Everyone wants to reach this population. Cash App already launched a teen account. Venmo seems to be exploring it this year. It's an exciting opportunity for growth potential because if you can get people when they're really young, they might form habits around you that last for a lifetime.
The branding is helpful in that, you aren't looking at Wells' individual P2P payment mechanism or Citi's individual payment mechanism. It looks very cohesive across the financial institution landscape that's participating in the network. So I think all of those things bode well.
They're trying to chip away at some of the frequent challenging points of interacting with the banking industry, whereas Cash App, PayPal, and Venmo are really growing off a viral P2P benefit.
Providers are trying to get new features out there. I'm interested to see how they're looking to tighten relationships, grow their volume through these new offerings.
Miriam Sandler and her husband Mark aren't cleaning up their kids' playroom.
21 products.
Or setting up for a segment on QVC.
Tap to join me live.
Instead of TV, she's going live
You're all set. One.
on Amazon.
Hi everyone, welcome back. I'm so excited to be live with you. I'm Miriam Sandler and I'm the face behind Mother Could.
Think of it like the home shopping network for Gen Z and millennials. Entirely online, hosted by famous creators like Sandler, who have millions of followers across social platforms.
Hi from Ohio, hi from San Diego, hello from Honduras, hello. Alejandra, hi, how are you?
We know that the vast majority of Gen Z consumers say that they now use social media as their first stop for shopping inspiration because they have built trust and they've grown up feeling authentic relationships with these people online.
Amazon, TikTok, Instagram, YouTube, Shopify, they're all getting in on the game. It's a way to differentiate a product from the millions of others in oversaturated online marketplaces.
One of my favorite cleaning products is a spin brush.
They want somebody demonstrating it. They really want somebody showing the product, how it works, and showing its efficacy. And it's also entertainment.
But the US is lagging way behind China, where 74% of consumers say they bought products through a shoppable live stream in 2022. In the US, 78% say they've never even watched one.
In China, we're seeing 200 billion plus in sales. How do we mimic that in the US? And I think we're probably in the mid hundreds of millions.
It looks really cute.
We go behind the scenes with creators to find out what it's like to sell via live stream and what it'll take for the emerging model to become a mainstream way that US consumers shop.
Very cool. So I will do like a little cucumber salad and cut this in half and then bring this out. And I want to give you a little demonstration. Here we go.
Impulse purchases, driven by compelling live pitches, are nothing new.
And this is the American egg, and I'm bringing it out on D-Day.
For the last 4 decades, the Home Shopping Network and QVC have been broadcasting to tens of millions of US households. But as e-commerce thrives, traditional retail has been forced to evolve. In 2017, amid slowing sales, QVC and the Home Shopping Network merged in a $2.1 billion deal. When the pandemic grounded shoppers in 2020, viewership for the shopping networks went back up 10%. But their biggest growth, 100% year over year, happened on their social platforms. It's no surprise the model has moved online, where other platforms are giving it a go too.
Live shopping has been sort of the holy grail for social media platforms for a couple of years. Instagram tried it, YouTube has tried it. And then really during COVID in 2020, we started to see it percolate mostly in Asia, where there was such a big audience ready for shopping.
Another really cool thing about this label maker is that it is completely inkless. It'll never run out of ink because it works with thermal technology.
Just like the QVC of old, personalities pitch products live, now from the intimacy of their own homes. Audiences can react with emojis or stars. A chat window lets them ask questions the host can answer live. And links to the featured products make for easy purchasing.
Oh my God, $23, you guys.
Thank you guys for letting us know.
During pandemic lockdowns, these live streams took China by storm. Chinese retail giant Alibaba was first to market there, launching its live stream app Taobao Live in 2016. In 2020, it exploded. In the first 30 minutes of China's 2020 Singles Day Shopping Festival, Taobao live streams generated $7.5 billion in transactions, a 400% jump from the year before. That same year, the live stream shopping market in China was valued at $171 billion, estimated to grow to $423 billion in 2022.
People are excited by what you're seeing from China, where you see really, really high conversion rates on some of these experiences, much higher than maybe a regular website would have. You're seeing potentially, up to 40% in some cases. You might see much lower return rates because people know what they got.
There's a rapidly growing ecosystem of new live streaming apps in China too, like TikTok's sister app Douyin and Pinduoduo, known for rock-bottom prices. Live streamers in China, known as key opinion leaders or KOLs, have made massive fortunes. There's entire boot camps devoted to the career craze of becoming a live stream shopping host.
KOLs there have millions and millions and millions of fans. So even if 10% show up, that's still 1 million. People want to buy product with meaning or product that they can't get anywhere else. And that's really what's the underpinning of live shopping. In the US, that's very different than in China, which is all about just, a mass population.
At 35% of the market, Alibaba's Taobao Live remains the world's biggest live shopping player. But the last few years have seen a flurry of US companies investing in live shopping ventures too. First among them, Amazon.
2 pockets actually. I love it. I'll show you the material a little bit closer up.
Amazon introduced live stream shopping in 2016, then launched its Creator app in 2020, a tool for making it easier to go live.
So the first thing that we're gonna start out with is this lovely I just killed my husband robe.
Tiana Young Morris was a practicing attorney when she first started live streaming in 2020.
The pandemic hit and I was bored in the house. I was on TikTok just like everybody else, and it just kind of took on a life of its own.
Videos of her trying on wigs and reviewing them went viral, long before she made money doing it.
Every other wig that we're talking about this evening is baby throw and go. Throw it on like a hat and out the door. Like that first viral video, I was like, oh, there are a lot of people that are gonna buy the product that I recommended. Yes, honey. How can I make money off of this? And Amazon just makes it so easy for you to sign up for the influencer program.
Through the Amazon Influencer program, creators get their own storefront where Amazon users can follow them. Now, Young Morris sells almost exclusively on Amazon Live.
As an attorney in private practice, I was making about 100 grand, like a little over 100 grand, maybe like 110 or so. And now I make about 6 times that.
The biggest moneymaker for Amazon Live creators is commission, which is usually 10% or less of sales from click-throughs on the live stream, although the rare category can be as high as 20%. Amazon also offers some creators a flat fee for going live regularly, and top creators can make extra from brands that pay for dedicated, sponsored live streams, like this one Young Morris did with Dove.
This body cleanser? Give it all to me.
While brands often send live streamers free products, top creators build viewer trust through honest reviews.
The length on them is not super long. I feel like it's important to just tell the truth about what it is, because if it's short on me and a tall woman buys it, then they're gonna realize it when they get it anyway, and they're just gonna return it.
I really want it to be my opinions. I want it to be purchased from me. Like, I spent my own money on this product, so I can tell you it is worth spending your money on this product. I probably decline 75% of the offers that come my way, and I could have a lot more money if I accepted those. And I would still have community members, but I would have no trust in me.
Celebrities like Kourtney Kardashian Barker and Paris Hilton also hold live streams for the Amazon launch of their own brands. Brands like JBL have also seen major success on Amazon Live, where a carousel of products linked on the left make for frictionless buying.
I've got so many amazing Prime Day deals for you guys, and it's actually in collaboration with JBL.
Last year during Prime Day, one of JBL's Amazon Lives hit 714,000 views. And JBL's Lauren Severson says 83% of purchases were made by first-time customers.
Our portable
waterproof speaker. So that saw an 80% increase in the 2 weeks following of sales. And then we saw an increase of 22% of traffic to any of our JBL pages on Amazon.
Vueltitas, mix, mix, mix. Mix, mix, mix.
Sandler's career as a creator first took off in 2019 with viral videos, like this one that has nearly 80 million views on YouTube, demoing playful recipes and activities she does with her 3 daughters at her home in Miami.
You're an excellent Play-Doh maker. So my husband was an investment banker for 15 years. One day we realized that I was making double what he was making, and he was making a really good living. I was like, let's take a leap of faith, leave. And he left. It's probably grown 4 times since, and it's just crazy.
Sandler's Mother Could brand makes the most on Amazon, but she has more followers on Instagram at 1.2 million, and TikTok with 730,000 followers and 11.7 billion views.
I don't profit off any other platform that you can go live. Everyone coming to Amazon Live is essentially coming to buy something. They're there for that. I feel like if you are live on Instagram, live on TikTok, live on Facebook, they're there to like see what's going on.
Amazon Live is the most complete end-to-end platform. We could say it's in the BYOA category, bring your own audience. So they have to come and drive traffic there, which is a little more difficult than showing up and just turning it on.
While Amazon is all about frictionless sales and high conversion, social media live shopping is more about growing followers and going viral.
Products go viral all the time on TikTok, and Scrub Daddy is a great example. Dyson Airwrap is another example. That's what differentiates the social platforms from Amazon. Amazon, you go there to find something you heard about or you're looking for.
In 2020, Instagram and TikTok became the first US social platforms to launch live shopping capabilities. ByteDance-owned TikTok partnered with Walmart for an hour-long live where TikTok users could buy Walmart fashion items featured by creators. The duo did another live stream in 2021 after reporting the first event netted 7 times more views than expected and grew Walmart's TikTok following by 25%.
I think TikTok is going to be able to leapfrog everyone else is because they have so many users now. They have 1 billion active monthly users, and every time you use the platform, it's learning your behavior, learning your interests, and serving you what it thinks you like.
But right now in the US, shoppers on TikTok have to navigate away from the app to make a purchase, eliminating a big potential revenue stream. So in the fall, TikTok started US testing of a new function called TikTok Shop. It allows users to buy directly in the app. And although it's invitation only for creators and merchants in the US right now, it has already launched in Southeast Asia and the UK. Now Shopify and YouTube have teamed up on live shopping efforts too. Announced in July, the partnership expands live shopping capabilities so viewers can click and buy without leaving YouTube.
It's not just like, here's yet another thing that's distracting our youth with video selling, but it's actually, here is a new way that business is evolving and adapting to how the world is going to look in the future.
Business owners like Cassie Ho can go live on YouTube and elsewhere to promote their own products. Ho first went viral with this Pilates workout video under her screen name Blogilates 13 years ago. Viewers asked her to sell merch featuring her screen name.
And I was like, what? You want stuff with my screen name on it? And so I was like, okay. So then I remember buying like these shirts from Forever 21 and like screen printing Blogilates on it and put it up on Facebook. And then it sold out within minutes.
Shortly after, Ho launched an activewear brand called PopFlex and started posting design process TikToks that get millions of views.
37 weeks ago, I attempted to make the perfect legging.
She tries on PopFlex clothes live on Instagram, which she says leads to far more sales than TikTok.
Right now, across all my social platforms, we have about 15 million followers and subscribers everywhere. And on YouTube, over 2 billion views. And then in terms of sales, PopFlex on its own is an 8-figure business, and then Blogilates on its own is an 8-figure business.
Ho said she had her best sales hour of the year before Black Friday during an hour-long YouTube live shopping event.
Sweatpants, they are happening tonight. It is happening. You need to go get them because I don't think they'll be lasting long.
There's also a handful of startups developing new US platforms devoted entirely to live shopping. There's Network that focuses on sneakers and collectibles, Supergreat and Trendio for beauty products, and the biggest among them is TalkShop Live.
TalkShop Live.
TalkShop Live, TalkShop Live.
Where Walmart held 150 live shopping events in 2022, and celebrities like Dolly Parton, Tim Tebow, and Jamie Foxx have gone live. And TikTok is reportedly in negotiations with TalkShop Live about outsourcing its live shopping efforts to the US-based startup. TikTok currently faces bans in several states due to concerns it could hand user data over to China.
I have a feeling that before it gets banned, it'll probably sell or do other things to placate, authorities. But I don't think that it's going away anytime soon. And it really is the backbone of pop culture right now because it is the chosen platform of Gen Z.
Despite trending hashtags like TikTok made me buy it, one survey found US shoppers are hesitant to pay for products directly on social sites. In turn, retailers miss out on the click-through and conversion data that's owned by the social sites. It's a big barrier to success for the business model, and one that's not an issue for Amazon Live or Alibaba's Taobao Live in China. As e-commerce platforms and not social networks, they keep buyers on site all the way through the sale. Amazon continues to grow its livestream efforts, launching Amazon Live in India last September. Meta, on the other hand, is scaling back its focus on shopping. It halted live shopping on Facebook in October and removed the Shop tab from Instagram's navigation bar this month.
So we're bringing Create down to the bottom, front and center, and we're removing the Shops tab.
And in China, the government is enforcing greater supervision over private industries, including live stream shopping. Some of its biggest live shopping superstars have been hit with massive fines or taken sudden unannounced breaks.
Okay, so yeah, this is the tablet and this is the case.
In the US, it remains to be seen whether live stream shopping is just a fad that took off while consumers were stuck at home during the pandemic, or if Amazon Live and social platforms have created a big enough draw for it to stick around for good.
One thing I've learned about merchants, they're incredibly resilient entrepreneurs, and when they find something that works, it spreads. So yeah, let's hope that this is the year that we see that real explosion in live selling.
Thank you so much. Have a great day. Have this on.
In Modesto, California, some of the very first Tesla semis are hitting the roads.
The Tesla that you can see behind us is fully operational. They're running up and down the road within a 400-mile radius, delivering product to all of our distribution locations and to our customers. We use them the same way you would see any traditional Class 8 vehicle delivering product.
PepsiCo, which owns Cheetos, Doritos, and other Frito-Lay products, pre-ordered 100 back in 2017. Walmart and FedEx have also placed pre-orders, but Pepsi was the first customer to take delivery of the new truck.
PepsiCo owns one of the largest private fleets in North America, and that's one of the reasons we have partnered with Tesla. We have the 15 in Modesto that we're launching, and then we have 21 in Sacramento, and then we are working plans for the additional units up to the 100.
First announced in 2017, the Semi has been one of the longest delayed products in Tesla's history.
What makes the Tesla Semi so different, and really Elon Musk's introduction of it, is he really brought the awareness to the broader public. He made trucking sexy.
And it could also be its vehicle with the biggest impact.
Even though trucks are only a small portion of all the vehicles operating on California's roads, they're responsible for the vast majority of carcinogenic diesel particulate matter.
Although it's only 1% of vehicle production, it's 20% of vehicle emissions. And it's over a third of all the particulate emissions.
The need for alternatives to diesel is steadily rising as stricter emission regulations are established.
In California, at the ports, you're not going to be able to use an ICE engine truck in the near future. Electric is an ideal solution for that.
But the launch of the new electric truck hasn't been without issues. There have been a few sightings of the Semi breaking down around Northern California.
We can have a concept vehicle, it can look great on stage, it can look really compelling and exciting and talk about a whole new future. The realities are quite different.
Welcome to the Tesla Semi truck event. I hope you like what you see. We're confident that this is a product that is better in every way from a feature standpoint, that wins on economics against diesel trucks in a worst case scenario, and that defeats rail in a convoy scenario.
At the time, Musk said the Semi would go into production in 2019 and made other promises about the truck's capabilities.
It really shocked, no pun intended, a lot of the population about a lot of the performance metrics.
But delays caused the original timeline to slip. 5 years later, the Semi has finally arrived.
We're incredibly excited tonight to actually deliver our first production Tesla Semi trucks. And yeah, we're looking forward to actually delivering our first production trucks to PepsiCo. Yeah, sorry for the delay.
Omitted from the event, though, were details around the economics, million-mile guarantee, and autopilot features announced at the original 2017 unveiling.
When Elon Musk introduced the Tesla Semi, it was a big deal. It felt like this was a revolutionary moment for trucking. Fast forward 5 years, when they delivered the Tesla Semi to PepsiCo, it was actually a much different sort of experience. It felt like they were dialing it in. They had promised these things and were going to deliver them, but it just didn't feel like it had the hype that we had a couple of years ago.
The trucks Pepsi received don't have autonomous features activated yet.
The autonomous functionality of Tesla is not spec'd for these vehicles. They have the hardware capability. We'll get to that down the road as an additional capability.
When it was announced, the truck was touted to have an industry-leading 500-mile range.
500-mile range. And by the way, it's 500 miles at maximum weight at highway speed.
There have been some initial reports that they can't handle the weight or the distance that was initially promised. And so it's more of a wait and see.
To start, Pepsi is delivering Frito-Lay products around 425 miles per charge. It's also delivering Pepsi out of its Sacramento warehouse on 100-mile daily routes, going directly to stores, and 300 to 400-mile runs to other warehouses.
The contents that are the trailer can weigh about 45,000 pounds is really the accepted weight. And potato chips are made of a lot of air. When we look at soda cans, aluminum, and liquids, these things weigh a lot, and they will weigh out.
Pepsi wouldn't speak to the price of the trucks, but it is estimated to cost around $180,000.
The cost benefit is still a bit of a question mark because I think the price new of an electric truck isn't quite settled yet. I think it's safe to assume that it'll be at least double the price of the equivalent diesel model.
First generation and early development has additional research funding and all that. That's where the partnership and support comes in. But ongoing, we believe there is a positive economic business case for electrifying the fleet.
But experts are predicting that electric trucks will be cheaper to operate over time.
When you take everything into account, a diesel truck will be 20% more expensive than a Tesla Semi per mile.
If you have a predictable charging cost, you can eliminate the expense of fuel and the more volatile pricing that comes along with fuel.
The big cost savings that a lot of people are seeing as they transition to EVs is that the amount of maintenance is significantly lower than traditional vehicles. Obviously, many fleets are thinking about it from that perspective. That total lifetime cost is significantly better.
Diesel vehicle storage tanks are cheaper and the fuel's more expensive. Electricity's more affordable, batteries are more expensive. There's always a constant dynamic between those two, right? And so we like to diversify our portfolio of solutions.
Starting in 2019, Frito-Lay has been transforming its Modesto facility to demonstrate the sustainable benefits of zero and near zero emission technologies.
This project has delivered a 91% reduction in greenhouse gas, and we're using this as a showcase to then cascade to our other operations.
PepsiCo partnered with the California Air Resources Board to make it all happen, matching its $15.4 million in incentives to purchase vehicles, including Tesla semis, to add to its fleet of over 80,000 assets.
We developed what's called the Zero and Near Zero Emissions Freight Facilities Pilot Program back in the 2019 timeframe. And this Frito-Lay facility won one of those grants for a complete transformation of this facility to zero emissions.
We thought it would make a smart move to make the deposit, partner with Tesla. So we put a deposit down several years ago for 100 units when they first announced. We thought it would have great application. We had the experience from the last 10 years with other EV products.
Pepsi received its first Tesla semis in December and already has them in use.
It takes us a couple of weeks between upfitting, logoing, labeling, and driver training. We'll continue to scale that up where over the next several months, most of the drivers will be certified and trained to drive the Tesla vehicles.
The trucks have replaced routes previously being served by diesel.
This vehicle right here with a 400-mile range enables the driver to leave from Modesto and return home without stopping and charging anywhere along the route.
Our average length of haul for over the road is about 425 miles. So we believe across the entire portfolio at Frito-Lay and Beverages that the Tesla semis will meet our delivery needs based on our network.
To charge the trucks, Frito-Lay installed 4 megachargers, Tesla's latest charging technology.
What you can see behind me are our 4 Tesla megachargers. They're capable of charging 750 kilowatts. These trucks here take about an hour to charge, which will give us about 400 miles of range.
The local utilities, the Tesla infrastructure team, we had to bring additional power into the site.
Although Pepsi wouldn't allow us to interview the drivers, O'Connell says feedback has been positive.
They like not needing to fuel the vehicles, right? They come in, plug them in, and can leave them, and they like the overall performance.
In addition to the Tesla semis, Frito-Lay Modesto is also using electric trucks from BYD and Peterbilt.
We have 6 of these Peterbilt electrified route trucks that are charged on site and used by our sales team to deliver our product to any of our stores in the community here in Modesto.
We have several hundred of those vehicles in several locations that we've implemented.
The company is also using compressed natural gas trucks.
This is a fully operational Class 8 CNG vehicle. We have 37 of them in operations here in Modesto. We have the same complement of range that you would see in any diesel tractor.
Competition in the electric truck space is heating up. As the Tesla Semi enters service, it comes at a time when several truck manufacturers are embracing the transition to electric and alternative fuels.
All the traditional diesel truck manufacturers also have electric truck offerings. So your Freightliners, Kenworths, Peterbilts, Volvos, Max, International, they all have electric trucks that are out there already.
Volvo just recently launched its VNR electric semi, a Class 8 truck with a 565 kilowatt battery capable of up to 275 miles of range. Daimler has announced plans to develop its own heavy-duty electric truck, the Mercedes-Benz e-Actros Long Haul, that will have a range of around 310 miles. Freightliner, also a part of Daimler, has the e-Cascadia, a Class 8 semi with a 315 and 475 kilowatt version offering up to 250 miles of range.
One of the advantages that other OEMs have over Tesla is that they know how to sell into the over-the-road trucking business and into the Class 8 environment. They've been doing it for years. They have a lot of experience. They know what fleets want. They know how they spec trucks. They know what drivers want. They have maintenance networks that exist across the country. They're just much better positioned today than what Tesla is to sell into this environment.
But even with so much activity in the space, it's still in early stages.
To introduce an electric vehicle that can solve the mission that's required of these vehicles, it takes many years, many designs, and a lot of testing and a substantial amount of investment. We're in the very early part of that cycle, and it's going to take a few years before we see these vehicles become commercially viable.
For trucking to go fully electric, it will require significant charging infrastructure development.
There's a huge amount of infrastructure that needs to be built. We think about it as the kind of infrastructure that gets built once a century. You had the railroads 2 centuries ago, you had the National Highway Network a century ago, and the scale is very similar to that.
Charging sites for heavy-duty trucks are much more demanding than your average EV.
If you have 20 semi-trucks charging all at one time, that's almost the same amount of power that it would take to power 20 big box stores. Think of that kind of scale of power required. The reliability is also very important. Fleet, for them, time is money, and they have to know that their vehicles will be able to move when they want them to.
Electric trucks also have a weight problem. Compared to diesel, they're much heavier, impacting the total load that they can transport.
The total weight, and that includes the truck, trailer, and the cargo, is 80,000 pounds in the United States. They have allowed, through some of the new regulation, for electric vehicles to go to 82,000 pounds, but that's the maximum gross weight that a vehicle can have.
For Tesla, scaling manufacturing of its new truck will be an uphill battle.
We'll be ramping up semi-production through next year. As everyone knows at this point, it takes about a year to ramp up production. We're tentatively aiming for 50,000 units in 2024 for Tesla Semi in North America.
That sounds extremely high. When you think that 240,000 Class 8 trucks built total, Freightliner builds maybe 50,000 of those. So they're talking about competing with the big dogs in the existing commercial truck space.
To meet this ambitious goal, the company just announced it will expand its Gigafactory in Nevada with a new 100 gigawatt-hour cell factory and a high-volume factory to manufacture the Semi.
The numbers I saw, maybe 500 this year will be built. 500 this year I can definitely see. 50,000 in 2024, I guess we'll have to wait to see on that one.
Despite the progress being made, not all trucking can go emission-free.
If you look at diesel, in terms of the power it can produce in the engine, on a weight basis, it produces far more power than what an electric powertrain will do. So because of those trade-offs, you're effectively dealing with these compromises that you don't have to make with diesel.
Eventually, though, regulations may force most freight operations to abandon diesel.
The more stringent EPA regulations are coming out. There's going to be another level of diesel emissions regulations going into effect in 2027. This is going to be an all-of-the-above solution to meet EPA requirements. So we'll see some hydrogen fuel cell trucks out there. We'll see plenty of natural gas trucks out there, probably.
In the U.S., California has been one of the most aggressive states in driving this.
California has a regulation called Advanced Clean Trucks, which requires manufacturers to sell an increasing proportion of their sales as zero emissions, and ultimately getting to fully zero emissions by 2045 in all sectors of the heavy-duty trucking industry.
And with some of the country's largest ports, it is putting significant pressure on the industry to adapt.
It is the epicenter of North American import and export supply chain. And so what that means is that if California forces the industry to go carbon neutral and eliminate the internal combustion engine, it means that automotive manufacturers and truck manufacturers have zero recourse against that. They will have to do this because if they don't, they won't be able to sell vehicles into the industry, into one of the most important markets in the entire world.
operationalizing any type of fleet portfolio, electrified, natural gas, renewable, diesel, there are challenges, but you can really make it all work without making as big a trade-offs as people think.
The next 5 to 10 years, you'll start to see a pretty significant inflection in the S-curve for adoption, especially for commercial vehicles, given that total cost of operation is significantly more beneficial than ICE vehicles. I'd say by the end of the decade, I would say at least 50% of commercial fleets would be electrified.
We know we have the technology and we have the policies in place. It's just a matter of getting the coordination to happen and continuing to make progress.
You got to give Elon Musk credit. This guy promises an enormously exciting future with really transformational technologies, and he's a world-class visionary that really is trying to set the tone for everything, and he's put everybody on notice. And eventually, they may get there. We may get to a point where we actually see the performance metrics that he's promised and the economics that he's promised, but we're not there yet.
Big tech companies like Meta, Google, and Amazon have been laying off a staggering amount of workers, tens of thousands of people.
Microsoft and Google, within just a couple days of each other, within 48 hours of each other, both announcing they're laying off 12,000 people in Microsoft's case, 10,000 people in Google's case.
And I think we aren't giving these layoffs as much due as they actually deserve. Right now, folks are saying, oh, well, that's just in the tech sector. It's a white collar layoff. It doesn't really matter as much. But the reality is these are still hundreds of thousands of jobs.
There wasn't really one area of focus we're seeing getting cut. It's kind of across the board and at all levels.
So what do the widespread tech layoffs mean for the larger economy and those persistent recession forecasts?
The first of the layoffs really started with Meta, which laid off about 10,000 employees. And this came after their earnings last year when they said, look, we're spending so much money on the metaverse, we're losing, up to $13 or $14 billion on this project. And investors hated that.
Meta stock fell more than 70% and lost more than $700 billion in valuation before Meta decided to lay off 11,000 workers. The stock ticked higher after the announcement.
They get the message from the street loud and clear. We aren't clear about what metaverse return on investment would look like. Having said that, if you can control costs in metaverse, I think that would be a positive.
The next big tech name to lay people off was Amazon. Up to 18,000 employees are getting fired starting this year. It was announced last year. Again, same story. Overhiring and overexpanding during the pandemic, and now these companies feel the need to cut costs.
We've certainly seen a slowdown in the advertising business over the last 6 to 9 months, and so this is clearly the response to that, to try and preserve those margin pressures.
These tech giants that are laying off employees are essentially tech conglomerates, and so tech layoffs across the board look like scary numbers, but if they are in parts of the businesses that are structurally weaker or perhaps in decline, that is less concerning than if we have job cuts in, say, the higher growth areas of the business. And in someone like Microsoft's case, that would be an area like Azure.
The big reason why, or the common thread between all of these big tech companies for their layoffs, is they grew too quickly during the pandemic. There was this glut of spending on tech products when the pandemic first hit and people were stuck at home and businesses had to find ways to help their employees work from home. So that means buying a lot of computers, buying a lot of IT services, Zoom subscriptions, you name it. That all caused a lot of money to be injected into the tech industry. And some people in the tech industry, some executives, got a little overconfident thinking this growth is going to be sustained forever. Let's hire now and get ready for that growth. But they over-projected it, and now we're seeing an economic slowdown and everything's coming home to roost. Now that we're seeing these companies refocus on their core missions and focus on what they believe is going to be the next wave of tech computing, specifically artificial intelligence.
Meta CEO Mark Zuckerberg conceded the same point in the company's layoff letter to employees.
This was ultimately my call, and it was one of the hardest calls that I've had to make in the 18 years of running the company.
Largely what's happening in tech is that they are right-sizing after the COVID surge in demand. And so that demand surge was off-trend. They hired to accommodate those surges, and so they hired well above their organic trend and growth rates.
And in many cases, not only was there the increased need, we'll call it, for infrastructure expansion and those sorts of things, but also you had just such a rush of customers. You needed salespeople, you need customer support, other levels of operating costs, essentially.
But in other cases, there are businesses where through time they have been very sort of cost conscious, so they've been investing for growth at all costs, and for that reason have fairly weak profitability relative to where investors perceive they should be.
If things do get worse, you'll try to see more consolidation. The big guys are going to be okay. Google's going to be okay. Apple's not going out of business anytime soon, no matter how bad the economy gets. But what you do want to look for is some of the more weaker companies, those growth companies that either had no profits or were barely profitable. Those could either go out of business or become really attractive acquisition targets for one of the bigger guys in this environment.
This may look like an astronaut training for the Olympics, but that's not what's really happening here.
For the ISS, you want a rigid lower half with the ability to rotate around the waist, and then a consistent working envelope, which is about right here in front of you. Easy to translate along the handrails. So low torque in the upper joints, good dexterity in the gloves is a big one.
Eric Vallis is a senior systems engineer. He's been testing out a prototype of a new spacesuit, which NASA hopes to use on the International Space Station by 2026.
The spacesuits that are being used now in the International Space Station by NASA are suits that were really designed in the 70s. These are suits that were originally designed for the Space Shuttle program. Due to the lack of funding, NASA kept working on them, kept repairing them and maintaining them for all these many years, but really these are suits that are at the end of their useful life.
NASA tried to update its suits in the past. A 2021 report by NASA's Office of Inspector General found that NASA has spent over a decade and an estimated $420 million to develop a next-generation replacement for its aging spacesuits, but failed to produce any operational suits. Estimates show that by the time new spacesuits are actually in use, NASA will have spent more than $1 billion on the redesign and production.
There were two different issues. One was lack of funding. NASA had to get funds, sometimes from other projects to fund their suit. And the second problem was that there was no destination. The projects of NASA have been moving through different political agendas during the last few years, and something that you need in any scientific and technological organization is a purpose and a timeline.
NASA is now going another route, contracting with commercial companies to make and maintain its new suits.
So without further ado, I am very happy to announce that the awardees will be Axiom Space and Collins Aerospace Industry Team.
CNBC got a rare look inside Collins Aerospace's new 120,000 square foot manufacturing and testing facility, located at the Houston Spaceport in Texas, where the company showed us its new spacesuit. NASA's current spacesuits, known as Extravehicular Mobility Units, or EMUs in NASA speak, are very complex.
The current spacesuit has roughly 18,000 components that make it up, and the interior volume of the suit is roughly equivalent to the size of a small refrigerator, about 5.5 cubic feet.
There have been a number of safety concerns over the years due to the aging spacesuits.
The final investigation is in following the near drowning in space of that Italian astronaut doing a spacewalk outside the International Space Station. His equipment failed him. In fact, they say it was his calm demeanor that probably saved his life after his helmet filled with water.
In 2022, NASA temporarily suspended all spacewalks following another incident where an astronaut's helmet filled with water.
We're starting to see some degradation of performance, some components that need to be replaced. So on Space Station, we're really watching very, very closely the performance of the EMUs while they are still on orbit. In the meantime, these new suits for this particular failure of water in the helmet, the new designs are designed such that that failure mechanism cannot occur.
Inventory issues are also a problem. In 2019, NASA was forced to cancel what would have been the first all-female spacewalk on the International Space Station because the agency did not have the proper spacesuit sizes available for both female astronauts.
In the beginning of human space exploration, the spacesuits were custom-made. With the beginning of the Space Shuttle program, there was this idea of abandoning the custom size system and going to small, medium, and large. That worked for a while, but as our astronaut corps is getting more and more diverse, the sizes don't work anymore.
NASA's Office of Inspector General also noted that of the original 18 primary life support system units, only 11 remain in NASA's inventory to support the ISS program, with only 4 of these units actually on the ISS at any given time for astronauts to use during spacewalks.
These are suits that were originally designed not to be serviced in space, but to be serviced here on Earth, because they were dependent on the space shuttle. So now kind of changed the objective because they have to keep them up there, and the astronauts are the only ones who can repair and maintain them. So the number is very, very minimal.
The Portable Life Support System, or PLIS, resembles a bulky backpack and is one of the 2 main components of the spacesuit, or EMU. The PLIS houses a variety of components that perform functions needed to keep an astronaut alive in space, including providing oxygen, maintaining body temperature, and removing carbon dioxide buildup from the spacesuit. The second major component is the Pressure Garment System, or PGS, which is the white garment that surrounds astronauts. Its main purpose is to maintain appropriate pressure around astronauts' bodies to keep them alive in the vacuum of space, as well as protect them from orbital debris. Underneath the PGS, astronauts don a liquid cooling and ventilation garment, through which cool water flows to help regulate their body temperature. The new suit designs follow a similar suit structure, but are modernized.
There's just normal, what we call obsolescence issues. Certain parts we just can't get anymore. And so we are building a new suit so that we can start using new components, take advantage of all of the new technologies that are available to us now that just simply weren't available nearly 50 years ago.
Under the Exploration Extravehicular Activities Services Contract, or XEVAS, NASA is providing Collins and Axiom, along with a number of their industry partners, with up to $3.5 billion through 2034. Axiom won the first $228.5 million contract to design the suits that will be used during NASA's Artemis moon missions, and Collins won the second $97.2 million contract to design and develop a new generation of suits for the International Space Station. In addition to making the spacesuits, Collins and Axiom will be tasked with providing maintenance and parts to keep the suits in working condition, as well as conducting training and operational support for NASA staff.
The beauty of this contract is the functional requirements for these two suits are very, very close. So at any given time, we could ask either of those contractors to actually start working on the other, what we call platforms. And we also have what we call an on-ramp clause in the contract, which means if another company comes into play and they have the capability to compete, we can actually bring them onto the contract and allow them to compete on task orders as well.
Kearney says the continued competition helps incentivize the contractors to perform on cost and schedule, and ultimately helps keep the expense to the government down. In addition to the fiscal support, NASA also provided the vendors with access to data from the organization's own suit development efforts through its XEMU project.
What we basically did was take that design and we made it available to industry because we put a lot of work and taxpayer money into developing that system. And so as industry came in and proposed on the Artemis suits, they were able to use any of the data we had available from the XEMU development effort.
Axiom Space would not give CNBC a sneak peek of its spacesuit designs prior to a public reveal. To design this new spacesuit, Collins Aerospace is working with longtime partner ILC Dover, as well as Oceaneering. Collins, which is part of aerospace and defense giant Raytheon Technologies, is responsible for the life support system, while ILC Dover is in charge of devising the pressure garment. Oceaneering will handle spacesuit and vehicle interface capabilities. The companies have a long history of working with NASA.
We were actually selected to design and develop and provide those spacesuits for the Apollo mission, along with our partner ILC Dover. We were actually also selected to design and develop the Space Shuttle EMU, or Extravehicular Mobility Unit.
ILC Dover and Collins also designed the spacesuits that astronauts currently use on the ISS. One striking difference, though, is the weight. The current EMU weighs about 275 pounds on Earth, significantly heavier than the prototype that CNBC saw. There are also other upgrades.
This helmet is different than the one that's used on the EMU now. It offers a better range of visibility. It has protective visors to protect from the sun's radiation and glare. The upper torso is adjustable, so it fits crew members better and can be adjusted while they're on orbit or doing a mission to help prevent shoulder injuries and to make their EVA more comfortable for them. The upper arm is also new to this architecture. It provides a better range of motion and a lower torque motion than the current EMU.
Furl says that while the current EMU fits the 5th to 95th percentile of astronauts, this new suit is designed to fit the 1st to 99th percentile of astronauts using fewer parts. As a result, 30% less hardware needs to be launched into space, meaning lower launch costs and decreased crew training time. Another big improvement in this new generation of suits is their increased mobility and range of motion.
Things like standing up, you really got to find the angles to rotate your body, but it's definitely something that we couldn't do before in the EMU.
Extended range of motion becomes particularly important for planetary exploration. Though Collins' contract with NASA calls for making spacesuits for the International Space Station, the company and its partners are designing the suit with future planetary missions, like trips to Mars and the Moon, in mind.
For something like the Moon or Mars, Definitely the less restriction you have in the lower body, the better. Being able to catch yourself if you start to fall is a big plus, especially with all the dust concerns. So good mobility, stabilization is important.
One of the biggest technological challenges for going back to the moon is the dust particles, which are like the consistency of talcum powder. They sieve through any fabric. So the fabric has to be coated or solid against the intrusion of dust particles.
A lot of the lessons learned from Apollo need to be applied and incorporated. So greater mobility, reduced mass, greater connectivity for the astronauts. They need a better ability to see what is going on with their suits, communicate with each other, because as we continue to go further and further from Earth, you're going to have all of that capability really self-contained. Crew members need to be able to operate somewhat independently from Earth.
Something else that suit makers have to consider is the length of time that astronauts will be spending on missions.
When we think about, some of those longer duration missions, some of the other aspects that we've incorporated is really just the maintainability, the ability to do maintenance at lower levels and enable that work to be done at the destination. So we've incorporated modularity and open architecture, so as new technologies are introduced, they can be incorporated into the suit.
Under the contract stipulations, NASA has asked Axiom to deliver the suits for its Artemis moon mission by August 2025, while Collins' ISS spacesuits are scheduled for delivery by 2026. Prior to being worn by astronauts on missions, the suits have to undergo extensive testing.
We require crew member testing in the pressure garment to make sure they're meeting the mobility requirements. And then we also require testing what we call relevant environments. So that could be a thermal vacuum chamber, that could be in the NBL, that could be actually testing on orbit on space station.
Since NASA is purchasing its suits from Collins and Axiom as a service, the vendors are free to make additional suits for non-NASA customers as well. Though Collins would not disclose the names of any of its other customers, the company says it's speaking with about 8 to 10 companies who are interested in their spacesuit services.
New customers that we're looking at are not just the current batch of commercial space customers. There are countries that are looking to be involved in space that were not in the past able to participate. And as space commercializes and becomes more affordable, those countries now have the opportunity to step in.
Romero also predicts that the design of these new spacesuits will continue to evolve to fit the new use cases of its broader customer base.
Today we use it for maintenance and repair, very little for experiential activities where you're going out and doing space tourism. That's really not a part of EVA today. But that probably will become a part of EVA in the future. Future programs will have more interaction with robotics. So our suit needs to be in a position to be able to communicate with the robotic systems and be able to safely operate around a robot.
And it could be big business. The space tourism market is poised to reach $4 billion by 2030. NASA is also looking beyond commercial companies for ideations of future spacesuits. In 2020, Pablo de Leon and his team at the Spaceflight Laboratory at the University of North Dakota won a $750,000 NASA grant to develop a new 3D printed spacesuit prototype for Mars and beyond. De Leon has worked on a number of NASA spacesuit projects in the past, but says this one's a little different.
Some of the advantages will be first to make replicable manufacturing. The second will be that you can scan the body and then build a suit that will be specifically designed precisely to that particular astronaut. And the third one is that once that our space flights go farther away from the Earth and we go, say, to Mars, for example, we're more than 1 year away from our planet. And if we need a replacement, say a glove, a boot, any other part of a spacesuit, we're 1 year away to get that replacement. So what about if you can build a machine that will put together your suits and you bring that machine to Mars?
De Leon adds that exploring the surface of the Moon and Mars will likely mean that astronauts will be using the spacesuits much more frequently.
Going back to the Moon will require that we'll do explorations almost every day or every 2 days. The same for Mars.
Spacesuits, I think they kind of hit a nerve with people just because there's a very human element to them. It's exciting to work on something that's so critical, that keeps crew members alive and safe. I know it's a big responsibility that we feel every day when we make decisions in the designs. Yeah, it's really exciting.
I don't think a space needs to be a perfect representation of what we hope a simple mind looks like. I think a space should be an imperfect representation of the people who are in it and wherever they're at in their life at that given point. A lot of different types of people have come in here, and most everyone likes the way this looks. At least that's what they say. Maybe they're lying, whatever. This place hasn't been a laundromat since 2005. It hasn't been any sort of functional business in 15 years. I'm Samson, I'm 27 years old. I live in Maspeth, Queens, New York City, New York State, and I pay $1,850 to live in a laundromat. Welcome to my apartment. I'd lived in a warehouse in Chicago, and I like the freedom of a commercial space, even though there's definitely less tenant rights, but something feels more ethical about moving into a vacant storefront that's been empty for years than taking up an apartment in some residential neighborhood that you're not familiar with. So I was looking on ArtCube and the Listings Project, and I'd found this space. I came inside and I looked, and I was with my girlfriend at the time, and she was like, that place is disgusting, and it was disgusting. But I moved in the next month. Laundromat. I moved here in March of 2019. When I moved in, the rent was $1,750, and so I paid 2 months rent up front and a security deposit of $875. I end up paying like an average of $120 for electricity and I think $60 for internet. This is the laundromat, or at least it was at one point. Now it's just this. There's a kitchen over there and a bathroom over there, but aside from that, this is most of the space. This is my organ. I got it on Craigslist Free in Connecticut. If you're ever looking for an organ, go on Craigslist Free. I work in production design, so I get a lot of free furniture afterwards. Everything has to go when the project is over. Make yourself at home. This is the bed. I built this when I first moved in for optimal sunlight reception. I think I built this thing for about 25 bucks. That's why it looks like it does. This is the sign from the original laundromat. I think it's from the 80s originally. This is my little reading nook. I'm not reading too much these days, but I've started all of these books. Of course, the laundromat didn't originally have a kitchen, but the guy who was here before me built it himself. It's a little small, but I have all the basic necessities. I got a big sink and a little stovetop and a little oven, so it works. It's my little songwriting station. This piano, also a Craigslist Free find, and most of the things on it as well. What is that? What is that? What are these? What are these? What is that? What is that? What are those? What are those? Blast, 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 blast. This is my shower. I didn't intend to move into a place with a window in the shower, but the place kind of came like this. This was kind of the most carefully placed feature in the whole place when I arrived. They put in a lot of effort to install a window. Yeah, this is how people get a hold of me. I'll be right here, and I get a knock. I say, hey, and I come outside and we talk. The fridge has been here since 2020. A nonprofit brought it by after I said that I was interested, and it's been sustained ever since. It's not really filled by nonprofits anymore, but it is filled by the community, and people here do eat from it as well. We got some bread, and some pink salmon, and some paper trays. Sometimes it's more full, sometimes it's less full. I grew up on a commune in Texas, but it was not a cult. David Koresh was not there. It was a humanitarian organization, a nonprofit humanitarian organization. and we did a lot of disaster relief and homeless outreach. But most of the people I grew up with had virtually nothing. They were all dirt poor, but they lived together and they helped each other, and money just wasn't really a part of it because we just helped each other out. I got mugged in this neighborhood a couple months ago. It's not always safe. Stuff has been stolen, but I'm largely protected by my neighbors. They all look out for me, and I couldn't do this thing. I couldn't leave my door open. I couldn't have a fridge out there. I couldn't have a bench outside or a table if I didn't have my neighbors looking out for me. I've got Gabe and MZ and Paul and Aaron. Dave sometimes opens my door at midnight and he's like, lock your door. And so I'll lock the door because Dave tells me to. I don't even remember to lock my door half the time. And so sometimes these people are looking out for me more than I'm looking out for myself. And that's true community. I knew true community as a child, and I know it again now. And it's been a while since I've seen it, but it's so wonderful to be in a neighborhood of people that know each other and look out for each other. It's incredible.
Samson.
Hey, buddy. Good to see you. Good to see you. Jans Danch.
What's up, baby?
Olga Manita. Jack. Come on in, guys. The space primarily is a collaborative space for creation and recording and interaction. I just live here right now because that's what I can afford. But eventually I'll move out of here and it'll be just a studio space. It'll be just an open store for whoever wants to come in and learn to paint or continue a painting or learn to record a song or continue a song. It's for beginners and people who are already passionate about what they do. Living in a storefront has taught me resourcefulness in a way that I've never known before. I really can't be too picky about what comes my way. I just have to make the best of it. And that's the greatest skill that I could ask for. It's nothing that I could teach myself. It's something you can only learn from life. And that's really in line with the life philosophy I have.
We were shocked at how high the rent increase was. My flatmate and I wouldn't be able to afford that increase based on the jobs we have and what we currently earn.
We love this area and we've lived here for the past 6 years. We desperately wanted to stay and we were more than prepared to stay.
London rents increased by 17% during 2022. That's the highest year-on-year increase the city has recorded since 2007. On average, London's renters, who are single earners, spend 48.4% of their income on rent. In 2021, that figure was just 42.7%.
Many renters are fighting their landlords on proposed rent increases or are being forced to move as they can no longer afford to pay rent for their homes.
Upon closely reading the tenancy agreement with our other tenants in the building, we realised that together we could communicate in a way that would challenge the process of the proposed increase.
There was no way that we could afford to heat or eat on that budget with our rent probably being about a good 90% of my pay packet.
There are also no rent controls in London, meaning that landlords have the power to charge as much rent as they think is reasonable and can get. In a highly competitive market with more demand than supply for rental properties, this has led to sky-high prices that are unaffordable for many. Renters can try to negotiate or say no, but then they run another risk, being evicted.
My name's Daniel Lloyd, I'm 26 years old and our landlord has proposed to increase our rent by 27%.
My name's Dave Trauner, I'm 33 and our rent went up 26%.
So, how did we get here? And what does it all mean for renters in London? London is a city of close to 9 million people spread out over around 607 square miles, which is about twice as large as New York City. From skyscrapers in the city centre to family homes in the suburbs, it is a highly diverse city and an international hub.
Inner London covers the sort of central part of London. It covers an area that's sort of maybe 20 to 30 minutes commute by public transport. It covers all the international areas. When you get out into the suburbs of London, which is far more of a market dominated by houses, maybe sort of 35, 40, 50 minutes commute out of the centre, rents fall. So, moving into outer London, there's better value for money, and so you get people on higher incomes moving there. The other thing I'd also add is London's seen a lot of improvement in public transport, so we've also opened up new markets.
Strong transport links are one of the advantages Daniel and his flatmate enjoy about their home, which is located in outer London.
London is just the best place to live. There are so many things to do, outdoors and indoors. The transport links are fantastic and enable us to get to all sorts of different places, to see different people, to meet different people.
Daniel and his flatmate also have to live in London for their jobs.
We love the city and the opportunities that it gives. For me, as a reporter, I travel a lot to motor races, therefore I need access to London's airports.
As a writer and comedian, Dave's job also ties him to the city.
I unfortunately don't really have too much choice in where I'm based, so I have to really be in the capital. I love London. It's absolutely incredible. I think it's a beautiful city to live in, and to be honest, I think it gets better as time goes on.
When the pandemic happened, lockdowns meant that London was suddenly much less attractive to live in. Restaurants, bars and activities were shut down, and working from home meant people no longer had to live in the city to commute to work.
So what we saw over the pandemic was a big hit to demand. People couldn't travel to the UK, offices were closed, the economy effectively shut down, and the supply of rented homes increased as landlords who typically rent properties to tourists and short-term visitors put those homes into the long-let market. And so we saw rents fall by about 10 to 15%.
The market was on the side of renters, but as London and the world reopened, the dynamic on the rental market shifted, with prices soaring. In December 2022, the median asking rent for a two-bedroom flat in London was £2,400, compared to £1,900 before the pandemic.
We started 2021 with a massive oversupply of properties. In some parts of London, there was a 50-60% increase in properties on the rental market. So prices were still 20% down from kind of 2019 levels. The demand and supply curve had definitely leveled out, which then brought the beginning of 2022, which was completely different, and the demand was high, and then the stock levels have dramatically reduced.
Daniel lives with his friend in a 2-bedroom flat in southwest London. They moved into the flat in November 2021 and paid a total of £1,400 a month. In October 2022, their landlord proposed to increase their rent by 27% to £1,775. The issue is not just affecting them, but almost everyone living in their building.
We understood that some people in some flats were having their rent increased by £100 per person. That prompted us to knock around and gather people's numbers, get a group chat together on WhatsApp to discuss our rent situations. And it was there that we found out that people were facing increases in excess of 25%, some as much as 30%.
Daniel and some of his neighbours also have a clause in their leases that limits by how much rent can be increased, and believe the landlord's initial suggestion would breach this. They reached out to their property manager to negotiate the increase and received a new offer of £1,750 a month, only £25 less than the original suggested rent increase. They continued to push back, but have not heard anything new from their property manager.
We have used the time to get legal aid from other organisations that are involved in renters' rights, so we have an idea of what directions they could take, but ultimately we're currently sitting, waiting, nervous to see what they're going to say.
High prices and low supply have led to fierce competition amongst renters, who now often feel they have to go to great lengths when trying to secure a property.
We often don't have to ask tenants to offer over asking price. They just offer over asking price because they've lost out on the last 2 or 3 properties that they've bid for. They're offering long leases. You're realising that, they probably don't want to be looking again in another year. I mean, they send us in bios, they send us in pictures. Applicants have got pets, send us in pet CVs.
Many people here in London are feeling overwhelmed with the task of finding a new home. Properties are disappearing from real estate websites within hours, so people need to react to new listings immediately. Scrolling through online property listings, you might find flats advertised for 2 people, but with bunk beds, or rooms so small the door doesn't fully open before hitting the bed frame. These flats now seem to cost what generously sized spaces did just a year ago.
So supply and demand are really out of kilter at the moment. On the supply side, the average London estate agent would typically have had 17 to 20 properties for rent on their books. That's down to 10 or less than 10 at the moment. So there's a real scarcity of homes for renters looking to rent. And now the economy is opening up. Tourism has restarted. We've also got mortgage rates increasing in the UK.
The market is driving this, not estate agents and not landlords. And I think that's probably the misconception. Tenants know they've got to spend over the asking price. We're not necessarily asking them to do that. They are coming forward with a really good offer because they know if they don't offer that, then they're going to lose out.
Many of London's renters, including Dave and his partner, have been forced to move. He has been living in the city for around 11 years and lived in his previous flat in South London for 6 of them. Dave and his partner paid £950 a month for the 1-bedroom flat, but in July 2022, his landlord proposed to increase rent by 26% to £1,200.
We were surprised at how much the rent was going up, and when we said, look, I think it's reasonable that there is going to be inflation. I think it is reasonable that prices do go up. We will negotiate at, say, 15%. Does that sound good to you? And they said, absolutely not. It's 26% increase or nothing. I think paying the higher rental price was absolutely never an option. But also the fact that the landlord had so openly showed a disregard not only for our well-being but also our safety and health. There were people using drugs on our doorstep, there were people urinating on our doorstep as well. They'd set up our gas meter wrongly and also, I think, unsafely as well.
Many of London's renters are still facing an uncertain future as pressures on the rental market are not expected to ease.
Well, I think we've seen the worst of the big increase in rents that we have. But I'm afraid I think rents are going to keep rising at a reasonably rapid rate, maybe in the 4 to 5% bracket, largely because we just don't have enough supply coming through. We really need to see more supply in London. A lot of that's going to come off new build development.
My advice would be to act quickly. You know, it's really important that the references are completed within 24 to 48 hours. It's really important that the contract is signed within 24 to 48 hours. So I would advise renters to think hard about what they'll compromise on, because there will definitely have to be a compromise.
After saving for over a decade, Dave and his partner were able to purchase a flat together on the edge of inner London. Their monthly mortgage is now lower than their increased rent would have been.
We were incredibly fortunate in order to be able to buy somewhere, and I know not everyone is that fortunate as we were, but the difference is now, instead of paying rent to pay somebody else's mortgage, we're now paying our own mortgage to hopefully one day, when the year 3000 comes, to actually pay off our own mortgage.
Dave is also hopeful that there will be long-term savings, as him and his partner can maintain the flat well and make small repairs themselves.
In the long term, actually owning our own flat and being able to nip things in the bud and maintain the place as it should be will actually save us more money.
However, buying a property is not an option for the majority of renters in inner London, as the average property price is £638,000. Daniel and his flatmate are not sure whether they will be able to stay in their current home, so they have been looking at listings for rental flats.
It's difficult, admittedly, to find a 2 double-bedroom flat in London because space is at a premium. However, we have found a few things a bit further out. We would lose a lot of our transport connections that we have to central London.
Paying the higher rent would be impossible for Daniel and his flatmate.
The only other options would be to move back to our parents' houses, but we're 26-year-old professionals. It wouldn't be fair on our parents to do that. So we're determined to remain in our current property, to fight back against the landlord, and to state our claim and get a level of increase that is acceptable and not at the high levels that they've been proposing to multiple people in the building.
This is Solo Stove, the brand known for its smoke-free backyard fire pits and camping stoves. Started in 2011 by brothers Jeff and Spencer Jan, Solo Stove has grown from a Kickstarter campaign to a $2 billion valuation when it went public in 2021.
I remember in that first conversation with them, Spencer and Jeff telling me that they had reinvented fire. And I thought, man, that's a bold statement. I mean,
the fire pit marketplace, as I'm sure most people can appreciate, is one that has really not seen any innovation over time. And Solo Stove came in and provided this sort of upgraded technology, upgraded innovation.
It's a company similar to Yeti, with its products available in a variety of sizes and prices. Entry-level stovetops and fire pits start around $100, while the largest fire pit, the Yukon, retails for $750.
The argument has always been that no one would buy more than one Yeti cooler. But what Yeti has done a nice job is introducing a wide portfolio of products.
Solo Stove was a pandemic-era winner as people sought more outdoor activities.
I love Solo Stove. I obviously love fires, and Solo Stove just takes that backyard fire pit experience to the next level.
With manufacturing overseas, the company has battled supply chain and freight issues while demand has soared.
I think we're through the woods on the supply chain challenges. It was kind of an 18-month-ish type dilemma that brands were facing, and we're looking forward to 23 and beyond and being able to meet customer demand.
Here's how Solo Stove turned backyard fire pits into an outdoor lifestyle brand with over $400 million in annual sales. This is Suddenly Obsessed.
So the story all begins in a garage. Spencer and Jeff, two brothers, love the outdoors and were looking to start an e-commerce business. And they were just tinkering around with things, looking on YouTube, and they learned about this thing called secondary combustion. This idea of basically getting warm air to circulate inside of a stove and ultimately combust.
In simple terms, the secondary combustion process creates a higher temperature fire with a cleaner burn compared to an open fire. This is the key to its technology.
The original Solo Stove was an ultralight backpacking stove that could boil water in under 8 minutes using just twigs and leaves and sticks out on the trail.
But customers wanted more. By 2014, the brothers launched 2 larger sizes. 2 years later, a backyard fire pit was released, known as a bonfire. Launched on Kickstarter, the company met its goal of $15,000 in just 2 hours, eventually raising over $1 million.
Solo Stove is probably most well known by its fire pit line. The Bonfire is our most popular, it's the mid-size. But what's unique about the Solo Stove product is that it burns nearly smokeless. So rather than sitting around your fire pit playing musical chairs and wondering how the wind knows exactly where you're sitting, you can sit around a Solo Stove for 4 or 5 hours and not smell like a campfire.
Randy Griffin lives in Dallas, Texas, and purchased the Solo Stove Bonfire in March 2019.
My dad had barbecue restaurants, so I kind of grew up in smoke. A fire has always just been a calming, really peaceful place for me. And so it was my 40th birthday. My wife we wanted to have a big party on my back patio that we had just built. And she was like, "Are you gonna have a fire?" And I'm like, "Babe, it's my 40th birthday party. Of course I'm gonna have a fire." So I started Googling smokeless fire pits and all of that. Solo Stove came up. And for my 40th birthday, I got my first Solo Stove. It was a huge hit.
To scale the business, John Maris was brought in as CEO in 2018.
What I thought was just so cool that Spencer and Jeff had done is they had made it accessible for an everyday person in a neighborhood, in a town, to be able to have a campfire type experience without having to have a 50-acre ranch.
Maris's resume included leadership positions at several Texas-based companies. He saw growth potential far beyond Kickstarter.
I'd scaled a lot of businesses from a growth perspective, and I saw opportunities really everywhere. E-commerce still felt really early and untapped. I saw opportunities in wholesale and retail for us to start partnering with brands like Dick's Sporting Goods and Academy and Ace Hardware, some of the partners that we actually have today now.
Solo Stove, from its origins, was always a direct-to-consumer brand, so it did rely heavily on word of mouth. Oftentimes, when you're using Solo Stove, you're inviting people over to your home. Then friends and family see this for the first time. You talk about the product, they get to experience it. Then over time, as the company started to make money, they began to lean into performance marketing and target consumers via various social media platforms.
Solo Stove generated about $16 million of revenue in 2018. That jumped to $39 million in 2019, Maris's first full year at the helm. And then came the COVID-19 pandemic.
Solo Stove became an obvious go-to to try to kind of break up the monotony of your day or all the screen time that we were all experiencing during that time.
I think Solo Stove was starting to get some traction before COVID, but the flame really took off with COVID. But unlike many other consumer products, it didn't reach any level of saturation or wasn't already highly penetrated.
So much of our business was coming from word of mouth. And when we went into the pandemic and people stopped being able to really spend a lot of time with friends and family because there weren't a lot of gatherings happening, we actually saw our referral rate go down. So the increase in demand was offset somewhat by the reduction in the referral rate.
So I'm a realtor here in Dallas, and I think the Solo Stove is a perfect housewarming gift because right now, especially post-COVID, people are buying a house not only for what's on the inside, but the outdoor living space.
Solo Stove finished 2020 with about $130 million in revenue. The following year, it formed parent company Solo Brands after acquiring outdoor brands Chubbies, Oru Kayak, and Isle.
We started getting introduced to other brands that were using outdoor and other means to do the same thing that we were doing. We thought, man, these are brands rather than just collaborating with, we'd love to just partner with.
With Solo Stove as its flagship company, Solo Brands went public in October 2021.
I bought right at the IPO price, right when it came out, and then it dropped significantly. I think it was like 20 bucks a share. I put a couple $1,000 in, and now it's, I don't even know what it is, $4 or $5 a share.
Solo Brands is priced at $17 a share under the ticker symbol DTC. It reached a high of $21 a share shortly after its IPO and currently trades around $4 a share.
I'm more sanguine about number 5, though, Solo Brands, the outdoor products company with a stock that sells at 10 times earnings. I like that.
The four companies generated about $404 million in revenue in 2021, with Solo Stove accounting for about 70% of Solo Brands. Through the first 3 quarters of 2022, Solo Brands has generated about $320 million in revenue.
When we look at the first full year as a public company, which would be 2022, the full numbers for the year aren't quite out yet. The company guided the full year revenues to grow 15 to 20%. For a company that saw such exceptional growth from 2020, 2021, to actually grow again in 2022, and kind of growing on top of all this COVID demand, in my view, is fairly impressive.
Despite this growth, Solo Brands saw 2 key headwinds in 2022. The pandemic brought on a rapid and unexpected rise in shipping costs.
Almost all of the Solo Stove products are made in Asia, many in China specifically, and these are big, bulky items, and then they are transported via ocean freight to the US. And the cost of that just ended up skyrocketing and kept going higher and higher, and ended up becoming more of an expense than the company was anticipating. So they had to make some downward revisions to their gross margin as a result.
In 2021, Apple introduced privacy updates that allowed users to opt out of tracking activity across apps. It became much more difficult for companies to serve targeted ads on websites and social media platforms.
It disrupted direct-to-consumer company landscape overall in how they would go after and try to target customers and gain new customers. Overall, it's caused an increase in customer acquisition costs for many different types of companies, specifically direct-to-consumer companies that are still building a brand.
As Solo Brands enters its second full year as a publicly traded company, it looks beyond fire pits to capture backyards across the U.S. It's introduced the heat lamp, pizza oven, and the Mesa, its entry-level fire pit.
Costco is this new emerging partner that just started in the 4th quarter, so that should be a nice sales driver in 2023 overall. The Mesa is a product that was launched in the 4th quarter. That could be the gateway product for many consumers to get their first trial with Solo Stove.
We believe our market opportunity in the U.S. is probably 80 million households, and we're just very early in that story. Still haven't even hit the 2 million customer mark for Solo Stove. So we've got our work cut out for us, but lots of opportunity out there, lots of households still to get in front of, and lots of just brand awareness opportunities with people that don't know who we are.
I do think there is some concern with Wall Street investors that you have basically a publicly traded fire pit company. It could also just be a one and done. Consumer buys it and then they never have to buy another Solo Stove product again because it's stainless steel and it's going to last a long time.
I think this is what we've been doing for thousands of years. There's life in it, there's serenity in it, there's that place of calming and having real deep, meaningful conversations that a lot of times you're just not going to get around the kitchen table, but you start a fire and you're in your backyard, and life can get really sweet and you can go really deep.
I've been disabled my entire life, but disability wasn't like a big part of my life.
Stand clear.
I wasn't raised to think of myself as being disabled. I wasn't raised to think of whatever limitations I was gonna have out there. It wasn't until I graduated college that I realized, wait a minute, I have to adjust my thinking of the world around me and myself. A lot of us cannot subscribe to the hustle culture that has become our society. And it's not because we're lazy, it's because we're disabled. And that's something that I repeat very often. Disabled, not lazy.
My name is Tiara Simmons. I'm 39 years old. I make roughly $26,000 a year, and I live in Long Beach, California.
I am a law clerk, just turned attorney at a solo practitioner family law firm, and I just launched my own virtual law firm. I was raised as a ward of the court, which means I was not raised by my biological family. My parents struggled with drug addiction, and for our best interests, we were removed from the home, but luckily not split up. I was raised by a legal guardian and her sisters. I used prosthetics from K through 12. It was 20-pound prosthetic legs and crutches, and I couldn't carry anything, I couldn't hold anything, I couldn't walk upstairs. They broke often. They were painful. I found that for me, it became easier to just use my wheelchair. It opened up the world for me. I can actually get out and not worry about the 2 inches of snow that just fell, or the autumn rains, where I can't get a cab or I'm getting drenched because umbrellas don't work for me. Raincoats don't work for me. I thought California was my best option. So I've been disabled all my life. I wasn't born disabled, but I became disabled before I turned 1 year old. From what I was told, I had a blood infection and it caused gangrene, blood clotting, and they had to emergency amputate my legs below the knee, both of them, and a couple of my fingers on my right hand. I was clueless about this settlement until right before senior year in high school. When I found out about the settlement money, I don't remember being super excited, like, oh, I have a lot of money, I'm rich now. It was just more so, oh, okay. Only because I wasn't raised to put so much emphasis and value on money the way that I do now as an adult who has none. I was able to buy a house by the time I was 17 years old. I was able to travel whenever I wanted to. I had a beautiful apartment, 2-bedroom, 2-bathroom in one of the quote unquote luxury buildings with a gym in the heart of downtown Long Beach. Rent I could just pay. Sometimes I would pay 2 months in advance just to make sure that I didn't have to worry about anything. You know how when the recession hit, people woke up and they're like, my savings is gone, and they didn't know what to do with themselves? That's kind of how I felt when I found out the settlement money was gone. I woke up that morning knowing that I could pay my bills, knowing that I would have no problem paying rent. And by the end of that particular day, I just went into internal panic mode because I didn't work. My husband and I, for the most part, we split the bills. Most of my money goes towards the rent. His money goes towards all of the other bills. But we have a joint account, so really it's just whoever's paycheck hits first is who pays whatever bill needs to get paid. I do have SNAP, but sometimes that runs out, or sometimes the case is on hold. So we have to make sure we budget for those types of food emergencies. I take public transportation and I spend maybe $25 to $30 per month on a TAP card or a Metro card, they call it, and then just have some cash for the bus. My husband takes Ubers to work. There's no other option, especially because of his hours. We were spending at one point about $250 to $300 per month just for him to get to work. We don't save a lot. There's almost nothing to save. We work, we get our paychecks, we save enough for the rent, if that's going to count as savings, but just to have a savings, we don't really have that luxury. I do not have student loan debt, but not because I paid it off. It's because I received a total and permanent disability discharge of my student loans. That is only conditional, and is conditioned on me being at or below the poverty line for the inspection period. If I go above a certain amount of money per year, as far as my income is concerned, then they reinstate all of my student loans, all of them, with the interest attached. It's a rock and a hard place. Like, I can't afford to pay $400,000 in loan, but I also can't afford to not make any money. And, you know, as a law clerk, I already don't make a lot. One day, I want to be able to buy a house. Can't do that if I know that all of like $400,000 plus is going to come back, because then it'll be buy the house or pay the loan. Living with a disability is very expensive, especially when you don't have resources. Because of wheelchair repairs, I have to miss work. Sometimes my husband might have to miss work. So we lose money. Besides just spending money, we lose the opportunity to make money. My ultimate goal is to be a public defender for LA County. It's not something that people hear and they're like, you want to do what? No, I want to be a public defender. I want to work with indigent clients. I want to work for people who might be in situations financial, like I am, who have found themselves in some trouble, but they can't afford the downtown law firm. It's just interesting because a lot of people, you know, when they found out that I want to be a lawyer and then that I actually became a lawyer, they just started saying cha-ching, cha-ching, like as if the money was going to roll in. And I'm like, that's not how it works, you know, unless I go to big law. But I don't want to work in big law. I want to work for the everyday man or woman, person. I'm not rolling in the dough right now, and I probably will never be rolling in the dough, but I know that, you know, as long as I can survive and as long as I'm doing what I think is my mission in life, I'm okay.
When I first moved to New York in 2017 with Yana, I had told her that in my life, I would like to do a solo show in Chelsea, Manhattan, and then retire. And I thought that would take me about 40 years, right? And it ended up happening in 4 years.
I feel absolutely great doing what I'm doing today because that was my biggest dream for 5 years. And I learned that everything you do is worth something, and don't fake it till you make it. Make it till you make it.
The gallery that's representing me is called Sugarlift Gallery, and that's where I have my solo show once a year. So I have to produce about 25 paintings, which is a lot. These paintings are taking me about 100 hours each. So my week could look like I'm just painting throughout the day, and at some point I have to go to New York City, drop off a painting to Sugarlift Gallery, let's say, or to go gallery hopping Thursday nights, or to be conducting a workshop. It's definitely a very isolated job that I have, where I just find that throughout the day, I'm painting very early in the morning, using the natural light from the window. I'm listening to music, I'm listening to audiobooks, and I'm just fully focused on the paintings that I'm making. So the painting that's behind me right now is priced at $30,000.
So as soon as we moved to New York, I was looking for a job. At that time, I had no documents yet. So one of my friends advised me to get an Instagram account and start just writing my story about how I moved to the United States. It was a very lifestyle kind of blogging at that time. As soon as I got my work permission here in New York City, I applied to a lot of different companies, and one of them was Tiffany & Company. So I just went for it because we really needed money at that time. And I was working there in total 4 years, I think. What happened next is that all this time I was trying to boost my blogging career, and at some point I realized that if I'm not gonna leave my full-time job now, I'm never gonna be able to make this jump because it's never the right time. Honestly, before I was not making any specific concept for my videos. I just started rolling. Whatever comes out, I will just spend 6 hours on editing and I will put it together some way. But then when amount of collaborations and sponsored videos started to grow, I realized that I need to come up with a plan.
So I'm the saver in the relationship.
And I'm the spender in the relationship.
So we file a joint tax return. All our expenses are just one, basically. Our bank accounts are all shared, our credit cards are all shared.
We are one.
As one.
That's how we feel. So I believe our budget really varies from month to month because we live a very dynamic lifestyle. For example, in November, we spent a lot of money on travel because I had several business trips and I like to bring Lucas with me. I'm also always coming to all his business trips. We have an opportunity today to keep our expenses low is because I'm getting a lot of things for free as an influencer. For example, if we want to go to a restaurant in New York, I just can contact them and they will be happy to accommodate us. Basically everything, starting with clothes, ending up with makeup, shower gels, shampoos, everything you can possibly imagine, even furniture, I can get for free, which is amazing. And it can be a paid collaboration when I'm getting like money on top, or it can be just trade. But I'm still spending money on clothes, I'm sorry. I have to say this, like nothing gonna stop me.
I was born and raised in Los Angeles, and I had an interest in art at a really early age. So after I took that figure drawing class, I really understood that I wanted to keep this going. And on the side, I was a child actor. One of the most noted roles that I played was an extra in Magnolia with Tom Cruise.
I was born in Russia. I grew up in Moscow. I came first to the United States when I was 21 years old, and I just completely fell in love with American culture. And at that time, I set my mind to come back here one day. So we decided to move to New York basically because Lucas wanted to start Grand Central Atelier School in here, and I always just dreamed to be in New York because I felt like this is the top of the world.
So my mentality in being a saver really stemmed from my parents. They were always making really safe real estate investments. Back then, when I had made that investment in 2017, the prices were really low. So I ended up negotiating this apartment. I was a cash buyer, so I paid in full. I ended up purchasing this apartment at $184,000, initially listed at $215,000. Really provided a nice stable income that added on to our really expensive rent in New York.
And I think we both were very scared that if we're gonna move out of Manhattan, our careers will be ruined. Like, I don't know where we got this fear from, but I feel like people who living in New York, they feel like it's really important to live in New York because this is where things happening.
Yeah, and I also remember this fear, right, of if you have this shipping address in Jersey and not in Manhattan, and
no one will collaborate with me.
Yeah, no one's gonna collaborate with.
They will know I live in Jersey. This is it. I'm not gonna be a fashion blogger from New York anymore. And honestly, we moved here and we're way much more calm right now, and we have more time to dedicate to our careers, and we have our own spaces, creative spaces, which is very important for both of our jobs.
In terms of savings, at the moment, we don't have a very large savings account. We just did a renovation, and a lot of what we had saved just went straight into the renovation.
Yeah, renovation is a black hole, guys. Like everything goes into renovation always.
Yeah.
Definitely our next step this year is that we're going to accumulate some cash in order to just feel more confident and have more freedom of taking a day off. If you have savings as a freelancer, this is when you can choose which projects you really want to work on or what you're doing out of necessity. Me personally, I want to get deeper into filming. I want to kind of start a career as a director and creative director. Participate in more creative, not so much commercial projects.
This year I actually would like to sell in a higher price range, and my goal is just to sell just a couple.
We're both at this stage right now in our careers where we still have a bit room to grow as an artist, as a blogger. I think we both learned that investing in ourselves, it's a great way of investment. I personally believe it's the same as investing in stocks. We will expand our family at some point, but we're not planning to stop in our careers. Obviously, there is so much more to do. There is so much more money to earn. Yes.
Yeah, definitely have kids one day with Yana, and also to just keep doing what I'm doing, always doing bigger and greater shows and improving.
This is no ordinary aircraft. It's an electric vertical takeoff and landing vehicle, or eVTOL, and it could have a major impact on the aviation industry.
For the first time, you can build aircraft that are not only low cost, but also really safe and really low noise.
An aircraft that's going to create great utility for short distance trips. 30-mile trips can be completely carbon-free.
Vertical lift aircraft are nothing new. The first helicopter took off more than a century ago. Today, the helicopter market is valued at nearly $49 billion and is expected to grow to $74 billion by 2029. About 40% of helicopters are used as private air taxis, but high costs have kept them from going mainstream for the average traveler. The introduction of eVTOLs could change that.
Helicopters are very expensive to operate for a number of reasons, but the biggest reason is that they have multiple single points of failure, which eVTOL aircraft won't. The electrification makes the aircraft safer. A safer aircraft also becomes less costly to maintain.
And while the eVTOL market is just emerging, some are optimistic it could be huge, reaching $57 billion by 2035.
They have incredible benefits over helicopters. I think over time, eVTOLs will make helicopters obsolete.
Helicopters introduced incredible utility to aviation, enabling new types of missions impossible for fixed-wing aircraft. The electric revolution is set to shake up the industry again as eVTOLs come on the scene.
Vertical takeoff and landing gives really an unmatched capability, and this is absolutely essential when we're dealing with mission-critical services, paramedical, reaching really remote areas, and this is the true value add of a helicopter. What happens when it becomes an eVTOL, it actually creates a new opportunity, and it also comes with some trade-offs as well.
Electric propulsion is the key element that completely changes how these aircraft fly.
With these vehicles, you can actually scale down the motors, and you can have many motors on these vehicles, making them not only just really efficient, but also really safe. The speed at which you can spin those propellers can be dramatically slower, and when you do that, you completely change the noise profile. And so these vehicles now, when they fly overhead, will be nearly silent to people on the ground.
Another advantage is that these new aircraft will be easier to pilot.
Much different than helicopters, and because of that, we think you have this new category that can be very attractive to young new pilots.
Operating costs are expected to be lower as well.
The fuel is going to be electricity, so the fuel is going to be relatively cheap.
Electric vehicles are powered by electric motors, which are much more simple than combustion or piston engines. That really enables much lower maintenance cost, which ultimately leads to much lower direct operating cost, which in turn transfers to low ticket prices.
Blade operates a rideshare service transporting up to 4 passengers between Manhattan and New York City airports for $195. eVTOL companies, on the other hand, are making big promises of pricing similar rides somewhere in the range of a premium Uber.
If you could imagine a trip from downtown Manhattan to Newark, those are typically a $100 type of ride.
Uber, which is investing in eVTOLs with startup Joby, estimates that operating a helicopter that flies 700 hours per year costs about $1,800 per flight hour. That would drop down to about $1,250 per flight hour if it flies 2,000 hours per year, a common target for how much eVTOLs will fly.
The key to get the cost per passenger down is to utilize the aircraft at a high level throughout the day. Our model suggests that we can make money and we can bring a great customer experience at that Uber Black level. As we fly more and more aircraft out of the same fixed infrastructure, we think we bring that down to an Uber X-like pricing.
The price point will also depend on the price of the actual vehicle. And so far, the value that we've heard from the market is between 3 million and 5 million. If you compare that to a helicopter that is currently serving that, they come in at, say, about 4.5 million, something like that.
But for now, the power and capabilities of helicopters are still superior.
Emergency medical services, it's search and rescue, it's law enforcement. For those type of missions, you need a certain payload and you need a certain range to be able to do it. At the moment, the eVTOLs are very far from achieving that payload range combination.
Over time, in the not too distant future, batteries will keep getting better. And as they get better, we will just continually upgrade the performance of our vehicles.
We should not try to replicate what a helicopter does with what we want from an eVTOL. eVTOL starts from a point of decarbonization. eVTOLs also start from a point of simplicity. So simplicity in design means it is simpler to maintain, simpler to certify, simpler to operate. So all of this creates then a very new market potential.
Airbus, which is developing its own eVTOLs, says they'll be used first for short-hop routes like air medical services, ecotourism, and passenger shuttle services.
Scheduled shuttle services, so the airport to downtown where it's really a time-saving, it is a predictive service, corporate shuttle services, right? Really taking to industrial parks and corporate locations. The beauty of these types of services is there is almost a very steady demand.
The eVTOL market is growing rapidly, with an estimated 200 companies attempting to create them worldwide. One of these is startup Archer Aviation, based in Palo Alto, California. It's taken a development approach that's oriented around the fastest path to market.
From the very beginning, we had a focus on commercialization because we wanted to build the most simple vehicle that could get that done, because that's the fastest way to do it, and we think the lowest risk way to get the vehicle certified.
The company's been spending the last 4 years developing a demonstration aircraft called Maker.
We call it our certification test bed. So we use that vehicle to work with the FAA in order to establish these rules to which we'll certify to. We also use that vehicle to prove out some of our core technology.
It just recently unveiled Midnight, its passenger aircraft intended for mass production. The vehicle is designed for a pilot and 4 passengers, with the ability to fly up to 100 miles at speeds up to 150 miles per hour. But it intends to service much shorter distances.
We actually don't think we'll be doing very many 100-mile trips because most of the demand will be replacing these 60 to 90-minute trips on the ground.
Designing and building an entirely new aircraft is expensive, costing millions or sometimes billions of dollars. To help finance its ambitious plans, Archer was one of the first eVTOL companies to go public via a SPAC in 2021, raising just over $850 million.
It's going to take a lot of money to bring these vehicles to market, but thankfully we timed it pretty well and we were able to team up with some great investors that supported us.
United Airlines is investing in eVTOLs through 2 companies, another startup called Eve Air Mobility and Archer.
Archer has an incredible design in their Midnight aircraft. I think they're ahead of the competition in many ways, pursuing FAA certification. Embraer has spun out a company called Eve that is going to be focusing on their eVTOL initiatives and are very well positioned within the aerospace supply chain to be a leader in this emerging air taxi market.
They've really been more of a partner to us. We also formed in a joint eVTOL committee where we're working on things like setting up our operations. We're working on how to develop Archer's maintenance plans. They even helped us in our design as we thought about how to build a vehicle that not only could be scaled, but also operated.
United and Archer recently announced plans for a 2025 launch of air taxi service in New York City.
We're going to be flying from downtown Manhattan at the heliport that exists there already to Newark Liberty International Airport, which is one of United's main hubs. It's a route that millions of people already take every year. People are already going from Manhattan to Newark. And we know there's demand because we see it in rideshare every day.
We're going to add cities, and you'll hear more from us in coming months around initial launch cities. But think about the congested hubs we fly into in San Francisco, in Chicago, in Houston, and in New York, LA. Those are the cities that are going to benefit, where the distance between the downtown and the airport is not really that great. But because of congestion, eVTOL is going to provide great utility.
In addition to operating a rideshare service, Archer is also selling its aircraft.
We announced last year that United Airlines will be buying some of our planes. Not only does it help us finance the vehicles and finance the building of this company, but it also adds an element of safety and trust into the equation.
But to deliver on its promises, Archer needs to scale manufacturing significantly. So it's teamed up with automaker Stellantis, which has promised to help Archer with manufacturing and invest up to $150 million in the effort.
They have a lot of experience in taking a product that's making thousands of vehicles and really scaling that up to hundreds of thousands of vehicles. Stellantis also has a management team that has some aviation experience.
The manufacturing angle is certainly something that the eVTOLs will need to look at. The scale of the manufacturing is imperative to be able to achieve a lower price point.
We're actually nearly complete with our low-rate initial production facility in California, which is right next door to our headquarters in the Bay Area. We're doing that to build our first 10 aircraft, which will be used for the certification process.
Archer recently announced that it'll build its first large-scale factory in Georgia at the Covington Municipal Airport.
The Covington manufacturing facility was designed to be able to launch with 250 aircraft built within its first year, but then really scale up from there. So the first phase of the production really can take us up to 650 aircraft on an annual basis.
But there are some big hurdles that Archer and eVTOLs in general must overcome to get to market, the largest being regulatory. Certifying aircraft is an intensive process that can take years, even for proven designs.
The Airbus H160, that one took from program launch to delivering it about 10 years. Bell is developing a heavy helicopter, the Bell 525. That one was launched in 2012 and it is not yet certified. But perhaps the most interesting one that is more, in my opinion, closely linked to the eVTOL designs is Leonardo's AW609, is a tilt rotor. Now that program was launched in 1996 and it is still not certified.
Archer says it's been working closely with the Federal Aviation Administration to expedite the process.
We've agreed to a lot of the rules with the FAA, and we're going to start working now towards the testing part, where we are validating that we can meet those rules and meet those standards. The goal to get through certification is really centered around the end of 2024.
Public acceptance is also critical for widespread adoption.
We have seen programs being affected by public acceptance. We had a fatal crash by one of the large helicopters in the North Sea, and that helicopter is no longer operating in offshore service because people refuse to fly in it.
And while eVTOLs could offer some advantages, traditional helicopters are also looking to leverage the benefits of electrification.
Robinson takes a large market share in the corporate private sector, and they have recently completed test flights with its R22 with electric engine.
As we're developing our eVTOL, all of this technology is then advancing the decarbonization of our helicopters. We're testing on eVTOL and bringing back to the helicopters. So the entire improvement of the overall product line is advancing.
Infrastructure is another bottleneck. eVTOLs could leverage existing helipads, but new vertiports will need to be built to accommodate the big demand that companies are projecting.
If you look at most of the modern cities today, they're quite built up, like New York, like London, like Hong Kong. It is going to be quite tricky to make room for this kind of mode of transport.
We're not waiting on some new future technology, some new future battery that doesn't exist in order to make these vehicles work. You can come out to our flight test facility and you can watch these vehicles fly. When we start to launch, it's really going to open everybody's eyes to electric solutions in the air as a possibility and not as some kind of crazy story.
It's going to change the willingness to take short trips for sure for the business traveler. But I think in the fullness of time, it's going to actually not only change the way we work, but it's going to change where we live. We're going to start to see it change the world later this decade. It's really going to hit a steep part of the adoption curve, the S curve, in the 2030s.
We need the critics as much as we need optimistic people driving this forward, but I do think it does have a place in the future for sure. You can see it, all of the traditional OEMs are getting involved in the game, but I do think it's also really important to understand the challenges ahead. It's not going to happen overnight.
All right, we're loaded up and ready to go.
For the 275,000 drivers dropping off 10 million packages a day around the world, delivering for Amazon is a lot of work.
I've been tired, exhausted, long days.
The expectation is just go, 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 go at your own cost.
But a lot has changed since drivers in 2021 told us about unrealistic workloads, peeing in bottles, dog bites, and error-prone routing software.
We're checked in, we're ready to go. Got our little key fob.
For some drivers, it's changed a lot, now that 1,000+ electric Rivian vans are on the roads.
Heated steering wheel is amazing. This little guy is cool. It's like the 360 view. So far, so good.
We talked to drivers of the old vans and new, and went to Boston to see firsthand all the new tech Amazon says is maximizing safety and efficiency for a better driver experience.
One feature I really like is this big old light bar that goes all the way around the back.
In 2019, Jeff Bezos announced Amazon purchased 100,000 vans from California-based electric vehicle maker Rivian. It's one step toward Amazon's ambitious promise of net zero carbon emissions by 2040. Amazon started delivering with them in July. Now it says they're in 100+ cities like Austin, Baltimore, Chicago, Las Vegas, Nashville, and New York.
This windshield is absolutely massive.
Some drivers voiced early concerns about range, but Amazon says at up to 150 miles, it's not an issue. Now, Amazon's added thousands of charging stations at delivery hubs.
So this one's charging right now, but here's the craziest part. Are you ready? Look at all those chargers.
Rivian has faced some recent challenges, cutting back 2022 production amid supply chain and assembly line issues. Its stock fell so sharply that Amazon recorded a $3.9 billion loss on its Rivian holdings in Q2 last year. And some drivers are worried about the inconvenience and wait time for maintenance, which has to happen at official Rivian service centers or by a Rivian mobile service team.
I was waiting for this moment. Rivian truck, Rivian van.
Still, Amazon says it expects 100,000 Rivian vans on the road by 2030, although that's pushed back from Bezos' original pledge to have them all on the road by 2024. For now, most drivers are still in 110,000 Amazon-branded gas-powered vehicles, primarily Ford Transits, Mercedes Sprinters, and Ram ProMasters. Amazon wouldn't share how it determines which of its 3,500 delivery service partners, or DSPs, get Rivian vans first. Amazon's been using these third-party contractors to deliver its packages since 2018, allowing it to cut back its reliance on UPS and the U.S. Postal Service. Here's how it works. The DSP is the employer of the drivers, responsible for the liabilities of the road and the costs of hiring, benefits, and overtime pay. And they lease the custom vehicles from Amazon. Amazon covers the fuel and installs charging stations for electric vehicles, and offers discounts to the DSP on things like insurance, uniforms, and package scanners known as rabbits. In the 4 years since Amazon launched the program, it says DSP owners have generated $26 billion in revenue and now operate in 15 countries, including Saudi Arabia, India, Brazil, Canada, and all over Europe.
It's very easy to get in and out with, all of the different handles to hold on to.
Julietta Dennis launched her DSP called Kangaroo Direct in Baltimore in 2019. She employs 75 drivers and leases more than 50 vans from Amazon. 15 of them are Rivians.
Because they're so new and a lot of the drivers don't really know what to expect from them, some of them have been hesitant. But the moment they get in there and have their first experience, that's the van that they want to drive.
The Rivian vans are small enough that they don't require a special license to drive, although Amazon provides its own training to drivers before they can get behind the wheel.
So this is where all of the lovely cargo goes. We have 2 shelves on both sides to allow for more space. And then the lights at the top, very innovative to help us see the packages and the address a lot easier, especially at nighttime.
Brandy Monroe has been delivering for Dennis's Baltimore DSP for 2 years. She says the new vans make her job faster and easier.
The van has a 360 view of the, all sides of the van. Also on the inside, it has a route laid out for you right on the tablet. And then there's AC seats and heated steering wheel, so that's great.
Former driver BJ Natividad, who goes by Avionics on YouTube, says his non-electric van could get very cramped.
I remember one time I had 23 or 24 bags and over 40 oversized packages. I had to be able to figure out how to stuff that all in there within the 15 minutes that they give us.
When designing the vans, Amazon asked for input from drivers about what needed to be better. Now they're filled with features for comfort and boosted productivity.
In the back here, the shelves actually fold up and down, and there's still plenty of space to walk.
The Rivian vans have at least 100 more cubic feet than the Sprinter and up to double the cargo space of the transit vans Natividad drove in Las Vegas until he left in July. More space to better organize means faster deliveries while en route and room for more packages.
The bulkhead is automatic. As soon as the vehicle is placed in park, it automatically opens. So that helps to get easy access to the packages in and out of the van. Also, when you leave the van and you walk away a few feet, it automatically closes.
We did a lot of delivery system tests because as a woman, I want to make sure that the seats are comfortable for me and that my legs can reach the pedals. I can see over the steering wheel.
My Lee's team at Amazon built out the Rivian Center Console and its integrated software.
When we start to notice that you're slowing down, that means that we can tell you're getting near to your destination. The map begins to zoom in so you can begin to find where's your delivery location, which building, and where's parking could be.
The new vans have keyless entry and automatically lock when the driver is 15 feet away and unlock as the driver approaches. Above all else, Amazon says it's made changes to make the delivery job safer. A ProPublica report found Amazon's contract drivers were involved in more than 60 serious crashes from 2015 to 2019, at least 10 of which were fatal. Now, Amazon's put cameras and sensors all over the new Rivian vans, which enable warnings and lane assist technology that autocorrects if the vehicle veers out of the lane.
The steering wheel just kind of shaking when you get too close to something, the automatic braking that it has, the 360 bird's eye view just to be able to see everything around the van. There's just so many features that would really help cut back on some of those incidental accidents.
It's crazy. All the alarms, like look, there's a person right there and it just let me know.
There's an automatic parking brake, rollaway detection, and driver-facing cameras inside. Now, Amazon can issue warnings about unsafe driving practices as they happen.
Camera, Metrodyne camera, which has always been there.
Beryl Tomei helps run the technology side of last mile delivery for Amazon.
The in-vehicle safety technology we have watches for poor safety behaviors like distracted driving, seatbelts not being fastened, running stop signs, traffic lights. We've seen over the past year that a reduction of 80 to 95% in these events when we've warned drivers real time. But the really game-changing results that we've seen have been almost a 50% reduction in accidents.
DSP owners like Dennis get real-time alerts if their drivers exhibit patterns of unsafe behavior.
You know, something with a seatbelt or just something flags, then our team will contact the driver and make sure that, you know, that's coached on and taken care of and figured out, like, you know, what actually happened.
Some drivers told us the feeling of constant surveillance is unsettling. Dennis says it's not an issue for her drivers. No one's complained to you about that? None of your drivers?
Never.
There's no sound ever being recorded. There's no camera recording if the driver's not driving. And there's a privacy mode.
Amazon says privacy mode means the cabin-facing camera switches off, both when the ignition is off and if the vehicle is stationary for more than 30 seconds, and that there's no live video feed available to anyone.
One of the things everyone was so concerned about was that there would be a camera back here in the cargo area. There's nothing in there.
Another concern drivers told us about is aggressive dogs.
Customers out there, please restrain your dogs when you know a package is coming, okay? Please keep them inside. Don't leave them just outside.
One Amazon driver in Missouri was found dead in October, allegedly after a dog attack. Now, Amazon is working to increase notifications to both customers and drivers.
One of the other things that we're building and we're going to be launching is the in-app for drivers, so that they can actually then tag inside the app that, hey, this place has a pet. So that in the future, any other drivers that come to this house in the vicinity knows that, oh, there's a pet here.
Other Amazon drivers have been carjacked. Amazon says the keyless system will help safely prevent theft.
The EDV logic will allow the van to drive away without the key fob for a short period of time, thus keeping the driver out of harm's way, and eventually turning off the vehicle once beyond a certain range.
Providing drivers with more efficient and better detailed routes could improve safety too.
People are running through stop signs, running through yellow lights. Everybody I knew was buckling their seatbelt behind their backs because the time it took just to buckle your seatbelt, unbuckle your seatbelt every time was enough time to get you behind schedule.
Drivers in 2021 told us that when they cut corners, like leaving their seatbelt off or running stop signs, it was often because they were rushing to finish their deliveries after losing time because Amazon's routing software made a mistake, like not recognizing a closed road or a gated community.
Locked, can't get in, gate.
Turn left to enter a private road.
Amazon listened. It's been adding a huge amount of detail to driver maps, using information from 16 third-party map vendors and machine learning models informed by satellite driver feedback and other sources, like a new in-vehicle data collection system called Fleet Edge. In a few thousand vans now, Fleet Edge collects real-time data from a Street View camera and GPS device during a driver's route.
Due to Fleet Edge, we've added over 120,000 new street signs to Amazon's mapping system. The accuracy of GPS locations has increased by over 2.5 times in our test areas, improving navigation safety by announcing upcoming turns sooner.
Tomei says by the end of 2022, Amazon added 325,000 new stop signs, 180,000 traffic signals, and more.
We also added points of interest, such as coffee shops and restrooms, so drivers can find a spot to take a break within 5 minutes of a stop for about 95% of cases in metro areas.
There's nothing more clutch than showing up to your first stop, finding one of these. Let's go.
In 2021, Amazon had to apologize for dismissing claims that drivers were urinating in bottles as a result of demanding delivery schedules.
And then as soon as I open the van, I'm looking around, I see a bottle urine. I'm like, oh, I'm not touching this.
Natividad started delivering for Amazon in 2021 when the pandemic dried up his gigs as a full-time DJ.
You're getting paid to exercise. You're getting a lot of steps in. Within 4 months of delivering for Amazon, I lost 20 pounds.
Natividad's shifts with Amazon were usually on the same route, with at least 200 packages. Once, during last holiday season, he had more than 400 packages and 200 stops in a single shift.
Towards the end of my day, they sent out 2 rescues to me to help out to make sure everything's done before 10 hours.
In Baltimore, Dennis says during peak season, her drivers deliver 350 to 450 packages on each of her DSP's 40 routes. And Amazon has a lot of these routes to optimize, 148,000 a day, up to 225,000 in peak.
And then we look at the density of the packages, the complexity of the locations we're going to deliver to, and any other considerations like weather and traffic from past history to put a route together that we think is ideal.
Another big challenge, Tomei says, is planning for the vastly different needs of areas with various density.
Given that we're in over 20 countries and every geography looks different, it's not just about delivery vehicles or vans anymore. We have rickshaws in India, we have walkers in Manhattan.
In Las Vegas, Amazon held a roundtable in the spring for DSP owners and drivers, where Natividad says he spoke for 20 minutes about the need for Amazon to improve its routing algorithms, especially within small, dense communities like an RV park, where he says the order of drop-offs made little sense.
As soon as I was done talking and reading off my list, I got this slow clap going on. I'm like, okay, everyone here can relate.
Natividad hopes Amazon will keep asking for driver feedback as it continues to innovate in delivery.
I think they should do that probably once a month with all the DSP supervision and a few of the drivers, and not the same drivers every time. That way different feedback is given. And seriously listen to them, because they're not the ones out there seeing and experiencing what we go through.
Natividad didn't get to try out the routing technology in the new vans before he left to deliver for USPS in July. But he's excited that the Postal Service is following in Amazon's footsteps, with new vans coming by 2028.
The Postal Service intends to deploy approximately 100,000 vehicles over the next 5 years, of which 66,000 units will be electric.
More important than new vans for Natividad is the stability that comes with working directly for the government instead of a third party that has a contract with Amazon that could change at any time.
Working as an Amazon DSP delivery driver, there's really no long-term effects or goals or incentives or benefits. I mean, you get health benefits, but compared to the post office, where the post office is a career, they have union, retirement, a lot more benefits, and pay increases every year.
Pay for Amazon drivers is up to the discretion of each individual DSP, although Amazon says it regularly audits DSP rates to make sure they're competitive. Natividad made $18.50 an hour. Indeed.com puts average Amazon driver pay at nearly $19 an hour, 16% higher than the national average. While tipping isn't worked into the job like it is for gig workers delivering for Uber and DoorDash, Amazon did hold a temporary campaign in December that gave drivers an extra $5 if customers told their device, "Alexa, thank my driver." And while Rivian vans represent big improvements for drivers and sustainability, Amazon is getting new Ram and Ford gas-powered delivery vans too.
I just found a Ram and a Ford CDV next to each other.
Amazon is also diversifying its electric fleet beyond Rivian, with thousands of orders in for electric Ram vans from Stellantis and electric Mercedes-Benz vans from Daimler. But for now, drivers are eager to see Amazon keep its current promise of rolling out tens of thousands more of its Rivian vans soon. In your dream scenario, would you drive a Rivian van every day?
I would. I mean, you can't beat this. You really can't beat it.
So you think this is olive oil, right? Wrong. Well, maybe some of it is, but this is actually a classic example of food fraud.
The extra virgin olive oils are being switched out with cheap ones.
And fraudulent to sell something labeled as something else. Why is this fish being mislabeled?
Your Parmesan cheese products do not contain any Parmesan cheese.
As there was no one brand that stood out as completely safe.
Wow, so we can't eat anything.
I guarantee you, anytime a product can be passed off as something more expensive, it will be. It's that simple.
Counterfeits, dilution, substitution, and mislabeling. Food fraud not only harms consumers' wallets, it puts their health and safety at risk.
We might not know the overall impact of food fraud because so much of what fraudsters do is hidden from us and has been for centuries.
Some estimates say food fraud affects at least 1% of the global food industry, at a cost as high as $40 billion a year, according to the Food and Drug Administration.
Grocery Manufacturers of America estimated that 10% of the commercially available food in the United States is adulterated. That's 1 in 10. It means if you're not on that 8-item or less checkout line, you've got something in your cart when you leave the supermarket that's probably bogus.
Here's how and why fake food sits secretly in our kitchen cabinets. According to the FDA, food fraud is considered economically motivated adulteration, or EMA.
It's a monetary impact to the consumer and to the food manufacturers, but it's also a potential public safety, public health impact. It robs us of nutrients and can kill people and has done.
Larry Olmsted researched food fraud for years and published his book, Real Food, Fake Food, in 2016.
As I worked on this book, my definition of fake food became anytime what you buy is not what you think you're buying. Doesn't really matter whether it's legal or illegal. It's where you're being tricked. You're buying something that's not what you think it is.
The worst offenders can include seafood, meat, dairy, honey, alcohol, spices.
The fraud happens more with more expensive foods. Totally makes sense, right? There's a higher margin.
Take your extra virgin olive oil as an example. Fraud usually occurs here when a cheaper oil is added to the more expensive oil, and the label still reads 100% extra virgin olive oil. That's food fraud.
Olive oil has been adulterated for thousands of years because it is of high value and it is sought out.
They might flavor it with beta carotene and maybe color it with a little chlorophyll to make it a little more green. And so then you've got a lower quality, cheaper oil.
So both of these olive oils I got at the grocery store, and both of them are the store brand, but one cost way more than the other. This one had a label of 100% Mediterranean blend of extra virgin olive oil. So the olives were sourced from a bunch of different European countries, and it said it was packed in Italy, and there was no expiration date. And when I purchased this one was a 100% California extra virgin olive oil. First pressed, cold pressed, unfiltered, no artificial colors, preservatives, or flavors. And this one had an expiration date. It said that these olives were harvested in October, November 2022, and that it would be good on your shelf until August 2024. And it was much more expensive. It's roughly twice as much as this olive oil. And this one had way more information about where this olive oil came from.
Now let's look at the spice market as another one that's vulnerable to fraud. Think of an expensive spice, like saffron. This tiny amount cost me $20 at the store. Saffron can be bulked up with some other material like plant stems and sold as the same, according to the FDA.
Popular spices like basil and chili powder from a range of different brands.
Anything that's kind of colored orange, brown, and ground up can be passed off as turmeric.
It's the ultimate bait and switch. And then there's fish. The FDA says seafood fraud can occur when a less expensive species of fish is substituted for a more expensive species. After all, it's kind of hard to know what fish you're buying, right?
If you're an experienced chef or fishmonger, you can look at like a red snapper fillet and tell whether it's red snapper, but 99% of consumers can't. You know, most of the fish we eat is white fish. Every fillet looks pretty much the same, which is why there's so much substitution. The FDA is mandated by law to inspect 2% of the imported seafood which is, I think, a very, very low bar.
In fact, the U.S. imports as much as 85% of its fish.
But federal fisheries enforcement is serious business. Agents from NOAA and U.S. Customs tear open a container filled with frozen fish from Thailand. They're looking for fraud.
First, it's important to understand the matrix that food fraud lives in. There's intentional and unintentional types of food risk. Unintentional risks include food safety and quality, like accidental foodborne illnesses.
CDC estimates about 50 million people a year contract a foodborne illness. Only 20%, 1 in 5 of those can be identified. So there's 40 million people a year getting sick from something they ate that we don't know what it is. And a good guess would be that fraud has something to do with that.
Then there's intentional. That's where food fraud is alongside food defense. The difference is fraud is motivated by economic gain and defense is motivated by harm.
If you have a ton of coffee and you can turn that into 1.2 tons by adding some cheap filler to it, you've just increased your profits by 20%. And a lot of these products pass through a lot of hands. They go from small growers to big trucks to tankers to boats to processing plants. It's not necessarily like this big company that's selling you coffee that's ripping you off. It can happen in a lot of ways along the way.
Even the FDA says it can't estimate how often this fraud happens or its economic impact. Over the last 10 years, the most common fraud committed is lying about an animal's origin and dilution or substitution, both ranking at 16% of incidents recorded. Dilution and substitution are exactly what they sound like. Perhaps somewhere along the supply chain, the real expensive process of refining something like fresh olives is ignored. Maybe a little canola oil is added instead. Then there's the removal of value, when an ingredient or part of a food is intentionally left out, taken out, or substituted altogether. And that substitute can be a non-food substance. That's the 14% of the recorded food fraud incidents using non-food substances.
The pandemic has given us a chance to focus on supply chains and forced us to.
For example, during the pandemic, labeling fraud really spiked in 2021 to 21% of the types of fraud that were committed and recorded.
If we knew all about it, why hasn't it been solved? The key was we weren't focusing on prevention. Food fraud prevention, if we do it right, is boring. We're the fire marshal checking exits and smoke alarms, not catching the bad guys.
The U.S. has laws in place to ensure food safety. That's part of what the FDA does today.
Basically, all food fraud, all product fraud is illegal under one law or another, somehow.
Before the FDA existed, manufacturers could add basically whatever they wanted into the food. Think of Upton Sinclair's The Jungle. That book was published in 1906. That same year, food safety regulation began with the Meat Inspection Act and the Pure Food and Drugs Act, which outlawed adulterated and misbranded food items.
To protect consumers,
this ultimately led to the creation of the FDA.
the Food and Drug Administration and the...
Since then, laws have hit the books to further food safety protocols, like the Food Safety Modernization Act signed into law in 2011.
And then horse meat hit.
The fraud was on a grand scale.
Horse meat was blended into beef in the UK, across Europe,
and sold to unsuspecting supermarkets for a period of 8 months in 2012. The scandal was exposed.
And that was a great wake-up call.
Some companies purposely mislead on labels.
Prosecuting the fraudsters committing the crime can be tricky. After all, they're purposely trying to avoid that detection. But criminals are caught. Like in 2016.
The product labeled Market Pantry 100% Parmesan contained cheaper Swiss and cheddar cheese and an organic filler called cellulose, which can be derived from wood pulp.
Castle Cheese was caught adding wood pulp and cheddar to its grated Parmesan that they sold as 100% Parmesan cheese.
The FDA does allow fillers like cellulose in cheese, but it can only make up 4% of the total ingredients.
The president of the company got a $5,000 fine, 200 hours of community service, and 3 years of probation.
For its part, the Food and Drug Administration says its job is to make sure food doesn't hurt you, not to police the labels.
Fraud is tough for the consumer in terms of food because it's difficult. They don't have a lab in their kitchen.
The Food Fraud Prevention Think Tank has a 5-question survey consumers can use when shopping for food. 1. What type of product is it?
Be aware of product that you put on you, in you, or plug in the wall.
2. Quality. Can you recognize the difference between the products? If you can't easily tell the difference, that makes you more vulnerable to fraud.
If I drink scotch, I couldn't tell you if it's a difference between a $50 bottle and a $5,000 bottle. So I know I could be deceived at that point.
3. Supplier. Do you know the retailer or the supplier? And do you trust them?
So when you turn that box of cereal or bottle of juice over and read the back, there's a lot of information there that's required by law that's helpful to the consumer.
And then question 4. Are you buying this item online? The supply chain can be shrouded in more mystery when shopping online. So how did you find out about this website? Is it reputable?
But it depends on how you find that supplier.
And finally 5. Complain. Okay, it's not a question, but the Food Fraud Prevention Think Tank says if the retailer is legit, they will want to know.
I think manufacturers can be the victims as well.
The FDA also relies on consumers' reports.
In recent decades, fraudsters have gotten more sophisticated in the techniques they use to fake the food products. And that means that our detection methods and our test methods and standards have to be better at detecting fraud.
That's why the U.S. Pharmacopeal Convention provides a framework for organizations to detect its vulnerabilities.
We have food fraud mitigation guidance, so it is a supply chain risk management tool to really take a look at which ones are the more risky products suspected to be adulterated.
Sometimes it feels like this is not that big of a deal. But the more fraudsters are able to achieve, the more we end up paying in the end as consumers.
These cases rarely result in criminal penalties. If you want to be like a drug dealer and import heroin and you get arrested on a large scale, you're going to go to jail. But if you can make $80 million importing adulterated honey and then you're going to get a slap on the wrist and some fines, why wouldn't you do food instead of drugs if there's no basically criminal downside to it? So as long as we don't take it seriously, why should the perpetrators take it seriously?
What we want is the food industry just to be focused on making food and not have to worry about looking over our shoulder, checking different suppliers. And that's going to impact more food being produced, better food, safer food, less expensive food. There's plenty of things for us to worry about in the world today, and food fraud should not be one of those.
This is Saudi Crown Prince Mohammed bin Salman, otherwise known as MBS. He's considered the de facto ruler of the Kingdom of Saudi Arabia. MBS announced the futuristic megacity project called NEOM back in 2017. To simplify what NEOM would look like, he reached into his pocket and pulled out 2 mobile phones, an old phone and another newer smartphone.
This is what we're going to achieve in NEOM.
He's creating a city at the cost of hundreds of billions of dollars where there is no city, no habitation of any size at all.
He really wants NEOM to be something that hasn't existed in the world before. I think that's very important to him, that this is not modeled on anything else, even though other people might point out, it has similarities to other models. He really wants us to be like something brand new and completely innovative and completely, out of the box, and something that the world has never seen before and that he has brought into existence.
NEOM gets its name from 2 words, neo, which is the Greek word for new, and M, which is an abbreviation of the Arabic word mustaqbal, Arabic for future. Also, the first letter of the Crown Prince's name is M. NEOM is a proposed futuristic smart city currently being built in the Tabuk province in northwestern Saudi Arabia. The site sits next to the Gulf of Aqaba, which borders Egypt, Israel, and Jordan. The project plans to cover an area of more than 10,000 square miles, about the same size as Massachusetts. The Mammoth Project, which is a part of Saudi Arabia's Vision 2030 reform plan to diversify its economy away from oil, is expected to complete its first phase by 2030 and cost $319 billion.
NEOM is this incredibly expansive project that started its conceptual life as an idea to build a brand new city. And it has since really just grown and sprouted new heads. And it's no longer just a new city. It's this entire new region that has all of these different components, one of which is an octagon-shaped industrial city that partially floats on the Red Sea. There is a ski resort component up in the mountains that they're calling Trojana. And then most recently, they also announced a sort of island resort project called Sindala that's extremely high-end and geared to sort of like yacht owners and very high-end tourists.
One of the chief components of NEOM is the line, a linear smart city with no roads, cars, or emissions. The city will run on 100% renewable energy, and what's more, Saudi officials say the city could accommodate 9 million residents by 2045.
The line is really the centerpiece of NEOM at this point. It's the biggest and the splashiest and the most kind of ambitious part of the project. It is essentially a linear city that is composed of 2 buildings meant to be about 200 meters wide, 500 meters tall, which is basically the size of the Empire State Building, a bit taller even. And then it would run for like 100 miles. So this very narrow strip of a building, skyscraper, extremely high, this kind of mirrored facade. And the interior between these 2 long strips of buildings, you have this kind of verdant kind of interior that they're imagining would be the place where people would live and play and work. It's really enormous. It's hard to almost envision the idea that they want to say that they're going to have 9 million people eventually living in this city, which is really just a building. So it's an entire city in one structure, essentially.
MBS is luring big names to be part of this project by giving them offers they can't refuse. In 2017, the project hired 3 of the world's largest consultancy firms, McKinsey, Boston Consulting, and Oliver Wyman, in multi-million-dollar deals. Not only that, NEOM offers lucrative salaries to global talents with 0 taxes. In 2022, the Wall Street Journal reported the project is paying senior executives roughly $1.1 million a year.
NEOM is a real thing. There's real money that's been devoted to it already, and more that seems almost certain to be spent on it. They're very serious about all of this. People who are making NEOM really think they can make a city that is different from every city that's come before, that's more modern than any city that's come before. It sounds like a total white elephant project to a lot of people, and it may very well be that.
NEOM gets its money from the Public Investment Fund, the sovereign wealth fund of the Saudi government. However, MBS is now planning to raise money by offering shares of NEOM to investors via an initial public offering.
It's something that he's talked about kind of from the beginning, the idea that we want to IPO the city or we want to IPO NEOM. And again, it kind of fits in with this idea of like city as corporation, this kind of purely capitalistic city, which is not typically how cities are run and makes it very unusual in that respect. They're also talking about bringing in kind of potentially investment from other regional investors, Saudi investors, like Saudi private sector investors. So they're trying to kind of create a funding mix. I think it's going to be one of the biggest challenges, definitely, though, is how do you get together, even in the first phase, $320 billion is just an enormous amount of money, right? They can't fund that themselves, obviously, because if the entire sovereign fund is $600, $700 billion, you can't spend half of it on NEOM. So there definitely need to bring in outside investors.
NEOM is projected as an eco-friendly city powered entirely by renewable energy. However, critics argue that those claims are just a form of greenwashing from the world's largest oil exporter. Also, NEOM is under a lot of scrutiny for its treatment of the Huwaiti tribe, who have been forcefully removed from the planned city by Saudi forces. In 2020, Abdul Rahim al-Huwaiti, a prominent member of the tribe who regularly posted videos of the forced evictions, was shot dead by Saudi security forces.
This wasn't an isolated incident. There were already kind of pockets of resistance to the relocations, arrests, people facing repercussions, and then over time, that resistance has been largely silenced, right? People are afraid, or they kind of just decided, I just need to take the compensation and move in with my life, because obviously resistance is not going to be fruitful. And then more recently, we have also seen that 3 members of the community who had been involved in this kind of resistance movement, one of whom was the brother of Abdurrahim al-Huwaiti, who had been arrested, were sentenced to death, according to some human rights groups that are following these cases. There's not a lot of transparency around these cases, and we haven't really had many statements from the government around what's going on, what they might be charged with, why a death sentence would even come into play. We do know very much that this is contentious, that many of them did not want to be removed, and that many of them feel that they were not fairly compensated.
The NEOM PR team did not respond to a request for comment. The Saudi Crown Prince has been applauded for his economic reforms and for creating more opportunities for women in the country. But on the other hand, the murder of Saudi journalist Jamal Khashoggi has become a prime example of his authoritarian tendencies. Some argue that MBS is using NEOM to project himself as a so-called reformer, more of a PR stunt than an actual construction project.
Mohammed bin Salman wants to project himself as a liberal leader within the conservative royal family in Saudi Arabia. NEOM, as a mega project, is seen in Saudi Arabia and the young Saudi population as part of this liberalization process under Mohammed bin Salman.
I think there's a good chance that it won't work at all. But the fact that Saudi Arabia has, under MBS, had this grandiose vision, that's both a criticism of that vision and praise for it, because having a vision like that is one of the things Saudi Arabia has never had before, and that it really kind of needed. So it's better to have, I guess, no vision than to have a bad vision, but having a vision does seem like a necessary part of any successful plan for a vast modernization and improvement of the country.
This is a physical and technological and symbolic legacy that he wants to leave behind that represents, everything that he is doing for Saudi Arabia, right? It's reached this level of incredible importance to him and to the state, and he is spending an incredible amount of resources and time because it's something that he will leave behind.
widespread medical debt is a uniquely American problem.
The United States has by far the greatest burden of healthcare bills on individuals.
7.4% of U.S. residents face catastrophic healthcare bills each year. That's more than double the next closest country.
100 million people in this country currently have some kind of healthcare debt. That's about 40% of adults.
U.S. medical debt totaled at least $195 billion in 2019. Having insurance doesn't always insulate people in the U.S. from debt. Over 90% of the U.S. population has some kind of health insurance, but medical debt is still a persistent issue.
Basically, our healthcare system is creating debt on an industrial scale.
The history of medical debt is basically a history of the changing answer to the following question. When the patient can't pay the bill, who foots it?
You've got two things that have been going on. One, high prices of medical care. And number two, patients that have to shoulder more of the burden of paying those bills that 20 or 25 years ago might have been covered mostly or entirely by their health insurance plan.
The rise of the insurance industry may have been a catalyst for price inflation.
1965, that's when the inflation bomb was lit. That's when it really went off because that just kick-started the third-party payer system.
So how did the medical debt crisis begin in the U.S., and how can we fix it? Healthcare costs have been climbing for the past century as the system has gotten more complicated. The U.S. was spending nearly 7 times as much per capita in 2020 on healthcare than it did in 1970. Before the recent spike in inflation, healthcare spending had consistently outpaced overall consumer prices.
It used to be that healthcare was only 10% of our economy. Now it's about 20% of our economy.
There are many complicated reasons for the rise in the cost of care, such as not prioritizing preventative care or a lack of price transparency. But one thing that kick-started inflation that may seem counterintuitive was the introduction of health insurance.
It was when you get this third-party payer system where the patient doesn't have to pay all of the cost of it directly. The insurer pays a chunk of it. That gives you relentless upward pressure on pricing. Because if you're going to get paid, why not get paid some more?
By the late 1960s, most Americans had some form of health insurance, such as a hospital-based plan, a government plan like Medicare or Medicaid, or insurance through their job.
Medicare at the time had reimbursements that were quite generous, and hospitals and physicians took advantage of those. They were able to charge them basically what they saw fit.
This insurance concept is called fee-for-service.
That means for every service that your doctor delivers to you, that doctor is billing for each individual thing. And that can create an incentive called provider-induced demand, which is basically that your doctor has an incentive to do more things to you.
There are many different ways that healthcare systems are organized around the world. Whether the system is more like the UK, where it's a government system, or more like Germany or the Netherlands, these countries all do one thing that we don't, and that is put effective limits on how much a health insurance plan can require people to pay out of pocket when they go to the doctor or the pharmacy or the hospital.
By the 1980s, there was a push, particularly by the Reagan administration and by Congress at the time, to rein those costs in.
A 1983 law passed under Reagan changed the way Medicare reimbursed doctors and hospitals. This made it so hospitals received a fixed rate for care rather than getting to bill the government whatever they wanted. If they spent below the fixed rate, they made a profit. Otherwise, they operated at a loss.
About 10% of hospitals closed in a period during the 1980s, in part due to those declining reimbursements. It was a real period of struggle. Hospitals really were hard up to pay their bills. Some of them turned to much more aggressive medical debt collection and became much less forgiving of patients in debt. They would charge patients, and instead of allowing for lenient payment plans or discounted care, they instead said, please put it on your credit card. The 1990s was the culmination of this effort to rein in costs in Medicare and Medicaid, and then at the same time, the growth of the HMO movement and other efforts to rein in the costs of private health insurance.
HMOs, or health maintenance organizations, are a type of healthcare plan that requires patients to see only specific doctors if they want their insurance to pay for it. There's no out-of-network coverage, and they must get approval to see specialists.
The network is much smaller, and you have no benefits if you go out of network. You have full benefits if you stay in network and follow the rules, if you will. By that nature, the HMO is able to negotiate better prices because they would channel patients towards the contracted providers. And some other providers were worried about losing patients, so they contracted too and accepted those prices.
HMOs grew rapidly in the 1970s and 80s until there was a backlash in the 1990s.
Beginning in the mid-90s, a lot of people have been put into an HMO by their employer, like it or not, and we're going to have to change providers, they got really upset. And then the media grabbed it and started running.
An alternative health coverage model called PPOs, or Preferred Provider Organizations, began to take the place of HMOs. PPO plans provide partial coverage to go to out-of-network doctors and also usually don't require patients to get approval to see specialists.
That shift took place, and prices were starting to rise again because of it. There was less control over it because it was a wider network. The insurance industry turned back to something they had started to do already back in the 70s and early 80s, which was increasing cost sharing to get people to change their behavior. And that was initially the primary motive for the cost sharing, is to make you think twice about something.
While healthcare costs continued to rise, patients were being asked to take on more responsibility for a larger portion of the bill at the point of care. In the early 2000s, federal legislation paved the way for a major restructuring of how insurance plans shared costs.
And now I'm honored and pleased to sign this historic piece of legislation.
The 2003 Medicare Modernization Act further increased the pressure on patients and on hospitals by helping in the proliferation of high deductible health insurance plans.
A deductible is the amount a policyholder has to pay up front before their health insurance plan kicks in.
The George W. Bush administration said that patients would be better consumers, more discerning consumers of healthcare, if they had some skin in the game, if they had to pay more upfront at the point of care.
The theory touted by many who knew better was going to get skin in the game. Now, since you're going to have to pay a lot of this money out of your pocket and there's going to be this big gap in coverage, you're going to pay attention. You're going to be an informed consumer. If you're well educated and it's a kind of a routine thing, yes, you can do your research. If you're having clutching chest pain, or you've been in a crash, or you just don't know, and the doctor says you need this difungomectane treatment, what are you going to do? Say, I want to look that up and do my own research? No.
The average deductible for an individual in 2022 is around $1,760, which is double what it was in 2006 when adjusted for inflation.
This dramatic rise in high deductible health insurance predated the Affordable Care Act, but the Affordable Care Act didn't do anything to really arrest that change. More and more of us are ending up in these health insurance plans that require us to pay thousands of dollars out of pocket before our coverage kicks in.
Roughly 70% of lower income adults said they wouldn't be able to afford a $500 unexpected medical bill. Nearly a quarter of those in households with an income of at least $90,000 also said they wouldn't be able to immediately afford it.
It doesn't really take a Nobel Prize in economics to realize that if most people can't afford a $500 bill and the average deductible on a health plan that someone gets at work is north of $1,500 now, that's going to create a problem because you can't walk into an emergency room or a hospital in this country and get out usually for less than a few $1,000s.
We are done.
There's no question that as bad as the medical debt situation in the United States is now, it would be worse if not for the Affordable Care Act. One of the important things that the Affordable Care Act did was it provided federal funding to states to expand Medicaid to working age adults who were not historically covered by this program. But as a result of legal challenges to the Affordable Care Act, the decision of whether to expand eligibility was left up to states. And most states have done it, but 11 states still have not expanded eligibility. And if you look at where medical debt is concentrated in this country, it is concentrated in the South, which is where Medicaid expansion is least common.
So the effect of the ACA on medical debt was largely through the expansion of Medicaid. But at the same time, that law did allow for patients to purchase high deductible health insurance plans on the marketplace, so it didn't stem the tide of that problem with insurance itself.
There's no question that providing health insurance is a critical protection against medical debt. The issue just is whether or not it's adequate.
People may also incur debt if they're hit with a surprise bill, meaning they thought their insurance company would cover a specific medical expense, but it didn't. A federal law called the No Surprises Act went into effect January 2022, hoping to address that problem.
Now people who inadvertently go to an out-of-network provider, for example, by going to an in-network hospital but being seen by an out-of-network doctor, that patient is held harmless. And then it's up to the insurance company and the doctor to kind of work out how much gets paid to them.
I think it's a little early to know whether the No Surprises Act is working as intended. It doesn't eliminate the problem entirely. It creates a system that is designed to protect patients and force a system of arbitration and negotiation between payers and medical providers that may be out of network, in large part because the medical industry was so opposed to anything that would actually bar this practice, which I'm not a doctor, but it seems pretty hard to defend the practice of intentionally subjecting patients to medical bills that would surprise them. And yet that, quite frankly, was a business model for an embarrassingly large number of physicians in this country.
U.S. policy attempts to address medical debt so far have been incremental and piecemeal.
There is no one answer. It's going to have to be a number of things being done at once. It's going to be painful for somebody, whatever we do.
This commercial airliner is missing something. Can you tell what it is? You might have guessed the big airline logos, but it's also the paint. How do planes get painted? And how important is it to their overall structure and operation? Commercial airliners can last up to 30 years on average, or 135,000 to 165,000 flight hours, before they are retired due to metal fatigue and the overall effects of harsh weather and solar radiation. That means that the exterior of a plane must be protected, and for many airplanes, the paint does exactly that.
The aircraft is the literal embodiment of the airline's identity. So airlines will paint their aircraft because it is marketing, but also there is a functional element to painting a plane.
Painting companies are key to not only making airplanes pretty, but ensuring their longevity and ability to stay in service for as long as possible. The average price of a standard Boeing 747, a popular commercial airliner, is about $420 million. So maximizing that return on investment is major. Staying in service for longer means more flights and more tickets sold. The global commercial aviation aircraft paint market was estimated at nearly $18.5 billion in 2020 and is expected to grow into about $65 billion by 2027. We spoke to Dean Baldwin Painting, one of the aircraft paint industry leaders, to get an inside look into how planes get their sparkle. Here in the outskirts of the small city of Macon, Georgia, is one of 5 facilities owned and operated by Dean Baldwin Painting, a 57-year-old aircraft painting company based in the U.S. This is Barbara Baldwin McNulty, CEO and owner of the company.
Back in 1965, my father-in-law worked for Eastern Airlines in Miami International and wanted to make extra money, and he started painting parts. And the parts became Cessnas and Pipers, and then they became DC-3s and DC-6s, and the company progressively kept growing slowly for probably 30 years. My ex-husband and I took it over back in 1978, and we stayed in Miami until 1999 when we expanded into Roswell, New Mexico. So now we have Roswell, we have Peru, Indiana, Macon, Georgia, and then we service San Antonio and Goodyear, Arizona.
Behind Barbara is a Boeing 767-300 being repainted for Delta Airlines. On this particular day, the facility is painting 3 planes from Delta, JetBlue, and United. The cost to paint a plane is an expensive endeavor.
almost 200,000, 175. That's for an airline with major customers.
Those costs include labor, stripper, paint, primer, masking materials, and proper disposal of consumables. When a new plane is brought into the facility, the plane must pass initial inspections before it can undergo its new paint job.
Everything we do before we go on to major steps has to have inspection come in and sign off that we're ready and it's okay to move forward.
The painting process varies depending on whether the plane is brand new or needs to be repainted.
There are other reasons why airlines might change the paint. That could include, for example, a merger. Think of Alaska and Virgin. When they merged back in 2016, they had to start looking at both of their planes that had two different names on them. Alaska was the branding that kind of won out.
A repaint begins with sanding the old paint off. Overall, painting will involve 4 to 5 layers and ends up being as thick as just a fraction of a millimeter. Painting an airplane is a surprisingly laborious process. It involves multiple engineers, inspectors, and painters who must ensure that all safety standards are being met and that the design as sent by the airline is accurate. This plane is in the process of being repainted. Right now, it's being stripped of all of its layers so that the new ones can be applied. After the paint is stripped, an anti-corrosion primer is applied. From there, the main paint layer, which is often white, is painted on. Then more protective intermediate layers are applied. This can be a 1-coat or 2-coat process depending on the painting company or the airline's specifications. You might have noticed that most commercial airplanes are white, and that's usually not a design choice. White is optimal because it's the color that best reflects light, which prevents cabin overheating and solar radiation damage. Historically, this has not always been the case. Airplanes used to be left as bare metal or chrome, but it tended to dirty more quickly, which caused some airlines to start painting their liveries. Throughout the entire process, the plane is continually inspected. Safety standards are set by the Federal Aviation Administration, and employees must be trained to apply the paint correctly and identify any anomalies before, during, and after the process.
Not only the safety, the compliance, the environment, the manpower, the training. It's not as easy as most people think. These days, manpower has been a terrible issue in trying to obtain. And then you have to spend time training. It takes years to get an individual to a paint level. It takes years of training, OJT records, and continual updates on their training.
At the factory, say Boeing or Airbus, and you see a lot of the green aircraft that are lined up that haven't yet been delivered, often you'll see the tail painted. And the reason for that is the airplane wouldn't be balanced if they didn't have that on there. It's very important for the weight and the balance, and so many pounds of paint go into painting that tail that it could really tip it in one direction or the other.
Along with a multifaceted team, millions of dollars are on the line when a plane is painted. The job must be completed in time and done well. Otherwise, the consequences can be costly, not just monetarily, but reputationally for the airlines.
If they use a painting facility, a third-party painting facility that doesn't do a good job, or if their own in-house painting facility doesn't do a good job, if the paint isn't applied correctly, it can peel off. And there are examples of that you'll find posted on social media. It's embarrassing for the airline. It's also bad because it means that that plane is not going to be as fuel efficient.
Because of the sheer size of an airplane, the paint ultimately adds up in weight. The more weight an airplane carries, the less fuel efficient it will be, which means higher costs to refuel the paint over time. Aircraft painting can be a lucrative business, and Dean Baldwin has grown significantly in its 57 years.
We are approaching this year $35 million in sales, and we employ approximately 350 to 400 employees.
For all of the functional aspects beneath its glossy surface, however, for most people, or most passengers, the paint job on an airplane just gives it a nicer look and feel, an identity.
I always say a paint job on an airplane is like makeup on a woman. Just beautifies it.
But how does this all come together in the first place? For the most part, aircraft painting companies and airlines enter into long-term partnerships.
The airlines usually go put a request for proposal, and they put out a bid that probably all of us will bid on based on the space that we have. Once you get an award, it is usually a 3 to 5 year award. They need us as much as we need them. They need us to be compliant. They need us to be on time. They need us to provide a quality product, no damages, keep our pricing at a competitive level. And they actually will work with you.
Aside from Dean Baldwin, International Aerospace Coatings and Moss Aviation are two of the larger aircraft painting companies, both of which have facilities abroad. Aside from its 7 facilities in the US, IAC operates 2 locations in Ireland and 1 in the Czech Republic, and also has services ranging across interior solutions and graphics. Moss has facilities in the US and in Europe, and has an annual revenue of $6.7 million as of February 2022. Aside from the painting companies themselves, the painting market also includes the manufacturers and distributors of the paint. The main players are Akzo Nobel, PPG Industries, and IHI Ion Bond AG. Sherwin-Williams, the paint company better known for its industrial and residential paint manufacturing, is also a manufacturer of aerospace paint. The largest market for airplane painting is North America, with Asia-Pacific being the fastest-growing market. So between the manufacturers, distributors, and painting companies, how do the airlines fit into the chain? The world's biggest airlines get their liveries painted either in-house or at external painting companies. In general, commercial aircraft are what dominates the market. With airlines investing heavily into their marketing, the aerospace paint industry has identified specialty liveries, planes painted with complex artwork or as physical advertising, as one area of growth. Several airlines have produced artful iterations of planes for sponsorships, partnerships, anniversaries, and advertising campaigns in general. Alaska Airlines made a Disney-themed plane. WestJet painted a Disney's Frozen-themed plane. And United made a Galaxy-themed plane. These are just a few examples. So next time you're on a plane, even if you're inside the cabin, consider everything that went into the exterior. This time, it's what's on the outside that counts.
When you see the 747 take off or land, it's almost transfixing because the plane itself is so beautifully designed.
Boeing called her the Superjet. The press called her Jumbo.
It makes the best landing of any airplane. And you are in awe that somebody even dreamt that this could fly.
Since its first commercial flight in 1970, Boeing 747 Jumbo Jet has flown over 3.5 billion passengers.
Its development back in the 1960s was measured in billions of dollars. It was a pretty expensive airplane to develop at its time. You were building a whole new class of airplane, the biggest airplane in the world.
It's one of the most recognizable planes to take to the skies, with its iconic hump, 4 engines, extensive landing gear, and sheer size. The 747-8 tail height is equivalent to a 6-story building. It has a wingspan as wide as 2 737-700s lined up nose to tail. It can travel 7,790 nautical miles, carry over 450 passengers, with a takeoff weight of nearly 1 million pounds. The 747 ushered in more affordable long-haul air travel by increasing capacity and lowering ticket costs. It quickly became known as the Queen of the Skies and was the first plane to have 2 aisles and overhead bins.
Boeing was already on the map when the 747 came out, but what the 747 did for Boeing was inject the company with a little bit more glamour, a little bit more sexiness.
The 747 was always intended to have dual roles. It was designed from the beginning to carry both passengers and cargo.
The flight deck was put on top of the plane so that the nose would open for easier loading. This gave the 747 its upper deck. Boeing produced the 747 for the last 55 years, during which a total of 1,574 airplanes were built for over 100-plus customers. The list price for a 747-8 in 2022 was over $400 million. But over the last few decades, airlines have looked for more ways to cut costs and to make airplanes as efficient as possible.
Airlines, even coming out of the pandemic, are trying to save as much money as they can. So they are looking for ways to have planes that are the most efficient possible. And right now, those are 2-engine jets.
The last 747 just rolled out of its Everett, Washington factory. It will go to Atlas Air for cargo deliveries. CNBC takes a look at how the 747 changed aviation and what the future looks like for Boeing's future aircraft. It was the beginning of the jet age. In the 1950s, Boeing introduced the 707, America's first jet airliner. Jet engines were safer, cheaper, and faster than piston engines. The number of people flying quadrupled between 1955 and 1972, as it became faster, more accessible, and financially possible. Pan American World Airways, or Pan Am, was one of the biggest carriers at the time.
So Pan American came to Boeing and said, we need an airplane twice the size of the 707. The head of Pan American Airways, Juan Trippe, said to Bill Allen, the CEO of Boeing, if you build that airplane, I'll buy it. And Bill Allen turned to Juan Trippe and said, if you buy it, I'll build it. And that's how the 747 got started.
In 1966, Pan Am put in an order for 25 new 747s.
One of the original design ideas for the 747 really was going along with what Pan American wanted, and that was building a double-decker.
Building a plane twice the size of its predecessor had a significant amount of challenges. The first iterations of the design were entirely double-decker, but that made it difficult to evacuate potentially 500 passengers safely and in a timely manner.
And this moment of innovation came in, and that was, instead of making a double-decker, why don't we make a wider airplane? Why don't we make a twin aisle, go 20 feet wide? And so the twin aisle, the wide-body jet was born.
Even though the design wasn't a full double-decker, it was still twice the size of the 707 and required new innovations.
What made it possible to make this giant jet was a revolution in engine technology. These new engines, especially compared to the turbojet engines of the day, were very efficient.
The 747 wasn't Boeing's biggest project at the time. It was also working on the 2707 Supersonic Transport, or SST.
What's interesting about the 747 when it was first introduced is airlines expected it to be an interim aircraft that they would use between their first generation of jets and the coming wave of supersonic planes that were expected to enter service later in the 1970s.
So the designers of the 747, they understood this, that at some point in the future, the 747s would be converted into freighters. And so they purposely set out to make the 747 the perfect freighter.
The SST program lost government funding and the prototypes were never finished.
Well, obviously, the supersonic era didn't happen quite the way we expected. And so, frankly, I think that led to a much longer life and much greater success for the 747. Once they finalized the specs for the plane, how are airports going to handle this plane that is more than twice as large with a wingspan more than twice the width of previous aircraft and an airplane that is much heavier? So that led to how Boeing designed the landing gear. It has 18 wheels and that's designed to spread out the weight of the plane so that it could use existing runways. But some airports had to widen their runways and taxiways. They built new terminals to handle this. They had to invest in new baggage handling systems.
In fact, the plane was so big, Boeing had to build a plant around it during its construction in Everett, Washington. Today, that building is the biggest in the world by volume, and where Boeing builds its other wide-bodies. These costs, along with the SST project and the development of its other new jet, the 737, created a significant financial strain on the company.
One of the biggest challenges for Boeing, how do they fund building it? Boeing bet the house on the 747.
There were people who said, literally, that this airplane would not fly. There were also people who said financially this airplane would not fly. It was a tremendous risk. That became one of the big issues in those days, that the money to build this airplane, that Boeing had to negotiate with creditors constantly to keep this program going, to keep the company going.
But that didn't stop Boeing. Joe Sutter, who is known as the father of the 747, led the design team, and they, along with other Boeing employees, were nicknamed the Incredibles for building the 747 in just 29 months. When the first 747 rolled out of the factory, it was a huge event. All of the airlines who placed an order sent flight attendants to represent them, and each company's logo was included on the fuselage. In 1970, Boeing delivered 93 total 747 aircraft with over 60 passenger versions.
Pan Am will bring you the world's first 747.
Pan Am operated the first commercial.
Because the public was so entranced with the 747, all of the major airlines had to have this airplane as their flagship.
Its jumbo size was something passengers, pilots, and flight attendants had to get used to.
My first introduction to the 747 was as a flight attendant in 1972. It was huge. Yeah, all of a sudden, the biggest airplane up until then was a 707 that needed 5 or 6 flight attendants. The 747 needed 14, and it had 5 different sections, and each section was a different size. It was chaos at the beginning.
So many airlines used the upper deck level of their first versions of the 747 as lounges for their first class passengers. Some airlines had lounges in coach, and American Airlines even had a piano bar in coach on its 747 for a short time.
Very extravagant, very luxurious. We had fresh flowers in crystal vases. Each meal had a special wine that was paired with it, and had to learn how to properly open champagne.
The first ever 747 prototype is still on display at the Museum of Flight in Seattle.
This is the upper deck experience. This was the interior that Boeing used to show the airlines the possibility of what that first class, that premier experience, that premier flying experience could be. Passengers could come up the spiral staircase and have a moment in the lounge.
It was the favorite airplane of the pilots.
Captain Lynn Ripplemeyer would eventually become the first woman to pilot a 747 and the first woman to captain a 747 transatlantic flight. She got her start flying cargo for Seaboard World Airlines.
They had professional engineers, so if you got hired as a pilot, you immediately went to the first officer seat. So this very unique set of circumstances happened at the exact right time for me to get hired by Seaboard World and as a 747 first officer and become the first woman to fly a 747. I went to work for People Express, first as a 737 first officer, upgraded with any gear to captain, again, which is almost unheard of, and then we got 747s. So I became a 747 captain at People Express in 1984. I had so much confidence in that plane. It flies beautifully. I think why many pilots like it is it makes the best landing of any airplane.
The plane was designed for long-haul flights, making international travel more accessible and affordable.
It only went to what we would consider to be important cities, major markets, world capitals. And having a 747 serve your airport was a badge of honor. What was also interesting is airlines viewed the 747 as legitimizing them. So a lot of airlines ordered the 747 when it was first introduced, even though probably they shouldn't have.
It also helped transform the air cargo market.
It wasn't long that the 747, with its capacity to be a great freighter, that freighter version came out, and that was in the early 70s with Lufthansa, and this is really where the airplane came into its own.
Airlines all over the world have flown the 747. It really runs the gamut, from United Airlines to Delta Airlines, KLM, Lufthansa, British Airways, Qantas. It was really a plane that flew all over the world.
Over the next few decades, the 747 continued to evolve with newer, improved versions. It also served other purposes, like government transport, including Air Force One. In 1977, Boeing delivered a modified 747 to NASA to use to ferry the space shuttle from its landing spot in California back to Cape Canaveral in Florida. In 1988, the 747-400 was introduced. This version had more efficient engines, longer range, and a modernized cockpit. It was the company's best-selling version.
Overall, the 747 safety record has been good. That's not to say it's been perfect. Some of these problems, though, are more airline related in terms of their maintenance than the design of the airplane. But the 747 has been involved with some very tragic events. Two of the most visible were the bombing of Pan Am 103, a flight from London to New York, and the crash of TWA Flight 800 off the coast of Long Island, both of which were 747s. But the 747 was a well-designed aircraft.
It actually is probably the safest airplane in the air because of so many redundancies. The more engines you have, the more backups you have to all the systems, because each engine provides the hydraulic power, the electrics, the pneumatics, the air conditioning. Everything that the airplane needs comes from an engine. And when you have 4 of them, you've got 3 backups. That airplane can fly on 1 engine. It's not going to keep altitude. You're going to want to be pretty close to a runway, but everything will still be working that you need to get the airplane safely back down on the ground.
Boeing saw a rise in deliveries through the 1990s before its decline.
The 747 was one of the most geographically widely ordered airplane in the world. For a plane of its size, it helped spur the development of the airline hub and spoke route networks that we now take for granted. But the 747 was not an airplane designed to serve shorter routes. And so as a result, that limited the appeal of the 747. And it also limited the usefulness of the 747.
Fares, routes, and service were regulated by the federal government until the Airline Deregulation Act was enacted in 1978. This created more competition among the airlines and brought fare prices down. It also created dozens of new airlines and the expansions of smaller ones.
With these large planes, they would funnel large numbers of passengers and then funnel them through large hubs. But what passengers want now is to fly nonstop to their destinations. And it turns out that the more fuel-efficient planes, the leaner planes, are able to do that. And that's something that has essentially killed both super jumbo jets.
With 4 engines, of course, you're going to use more fuel than you are with 3 or 2. So they were finding ways to fly an airplane much cheaper and more efficiently. And the 747 didn't cut it. It's not because people don't like it. It certainly isn't because pilots don't like it.
In the 80s, airlines started to do away with the luxurious lounges and replaced it with seats for increased revenue.
Airlines also pack a lot more seats onto planes than they used to. That is the idea. They want to get as many people into coach as possible.
In 1990, Boeing 747s made up 28% of the world's passenger wide-body fleet. That's down to just 2% in 2022. And despite the rise in air freight during the pandemic, in 2022, the 747 made up just 21% of the world's wide-body cargo fleet, down from 71% in 1990.
In fact, Pan Am clung to that plane far too long, and it's partially responsible for the airline's demise.
In 1991, Pan Am ended operations.
So from the mid-1980s into the 2000s, you saw fewer and fewer airlines flying 747s. Those that had them generally reduced the number of 747s in their fleet.
Despite all these signs that airlines were moving away from four-engine aircraft, Airbus, Boeing's main competitor, launched its super jumbo, the A380, in 2007. The company spent billions on developing it and overtook the 747 as the world's largest commercial plane. It is a full double-decker and could be configured to seat as many as 853 passengers. But many airlines were already moving away from the 747 and the hub-and-spoke model for more efficient twin-engine aircraft. Airbus ended production of the A380 in 2021.
The end of the 747 was pretty much inevitable, and by some measures, maybe even by Boeing's own doing.
This is the last 747, number 1,574. When we visited Boeing's Everett, Washington factory, the company was putting the final touches on it before heading out to be painted and flight tested.
It's an exciting, emotional time for us. The 747 has been absolutely transformational, certainly to all of aviation, and as part of that to Boeing. It laid the foundation for the twin-aisle aircraft that followed.
Boeing's only going to build planes that airlines want. The orders stopped coming in for the 747 because Boeing and others have built other aircraft that can do the same job that the 747 can, or close to it. So the 787 Dreamliner and the Airbus A350 can fly routes that the 747 couldn't. They can go much further nonstop.
The company delivered its last passenger version to Korean Air in 2017. That same year, all U.S. airlines stopped flying it.
When the 747s were retired, people were really sad. United's last 747 flight from San Francisco to Hawaii had its departure covered live on television in San Francisco. It was a big deal.
Boeing 747 was the most successful widebody until 2018, after Boeing's 777 took the #1 slot.
When you look at the 777-8F freighter and you compare it to the 747, it can carry similar to cargo levels, but with the twin engine economics. And it has over 30% reduction in fuel burn, which is great for our customers' efficiency as well as for sustainability and the environment.
Demand for cargo versions remained strong until 2020, when the company announced it would end production of the 747 freighter version.
It just really made sense that we would shift to the twin engine model over the 4-engine model of the 747.
Atlas Air has the largest fleet of 747s and will take final delivery of the last plane in early 2023. The ending of the 747 comes at a time when the aviation industry is looking to transform itself with more fuel-efficient, environmentally friendly technologies. Boeing's CEO recently said the company would not design a new airplane in the next decade, while the company waits for new fuel-efficient engines to be developed, since advances in engine technology doesn't yet warrant enough of a fuel cut for buyers.
The end of the 747 is pretty much the least of the issues that are going on at Boeing right now. This is a manufacturer that in 2018 and 2019 had two of its best-selling 737 MAX planes crash and 346 people were killed. Since then, the company has been trying to regain its footing. It has picked up sales of those aircraft once again, but it's not the only thing that Boeing is dealing with.
It also had production flaws on its 787 Dreamliner that delayed deliveries for almost 2 years.
There's a third front that Boeing is dealing with, which was the replacement essentially for the 747, the 777X. And that's a plane that has been delayed and delayed and delayed, and it's not going to be delivered and flying for customers until at least early 2025. So the end of the 747 is kind of this turning point for the company.
In the meantime, airlines looking to purchase large wide-body aircraft are turning to Boeing's 777 and Dreamliner, as well as Airbus's A350 and A330.
United Airlines placed the largest order of any commercial carrier for wide bodies, and that was for 100 Dreamliners, and they have options to buy 100 more.
As for the Queen of the Skies, the end of production doesn't mean you won't see her flying around anymore. There are 396 747s still flying. 311 are freight, 44 of them are passenger planes, and 41 for VIP or private service, including Virgin Orbit. 6 airlines still operate the 747. Lufthansa is the largest with 25 in its fleet.
The airlines that have it will probably continue to operate it for maybe another 10 years or so, perhaps a little bit longer. I think we'll continue to see the 747 operate as a freighter for decades to come because it's a really good freight airplane.
There's plenty of other ways to experience a 747 too. There are hotels, a water park, and many other aviation museums around the world that have them on display. A testament to how iconic and transformative the Queen of the Skies has been over the last several decades.
The 747 is beloved in a way that most other commercial airliners are not. I remember my first 747 flight. It was on American Airlines from Kennedy to Dallas Love Field. I don't think you're going to see people crying when the 777 or the 787 Dreamliner decades from now is retired. They just don't have the same emotional connection.
She was my first jet. That was the first jet I ever flew. And I don't know if there's many other pilots that can say that. So I guess that's why she's my baby. And I think because I felt like if I took care of her, she'd take care of me.
You could say it's the hump, it's the shape, the size, all those things. But what I think this airplane, it inspires us that we can do these amazing things. And I think that that is what has captured everybody's imagination. Why there's such an emotional attachment to this airplane, that it just reminds us as human beings that we can do amazing things.
$1.7 million square feet, a capacity of about 60,000 screaming fans. That's the plan for the Tennessee Titans' new stadium in the heart of Nashville. It's projected to cost $2.1 billion, and more than half will come directly from taxpayers. The over $1 billion price tag is the most public money ever committed to an NFL stadium, beating out the previous record of $850 million set by New York State and the Buffalo Bills just a year prior. Since 2000, subsidies for financing major pro sports venues have cost taxpayers an estimated $4.3 billion. As 75% of new stadiums built were backed by tax-exempt municipal bonds. And NFL stadiums are some of the most expensive facilities in the world. It's also America's most profitable league.
The benefit is really for the community and the opportunity it provides for locals. Being a major league sports town may have indirect linkages to an economic and fiscal benefit.
While the NFL and team owners estimate that building stadiums will provide economic growth for a city, economists and urban planners think otherwise.
We're talking about a ton of money being used, usually across the country. It doesn't go to a vote. It's if the mayor or the city council wants to spend these hundreds of millions or potentially even to billions of dollars, we now have a lot of empirical evidence, a lot of studies that show that investing in stadiums is not the best idea. It doesn't give you the best return on investment.
Lenders may perceive bonds for a stadium as pretty low risk because the stadium is guaranteed to generate revenue, because football is cartel. It's not going to go out of business anytime soon.
It all begins with the issuing of tax-exempt bonds from state and local governments that the federal government has signed off on for decades. These tax exemptions help lower the burden of high debt through low-interest municipal bonds used by cities and teams to pay for stadiums. Since 1913, municipal bonds were a popular financing option for things like airports, roads, hospitals, and schools. Private entities had access to public bonds, but were subject to a volume cap that limits how much public bonds are issued per year. As for stadiums, well, they weren't subject to that cap. But fast forward to the 1980s, we arrive at the Tax Reform Act of 1986. The bill wanted to end tax exemptions for private use, including stadiums. Instead, the bill inadvertently created a loophole, allowing stadiums to be backed by tax-free public bonds. So how does this loophole even work? In order for stadiums to be exempt from federal taxation, they must fail one of two tests. There's the private use case test, which boils down to no more than 10% of the money from the bond is being used by a private entity. NFL teams will certainly pass this since pro teams would use more than 10% of that bond money. Then there's the private payment test, also known as the 10% loophole. That test states that no more than 10% of the bond's debt service is backed by the stadium itself. So if a state or local government is willing to finance at least 90% of the stadium bond, it fails the private payment test, meaning the stadium will get tax-exempting finance through public bonds. In order to keep that tax exemption, repayment of the bond cannot come directly from revenues generated from the stadium or rent collection. Instead, cities rely on taxes like hotel taxes to pay off these bonds through tourism. Of course, that works differently depending on how many tourists the city attracts. Even how things are set up varies from team to team. Just take Las Vegas and Chicago.
The stadium authority actually owns the stadium. The benefit of the stadium is actually to the Raiders. We lease the stadium to the Raiders for no cost. So the basic concept was they're going to put a $1.25 billion into that stadium, and they are going to get the direct economic benefit of that stadium. The public, through the room tax, is going to put in $750 million.
A lot of times the argument is, well, you also get exposure. You know, these Monday Night Football shots looking over Chicago skyline will encourage people to come and visit. And there's really no way to quantify if that's actually occurring. You know, you can't go out and ask everybody on the street who comes to visit Chicago if they came because they saw us on Sunday Night Football.
The 90s became a free-for-all for this loophole, and the moniker of Stadium Mania was created for this sports era. Pro leagues and even colleges began using public funds for venues. The NFL saw major shakeups in the 90s and early aughts. New NFL teams were added, with stadiums mostly paid for by the public. Some teams moved to cities, completely rebranding or rebooting franchises. And as the dust settled, during the height of Stadium Mania, the NFL saw 4 teams move cities, 4 new teams added to the league, all of which were awarded new, mostly publicly funded stadiums. Stadium Mania got so out of control that a bill was introduced to Congress known as the Stadium Financing and Franchise Relocation Act of 1999 to combat teams' leverage on its home city. But that bill never came to law. It's clear that stadiums are largely paid for by taxpayers and local governments, and these bonds can't be paid back directly from what the stadiums generate, so the cities are left to their own devices. And it may come as no surprise that NFL teams make hundreds of millions of dollars in revenue each year. The NFL is a privately owned organization consisting of 32 teams. Revenues for each team is split into 2 groups, national and local revenue. National revenue is the money that the NFL generates yearly from things like media rights, licensing, brand deals, and sponsorships. That money is split evenly among all 32 teams. Local revenue varies from team to team, but it's the money that the team generates from ticket sales, concessions, licensing, team sponsorships, and even naming rights. One team, the Green Bay Packers, is publicly owned and provides some insight to how the money flows for the NFL. The Packers got $347 million from the NFL for national revenue in 2021. Multiply that by 32 teams, and you get $11.1 billion for the entire league. For local revenue from things like ticket sales from hosting 620,000 fans and a stock sale in 2021, the Packers made an estimated $231.7 million in that year. Though there are over 500,000 shareholders, Packers stock has no monetary value. It doesn't pay dividends nor can be sold. Yet $64.7 million was generated by funding from newly deployed stocks to fans. These stock sales allowed the organization to reinvest in its stadium. The Packers are uniquely positioned compared to the rest of the league. Since they're a non-profit publicly owned team, they can rely on things like shareholder funding to afford upgrades or renovations that the stadium might need. As for the other 31 teams, they either rely on private funding or, like most cases, public funds. And in rare cases, when a team and a city don't see eye to eye, a team could just move to a new city willing to foot the bill. Hill is the chairman of the Las Vegas Stadium Authority and was an integral part of facilitating the deal that moved the Raiders from Oakland to Las Vegas in the nearly $2 billion Allegiant Stadium.
From our standpoint, I think it's only leverage if you allow it to be. One of our principles going into this is don't fall in love with the deal. It's got to work for both sides. All deals should. And so from a leverage standpoint, we didn't really look at it that way. We felt like we could probably structure a deal that would work for the Raiders and the NFL as well as Las Vegas and the state of Nevada, and we feel like we certainly did that. And felt also that if we couldn't do that, we shouldn't move forward. It wouldn't ultimately work for everybody involved.
Teams are valued anywhere from $2.8 to $7.6 billion and bring at least $200 million annually, which begs the question, why do multi-billion-dollar NFL teams need public funds for new stadiums? And do the home cities reap any of the rewards? Spillover gains is the idea that stadiums create an indirect positive economic impact. These gains are difficult to track and vary from city to city and case by case. In a comment to CNBC, the NFL stated, "Private-public partnerships have worked well for decades as a vehicle to build multi-use community stadiums. We understand that these are difficult decisions for communities and leaders and appreciate the support. In the case of Las Vegas, the government is better positioned to recoup its municipal bond commitment, as Las Vegas is one of America's biggest tourism hubs."
We're collecting about $50 million additional dollars through room taxes. That's largely paid for by tourists, almost completely paid for by tourists. But the real key there is the stadium itself is producing more tax revenue than the $50 million. It's turned out to be probably double the $50 million, and that comes in the form of live entertainment tax, a ticket tax, sales tax on everything sold around there, a modified business tax, which is a payroll tax. All of those types of taxes then are into their typical flow and used in their typical way to provide services throughout Nevada.
The spillover gains Hill is referring to are unique to not only just the NFL, but all of pro sports. Over 20 years of research studies have found that stadiums are costly and show little to no evidence that gains outweigh the potential tax burden for the city and its people.
You'll at least get the new stadium and you'll get whatever other economic activity spins off the stadium, and then the stadium pays for itself using these sales taxes that have come in otherwise. But that is only true if you accept that the land that the stadium is on and the borrowing capacity used to raise the money to build the stadium, if you accept that could not have been done for any other possible land use other than a stadium. And that's just clearly not true.
Just take Chicago's Soldier Field, for example. In 2001, Soldier Field needed massive upgrades for its aging stadium built in the 1920s.
Beautiful old stadium, just not functional for the modern NFL. The powers that be, Mayor Daley, he was big idea guy, but also a big deferred payment sort of guy. He signed us up for a 30-year bond obligation, and we actually currently owe more than the original project was estimated to cost.
Renovation costs were $587 million. $200 million in funding came directly from the NFL and the Chicago Bears. The remaining $387 million was financed through public municipal bonds, all of which were backed by increased tourism taxes on Chicago's hotels. The city now owes $640 million on that initial $387 million bond. But what about the money generated by the team? Well, since funds generated by the stadiums can't be utilized to pay back bonds, the local revenue an NFL team earns in a given season goes straight back to the organization. Public funds diverted to multi-billion-dollar teams make little sense in the long run to a city. Yet cities continue to shell out hundreds of millions of dollars for teams. In 2021, rumors spread that the Buffalo Bills threatened to move the organization to Austin, Texas, if the team didn't receive public funding for a new stadium. Well, the team didn't move, and it's going to cost the city $850 million in public money diverted to Orchard Park Stadium in New York. For perspective, Orchard Park's per capita income is $49,000 per year. Nashville, Tennessee has received the most public funding to date. $1.26 billion of the estimated $2.1 billion will come directly from public funding, and Nashville's per capita income was over $36,000 per year. The 10% loophole has been widely criticized. The NFL, the most profitable and popular sports league in the US, has garnered the most attention.
I think every city could potentially brainstorm other possible land uses that can go on a space that are in demand, and that there's a market for, and that it doesn't have to be sports.
Reducing or completely eliminating the use of public funds for stadiums has become an increasingly bipartisan issue. Since 2015, both Republicans and Democrats have expressed their shared interest in closing the loophole. In 2015, the Obama administration proposed removing the 10% loophole for sports and other private projects. In 2017, Democrat and Republican Senators Cory Booker and James Lankford introduced a bill outlawing the use of tax-exempt bonds for any pro-sports venues. That same year, the Trump administration proposed eliminating the tax-exempt bonds for NFL stadiums through the administration's tax reform bill. Most recently in 2022, Oregon Representative Earl Blumenauer introduced a new bill called the No Tax Subsidies for Stadiums Act of 2022, yet no progress has been made on that bill.
I think this is something that state and local governments also need to be taking a look at, because especially for a team that serves like multiple local jurisdictions, the team can, without leaving their market and without leaving their particular region, they can still try to pit local jurisdictions against each other in a bidding war over the exact location of a stadium within a region. And that is really a race to the bottom that needs to stop.
As for how fans feel regarding this issue, most just want to ensure that their teams stay put. Protests from fans have erupted over the years when other cities have drawn their teams away from them. NFL teams and their fan bases are linked by a shared identity, and a team can reflect a city's persona. Die-hard fans from all 32 teams will continue to fight hard to make sure that their teams stay in their hometowns, even if that means they have to foot the bill.
San Francisco has an empty office problem. And it starts right here, in the core of the city's downtown. There is 27.1 million square feet of empty office space in the city. And to put that into perspective, let's take a look at San Francisco's largest building, the recently completed Salesforce Tower. There are nearly 20 Salesforce Towers worth of vacant office space in the city.
San Francisco's downtown is among the most vibrant in California and across the country. It's suffering right now. It's emptier than it has ever been in my experience.
San Francisco and many other parts of the country, we have seen a significant rise in the amount of vacant space at office buildings, and it's to a point where we have a pretty big surplus, and that will take a number of years to be able to work off that excess.
We're never going to get back to what we were before the pandemic. We're going to be different. We're going to evolve. We're going to recreate opportunities that may not have existed in San Francisco.
San Francisco has close to 90 million square feet of office space inventory, and over 27 million of that is currently vacant. Mayor London Breed has seen this dramatic change while she has been in office.
So San Francisco has a vacancy rate right now at around 25%, and before the pandemic it was extremely low and almost non-existent.
The issue started with the pandemic because prior to the pandemic in the city of San Francisco, our office vacancy rate was about 4%, which meant that 4% of all the space, the millions and millions of square feet of space that we had in the city were vacant.
And this issue is costing the city a lot of money.
How has the economy been affected by the empty office spaces in the city? Well, the economy has had some major impacts. We are facing an over $700 million budget deficit, mostly as a result to the challenges around our empty office spaces, as well as we're seeing businesses close in the financial district.
Historically a city that thrived off of commuters, San Francisco is no longer that. It's even referred to as the work-from-home capital of America, with 46% of workers working from home in 2021, up from 7% in 2019. With many workers no longer commuting to the city, the local economy continues to suffer and office vacancies continue to rise. The city is now experiencing its highest office vacancy rates in nearly 30 years, and as leases run out, many companies are opting not to renew. So how does San Francisco solve this problem? One local legislator suggests tackling two of the city's largest issues head on.
Well, what we can't do is just leave these buildings empty. That would be bad for our city's downtown. It would be a total waste. There are some obvious things that we can look at where we can meet some of the other needs that we have and actually solve another problem that we have, and that's our housing crisis.
San Francisco is tied with Boston as the second most expensive city in the U.S. to rent, ranking behind only New York City, with the median price of a one-bedroom costing $3,000. And the average sale price of a home in San Francisco was $1.35 million in November of 2022. To address this problem, the city has adopted the housing element, which requires 82,000 units of housing to be built by 2031. In order to reach that goal, San Francisco needs to build more than 10,000 units per year starting in 2023. But that's proving to be easier said than done.
The system is broken, and I have been trying to work with the legislative body of this city to change it. And sadly, in many instances, most of the members refuse to do so. In the next 8 years, we have to build 82,000 units. It's going to require that we make some major changes that I know our legislative body is not going to be open to. But if they don't, what's going to happen? State support for affordable housing is going to be taken away. Tax credits and all the things that we enjoy to support the ability for us to build housing in the first place in San Francisco is going to be taken away. We have to get aggressive with building more housing, and that's going to take a lot of hard and courageous decisions.
With the housing deficit and an office surplus, office-to-residential conversion could potentially be a long-term solution to address both problems.
This is not a simple thing. It's not just, something you can do for cheap or super easily. It's a challenging thing to do, but it can be done. There are over a dozen cities all over the country that are doing it.
From 2016 to 2021, there have been 218 office conversions in the U.S. And so far, in 2022, there have been 42 completions with 21 underway. However, 46% of those conversions have been from office to lab, with only 17% being converted into multifamily buildings.
the rents that you can get for a life sciences lab space are much higher than office space. So it makes that conversion financially viable. We have high demand for residential still, but not at the price that would be required for a developer to do that from a financial perspective.
In current market conditions, developers lack incentives to build housing, and strict regulatory policies often mean that affordable housing initiatives need to be government-led. In Calgary, Canada, the government is focusing its conversion efforts on housing. The city is working with Gensler, one of the world's largest architecture firms, to revive its downtown core.
Calgary was facing a bit of a crisis with vacancy, so they had even pre-COVID, an office vacancy of about 38%. And what that meant was they had around 12 million square feet of empty office buildings, and that was spread across the whole city. But they wanted a way of looking at it to see really if residential conversion was viable, and then if it was, which neighborhoods would benefit from it most.
Through an algorithm, Gensler found that Calgary had about 6 million square feet of office buildings that would be good candidates for conversions. And now the city has started the process of converting its downtown. Gensler estimates that after the completion of the first batch of office buildings, the downtown population will increase by 24%.
There's a lot of cities still talking about it, and they actually moved from concept to action in about 3 months. One of the really interesting things that Calgary did a good job of is just making it very clear and very simple how their program works. It's two things. You go straight to building permit, and it's $75 a square foot. And I can explain it in 10 seconds.
Calgary is just one of many examples of office conversion efforts taking place today. In the US, New York City, Detroit, and even Kansas City have all launched similar initiatives. So could we see something similar in San Francisco?
San Francisco in particular, I think actually has a real opportunity to do something like this, because you have a office market which is seeing an increase in vacancy, especially around the core, and you're actually seeing a housing market that is maintaining strength. People have been talking about a housing crisis in San Francisco for a long time, and this is a good way of slightly redressing that balance.
Has the city received applications to convert specifically from office to residential?
Not at this time, but we are working and engaging with the business community to help them to understand what is possible. I think that there are a lot of businesses, property owners in particular, who were not completely aware of how easy it could be to convert.
And projects like this have taken place in San Francisco before. We met with Mark Babson, the president of Emerald Fund, at 100 Van Ness, an apartment building that his firm converted from an office.
We have been developing housing in San Francisco since 1979. 100 Van Ness is a 1972 office tower, 400 feet tall, over 400,000 square feet of office that AAA owned and operated for many years. We took over in 2011, and then from 2012 to 2015 converted the building from office to residential.
Emerald Fund undertook the biggest residential conversion in the city to date, building 418 new units of housing, and its conversion was largely driven by conditions similar to what we see today.
This was an outgrowth of the Great Recession, and for 3 years they were unable to sign any new leases, and you had a 35% vacancy rate, much like today, in the area, in the Civic Center area. We evaluated what makes more sense, converting the building to residential or keeping it as office. And our analysis said to convert it to residential.
While the decision to convert the building was easy, the actual project was a big undertaking.
I think that our construction costs were somewhere in the $125 million range, which is much less than it would cost today. We decided to strip down the building. The building was at that time 40 years old, and so the mechanical, the electrical, the plumbing, none of those systems were worth salvaging.
Office conversions typically take place in older buildings that are often in need of major repair or remodeling. In these cases, developers are already at a point where they are investing dollars into costly upgrades. While an office to residential conversion may require the stripping of the building, in most cases, it's still much cheaper than building from the ground up.
But we're finding them in general to be about 30% less than the cost of doing a ground up building. Obviously, you're maintaining the existing structure. In some cases, you're maintaining parts of the existing facade.
While office to residential conversions can be a cheaper alternative, many developers have no incentive to build more housing. Strict housing policies often mean that what would have been a profitable project no longer is.
The most important thing from a developer standpoint is what makes the most financial sense, what project works. There's a lot of things that are standing in the way of converting office to residential. The biggest one being that the numbers aren't